Squawk Box. RTX, formerly Raytheon, now out with quarterly results. The company earned $1.45 a share. That is about 11 cents better than estimates. Revenue came in at $20.09 billion. That topped expectations. The expectations had been $19.85 billion. RTX also raising its earnings and revenue guidance for the full year.
Some other notable earnings earlier this morning. 3M reporting earnings of $1.98. That was 8 cents better than expected. Revenue was slightly better than expected. 3M also raising the low end of its full year earnings guidance. It's now looking for $7.20 to $7.30. The low end had been $7 before. Also, GM reporting an adjusted $2.96 a share. That beat expectations of $2.43 a share on revenue of $48.76 billion for the quarter. GM also raising its low end of the full year guidance for earnings per share as well, and that stock's up by about 0.8%. GM CFO Paul Jacobson will be joining us later this hour. Joining us right now is Sarat Sethi. He is DCLA portfolio manager. And Sarat, what are you thinking of earnings season so far, and where the market's valued at this point?
I think we had a really good lead off with financials. Historically, the last couple of quarters, that wasn't very good. They kind of disappointed. But if you look at where Morgan Stanley, Bank of America, Goldman really performed well, and what they said was expectations going forward are going to be better. And I think that was a good leading to earnings coming forward with the consumer, capital markets activity, and if you look at kind of where they think business is going. So that was a good lead in, and then you've got some good earnings coming too. But then you've got some companies saying, hey, things are a little squishy for them as well. So you got to look below the hood, peel back that onion, and say, hey, market's at 5,800. Where are the opportunities? This morning, Raytheon had good earnings. That's a stock that's got great free cash flow. GM is doing well as well. So you have to look at kind of which ones that you want to own going forward for the next couple quarters. Yeah, we know we've got some bumps coming down the road, but I think cash flow earnings are going to be huge, and those that can protect margins. Because companies have raised prices over the last 2 years. We know that for sure. It's the ones that can actually raise revenue going forward and not just price.
Okay, and what companies fall into those expectations for you?
So for us, if you look back, some of the commodity companies, I think copper companies are going to be able to raise prices. We just don't have enough supply. Maybe you get a little bump in the road just in terms of, hey, what's going on with fiscal stimulus? So I like the commodities. I like energy companies as well. Schlumberger had good earnings last week. Stock sold off, but you're selling at 10 times earnings. American Express, down 5% since they had earnings, but they are looking at double-digit growth. So companies that are growing. Now look at Delta. Delta is growing so fast. The stock's trading at 7 times earnings. They're going to basically, in a couple of years, pay off all their debt. They're not going to do that, but they're going to actually increase more into what they're spending for their loyal customers. So I like a whole bunch of these companies that I think are going to grow in the next 2 to 3 years.
It's funny, we were talking about lithium and a new lithium discovery in Arkansas. That's the kind of sea change that you rarely see in a commodities business, but it does happen from time to time. I think you like copper better.
Well, it's interesting. I do like copper, but lithium has already run quite a bit. But let's go back to Schlumberger. Schlumberger can actually help lithium companies find more lithium. So there are ways to play this, but I do think you have to be in the commodity space, whether it's copper, aluminum, or even steel. We just don't have enough of that if we're going to grow the way we want to grow, whether it's EVs, it's going into all the other types of businesses that are going to be productive to save energy.
All right, speaking of EVs, we've got GM coming up, the CFO.
We've loved GM for a while. We've actually sold the stock. I think it's a very good company. I think the headwinds are going to be pretty strong. It'll be good to ask as to how are they going to compete in the EV space? How are they going to compete in the robot space? Stock's done very well, great cash flow, but the reinvestment's going to be very interesting.
It's so interesting to think that a car company now has to compete in the robot space, all because of Tesla?
All because of Tesla, Waymo, you've got a whole bunch of other things coming at it. And how do you maintain the margins in an EV space where you have batteries, to your point, lithium? There's a whole different way of selling these. How do you service them? So I think the stock's done well, but it still trades at a single multiple. It's very hard to get it over that.
Okay. Sarat, thank you for coming in today. Great to see you.
And still to come, Ukraine, the Middle East, other geopolitical hotspots. Mike Gallagher, Palantir, head of defense, joins us to discuss how the election could shape foreign policy. Squawk Box is coming right back.
I think that empathy is an important thing, but my shoes will never fit on your feet because chances are my journey is different than yours. So open dialogue is so important. I'm proud to be a father, a husband. I'm proud to be an executive. I'm proud to be a voice for our community. All of these things, but most of all, I'm proud to be a human. And as a human, I just wake up every day to do the same thing and just do it better.
Welcome back to Squawk Box. Both Vice President Harris and former President Trump have very different approaches to foreign policy as the election draws closer. Joining us right now with a look on what these policies might look like is Mike Gallagher, Palantir, head of defense and former Republican representative for Wisconsin. Good morning to you. I'm curious, actually, if somebody was at a cocktail party with you and said, what do you think the distinctions on foreign policy are? Just straight up, what you actually think they would be, if you were in a sentence.
I think a much stronger military deterrent under Trump, a much more hawkish approach to China, and that is really, I think, where the biggest difference emerges. The Biden administration started off with a lot of continuity with Trump's China approach, and about midway through the administration, they shifted and they engaged in this sort of intense diplomatic rapprochement. They sent every major cabinet official to China in an attempt to turn down the temperature. I think you can expect a much more aggressive approach on China in a Trump administration. And I think his cabinet on national security would largely be populated with sort of Reaganite national security, you know, speak softly, carry a big stick kind of hawkish.
Who do you think would be part of his cabinet? I mean, that's a big question.
Yeah, I think Secretary of Defense, the names you hear, Tom Cotton, Mike Pompeo, Mike Waltz, Robert O'Brien. I think for Secretary of State, Bill Hagerty, Robert O'Brien as well, John Ratcliffe at CIA. I mean, these are all very serious, smart, aggressive people. I think that would be a fantastic team, and I hope Trump and the Trump transition team takes a look at all of them.
Steve Leisman was talking earlier about tariffs and really talking how even bipartisan, as opposed to economists. Economists, on a bipartisan way, say that these tariffs turn into taxes on the American people. Do you agree with that?
Well, tariffs do come with costs. I think you have to make a distinction between the 232 tariffs, which I had opposed. These were the steel and aluminum tariffs. I think it was an exaggeration of the intent of the law. We don't have a national security threat from Canadian steel and aluminum, but I thought the 301 tariffs that Trump put in place and Biden largely kept in place were a good piece of work and highly justified. I think that gets to a broader economic dynamic. As we have a more intense or antagonistic relationship economically with China, we're going to have a proactive, positive trade agenda with other parts of the world, and we need to break down barriers to economic cooperation within the free world.
So
That's
you
the
would,
path
so you
forward.
would be in favor of tariffs on China, but not necessarily on our allies.
No, I think we should actually expand our partnerships with our allies. I think we should look for digital trade agreements with our
But he's
allies.
not-
I think
he's
we
not
should have a
talking
free
about
trade
that,
agreement
though.
with Taiwan, a post-Brexit gold standard trade
Right.
agreement with the UK.
But he's not talking about that. He's talking about putting a 200% tariff on deer. You know, if they move some of their stuff to Mexico.
I suspect President Trump, as was the case during his 4 years in the White House, is using a lot of this as a negotiating tactic. We'll see. He doesn't have an opportunity to kind of pull, and Nixon goes to China on trade in certain areas. The one thing I would say is that for all the talk about economic policy, which is very important, if we don't fix our military, if we don't fix our hard power investments, none of the rest of it is going to matter. And there we have a massive problem with our defense industrial base. Our stockpile of critical munitions has gotten dangerously low. You have a smart audience, right? They look at numbers all day. They're looking at correlations. They're doing pattern recognition. There's an almost perfect correlation between the stockpiles of critical munitions and peace and stability in the world. The reason we see Xi Jinping this week going to Russia for the BRICS summit with Putin, the reason this is the closest relationship between world leaders on the global stage today is because they sense an opportunity to displace America as the world's sole superpower because our military
Can I ask you a question about that, though? Do you think that under the Trump administration, 2016, 2020, from a budgetary perspective as it relates to defense, that he did anything that you would say was helpful to either reducing costs, helping the Defense Department, that is somehow different than the Biden administration?
Well, I was on the Armed Services Committee during those years, and what usually happened is the Defense Department submitted a budget that was insufficient, and I criticized the Secretary of Defense and Trump at the time, and then we, in a bipartisan fashion, would have to overrule that. And we did actually increase defense spending, but all we did was put a down payment on fixing readiness issues that were the result of the defense sequester under the Obama administration. What we didn't do was actually rebuild the Navy. We didn't transform the Fourth Estate. We didn't modernize the software that the military uses. That's what we do in Palantir, in my day job right now. We didn't do the transformative things that will be necessary in order to bend the cost curve, rebuild our shipbuilding industrial base in particular, and maximize production of critical.
And do you think he would somehow do that this time? And why would he do it this
I
time?
think it would
not
depend
that time?
entirely on the team that he puts in place. If you look at the history of the Reagan administration, for example, it required the president backing a very talented Secretary of Defense, a very talented Secretary of the Navy, and they then had to go to war with their own bureaucracy in order to produce the 600-ship Navy. If you read Gates' memoirs, he had to go to war with his own bureaucracy to field the MRAP, which I was the beneficiary of when I was downrange in Iraq. It's going to require that same level of presidential leadership combined with talent in the form of a Secretary of Defense who's willing to push the bureaucracy to actually
And
transform.
to this day, Reagan is criticized for spending too much money on defense. And
Well, he won the Cold War, so that's
what
not
I
a
mean.
bad
But
bad
there's certain things that you need to, as opposed to things that you spend money on that are absolutely useless.
You know, part of the problem too is the military is a microcosm of the rest of society, which is to say the money is largely not going towards the tooth, the weapon systems, what actually enhances lethality. It's personnel costs, right? It's healthcare, it's retirement. It's the same thing that's happening with the rest of society. Healthcare, retirement costs are consuming everything, and that's largely mandatory spending. That doesn't even get congressional review every year. That is the fundamental problem we need to fix, but neither party has exhibited enough willingness or
Fixing by
courage to
cutting
fix
down
it.
the numbers of people in the military, or fixing by cutting the benefits? That you
I think you could first attack the largest branch of the military, which is not the Army, it's DoD civilians. Over 800,000 people. I think with advances in AI, we have an opportunity to automate a lot of those functions and reinvest it in the Army the Navy, the Air Force, and the Marine Corps. By the way, the entire acquisition workforce is larger than the United States Marine Corps.
Would you like
Elon?
Would you like Elon Musk to take a look at the?
I actually find what Elon is talking about extremely compelling, and I've had disagreements with Elon on Twitter Spaces about his views on China, but the SpaceX story is one of the most remarkable and inspiring in recent years. Him going out there and talking about.
Do you think he would
cutting.
figure out the Defense Department? He said this. You want them to invest in innovation. And also, I would imagine, well, you don't want them to cut the budget. He wants to cut the budget.
No, I think.
I don't know if he wants to cut the defense budget, but he wants to create efficiencies.
Yeah, my overall view is that you can cut butter or certain aspects of the welfare state and invest that in a robust military deterrent. And you want a defense budget that at least keeps pace with inflation. But there is a lot of room for savings within the defense budget. The property, the Navy owns a bunch of golf courses and hotels that it doesn't need to own. It takes $15 billion a year, $10 to $15 billion a year goes unspent. Congress appropriates the money to the military, and then it goes unspent, and it just goes into abeyance for 5 years and then back into the Treasury. Use that. Give them the flexibility.
What job do you want in the Trump administration?
My wife's going to give birth to twins in a month, so I will not be taking a job anywhere other than as a father.
What about Boeing? It just from the perspective of the defense issues, all of the issues the company's facing right now, how do they deliver on defense, and what happens if that company really gets in trouble if they can't settle this issue with the
It's a massive problem for the Defense Department. So we need Boeing to transform, and I think we need to partner. I think creative partnerships with Boeing and non-traditional defense companies present the way forward. But I think it gets to this broader issue where our entire defense industrial base or manufacturing base has been eroded ever since we let China accede to the WTO. In 1999, I think 4 of the top 10 American companies were manufacturing companies. Now none of the top 10 are. I think SpaceX is number 11. That's the closest thing. We need an industrial renaissance here in America. And particularly to do that, we need to leverage what is our asymmetric advantage. That's the weapons-grade software that we can produce. We can create a digital twin of all of our factories, from the factory to the foxhole. We can map it. We can get more efficient. We can innovate. That's sort of what SpaceX has done in many cases, effectively. And that's what Palantir is doing on a daily basis.
Mike, thank you.
Thank you.
Really appreciate it. Great to see you.
Always fun to be with you.
Coming up next, we should mention GM CFO Paul Jacobson will be with us after that company just reported its earnings. We're back in just a moment.
Welcome back to Squawk Box. Let's bring in General Motors CFO Paul Jacobson on a morning where GM beats on the top and the bottom line by a wide margin. Paul, I'm looking at the numbers, and it's pretty clear that the strength, it's not entirely because of it, but a good chunk of the reason why you've done so well is the strength of your internal combustion engine business. How have you been able to maintain your pricing that we saw the strength of in the third quarter?
Well, good morning, Phil, and thanks for having us today. It's really a tribute to the men and women of General Motors, from design to engineering to manufacturing to administration. It's really a team effort, but it starts with the quality of the products that we have. We've been in a refresh cycle that I think has kept us ahead of most of our competitors, and you've seen that not just in pricing but in market share and demand for our vehicles, and it's a fun momentum to be a part of.
While you were strong in the U.S., you had another quarter where you struggled in China, a big loss, $137 million. And I think a lot of people look at what's happening in China where you've lost a lot of market share, and they say, is it because the Chinese brands are more aggressive, or is it because the Chinese consumer is just turning away from Western automakers like General Motors?
Well, we knew coming into the year that China was going to be a problem for us. We had a lot of inventory with our joint venture partner. The good news is our retail sales actually picked up in the third quarter, and we've been able to work down that inventory. We're about 50% of where we were at the beginning of the year. So we're making real progress, and we've got a number of meetings with our partner in the fourth quarter. We've talked about needing to make changes to the business, bringing costs down to be competitive in the new market that's there. And we think that we can turn it around.
But to get back to my question, my original question, what's the reason for the loss in share? Is it ultimately the aggressiveness of the Chinese automakers, or is it the Chinese consumer turning away from Western brands, Western automakers like GM?
Well, you know, that's been something that's been going on for a couple of years now as the Chinese consumer has really migrated to new energy vehicles across the board. But when you look at our portfolio, we've got a lot of ICE vehicles over there. We do have a number of good EVs with our partnership with SGM Wuling and the Hongguang Mini EV and others like that. We're also bringing in some premium imports. So while the market has shifted there, there's still a pretty sizable market for us. I think we had just gotten into a point where we had pretty sizable inventory builds that were really causing pricing issues for us, et cetera. So we think that we can adjust the business and work. It might be smaller than it was historically, but something that we can put together and be successful there.
Paul, you had success in the third quarter with EVs, especially EV sales, but you're not fully profitable yet. Yes, you were profitable on a per unit basis, but not fully profitable. When does that happen?
Well, you know, we are making great progress, and as you saw when you were in Spring Hill recently for Investor Day, we've got great infrastructure, not just in our battery cell plants that we've got, where we're the largest producer of cells with our partner LGES here in the United States, but also we've got a lot of flexibility in our assembly line where we can produce ICE and EVs on the same line down there in Spring Hill. So what we've tried to do is really build an infrastructure that's flexible. We know that EV demand is going to have ebbs and flows. We saw it slow down beginning of this year. We obviously saw a pretty big pickup in September. I think some of that was the vehicles that we brought to market. We saw our retail sales were up about 50% in the quarter as we continue to scale. So as we get those scaling benefits and grow into the infrastructure we've built, we've got a really good path to profitability and feel proud of the team for the progress that we're making.
Paul, it is a busy morning with a lot of earnings reports and a lot of interviews like this one that we're going to be packing into Squawk Box. Thank you for joining us this morning. Paul Jacobson, CFO of General Motors, on a morning where they beat on the top and the bottom line. Becky, I'll send it back to you.
Okay, Phil, thank you very much. Right now we want to get over to Morgan Brennan. She's got a look at Lockheed Martin's results. Morgan?
Good morning, Becky. Well, Lockheed Martin reporting a big earnings beat, $6.80 per share, but revenue of $17.1 billion. That was missing the mark. The defense contractor is impacted by a lack of funding for the next production lots of F-35 fighter jets as it negotiates lots 18 and 19 with the Defense Department. Now, that's expected to be resolved this quarter, according to CFO Jim Malave. Lockheed again raising guidance for full year 2024 sales, segment operating profit, EPS, free cash flow, raising the dividend, raising the stock buyback. The maker of Blackhawks and satellites posting a record $166 billion backlog. This was led by missiles and fire control. Book-to-bill in that segment was 2.7, which is very strong. Lockheed CFO Malave telling me demand is, quote, very, very strong, pointing to GMLRS. These are the artillery rockets that are used in Ukraine, and JASSM and LRASM cruise missiles, which are produced for the Air Force and the Navy. Lockheed also makes that powerful THAAD missile defense system, which is what the U.S. is supplying to Israel along with troops. Malave noting that that's already in Israel. On election and defense spending, which is currently set to grow 1% due to budget caps, Malave saying, quote, our base forecast going forward is that there really aren't more supplementals. So to the extent that there are, that would represent upside to the growth framework that we're going to lay out. Now, management's going to lay out that multi-year strategy. This is 2025 through 2027 on the 11 a.m. Eastern conference call. Guys, shares of Lockheed Martin, it looks like unchanged right now. The stock is trading right near all-time highs. It's not just Lockheed that's seeing the strong defense demand either, guys. RTX's Raytheon defense backlog surged last quarter. Defense remains strong at GE Aerospace as well. I know you guys were just having this conversation with Rep Gallagher of Palantir, too. Back over to you.
Yes, we did. All right, thank you, Morgan. Coming up, Paul Tudor Jones on markets, the election, the Fed, and much more. An exclusive interview that you can't afford to miss. Squawk Box coming right back.
Spotlight.
Still to come this morning, how the Harris campaign is thinking about ways to tax billionaires. And later, an exclusive interview with Paul Tudor Jones. That is live from the JP Morgan Robinhood Investors Conference. Squawk Box will be right back.
maybe.
The other one.
All right, welcome back, everybody. The results of the final CNBC Generation Lab poll before the election are in. That poll surveyed just over 1,000 people across the country from ages 18 to 34. According to the poll, the top issue when voting for president is job creation and the economy. That's followed by taxes. The Harris team has been looking at more ways to get tax revenue from America's wealthiest, especially those who don't pay income taxes. Megan Casella joins us right now with more. Hi, Megan.
Hey, Becky, that's right. So the root of this issue for the Harris campaign recently has been this proposal to tax unrealized capital gains. We heard Mark Cuban on this show come out yesterday and say they're not going to pursue that, but we haven't heard anything definitive from the campaign itself. So I've been talking to folks in and around the campaign and trying to get a sense of what's really going on there. And what I've been told to focus on is her language on the trail that billionaires need to pay their fair share. They need to find some way to derive some sort of revenue from this class of Americans. And so what I've heard is that her advisors have been pushing an alternative proposal that would tax billionaires' borrowing. So what they would do is say, if you're taking out a loan and using your assets as collateral and funding your lifestyle off that loan, they would tax the amount of the loan.
I mean, that makes sense. That is the money that if you're using it as cash and using it as income, it should be. If it's not being just stored away.
Yeah, that's the argument in favor of it. There's one, depends on how it's structured, of course, but there is one proposal out there that says it could raise $100 billion over 10 years, most of that being the existing. So in the first year, it would raise a whole lot, and then less moving forward. But what the argument is that there's fewer issues than there are with unrealized capital gains. There's no liquidity issues or concerns. There's
No
less of a
constitutional issues,
especially
in
that
terms
one.
of that. I mean, that makes a lot of sense, but we've said that for a while. I think everybody around the table agrees with that idea. The question is how much money is actually there if you do that. The second question is, if this is what you think, why don't you say it?
Right. $100 billion is not a lot of money when responsible federal
That's
budget.
what I thought.
Exactly. Her deficit's, modeling it now or something like that.
I was going to ask, how much is covering home health care till death under Medicare?
It's not a lot of money to go after this plan.
No, but
That
how
would
much?
be a
No, but
huge
how much
amount.
is this? Because that's a proposal too. I mean, it's got to be.
It doesn't offset the
It's got to
spending.
be multiples of that. It's got to be.
Right.
I'm looking it up, see if I can.
I
see
think
it.
that's what's been so frustrating about this campaign is not really knowing the actual details on anything, having people around the candidate saying, well, I hear that he or she would do this, not actually having it put out and said, okay, here's what I believe in and here's what this is.
Right.
It seems like it's a lot of pandering on both sides to try and buy as many votes as you possibly can, whether that's in the form of tax cuts or whether that's in the form of giveaways, and not a whole lot of concrete measures on how you end up paying for it.
Exactly, and I tried to say that when I was talking to these folks. I said, why are you letting Mark Cuban be out here, being the face of this? Why aren't you saying it yourself when it is something that matters to so many people?
Because they don't want to alienate other voters. That's the big. That's the big
of
issue.
course, the big thing out there. And when I said this matters to so many people, someone told me yesterday they would tell you you're crazy if you said it to the campaign that this matters. The defense is that this isn't something they think is really going to be a moving issue in the last 2 weeks of the campaign. So they don't want to touch it. They don't want to alienate. But that
They don't want to alienate the base, but they also don't want to alienate their big donors, and that's the issue they run.
Exactly. And I guess with 2 weeks left, they'd rather just let Cuban talk about it. Even when Trump's going on the attack, they say we don't want to make it more of a thing by having Harris herself come out and say it. But I agree with you, especially reporting on this campaign, trying to get concrete details out of them has been really difficult.
Yeah, and in the meantime, we talked earlier today about how Donald Trump is basically promising tax-free or tax-massive givebacks to about 93 million Americans. So
Right, so
see
you're
it
talking about
happen on both
deficit
sides.
impact, exactly. And of course, there's the Congress question. I know Joe was raising this earlier in the conversation with Steve Leisman.
Right.
That's a huge question on both sides too. If we have a divided government, it's really unlikely that any sort of tax on the wealthiest Americans gets through, but at least this is one proposal.
Megan, thank you.
Yeah, tax increase on. I mean, they have a picture of Elon Musk when they talk about billionaires that paid $11 billion in taxes when he sold some stock. So Elizabeth Warren and all her constituents cumulatively will never pay that much. Maybe they do, but barely. Coming up, the next move for Bitcoin. We're going to talk crypto and digital assets after the break. Then later, former Boston Fed President Eric Rosengren joins us. Squawk Box coming right back.
It is just before 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick along with Joe Kernan. Andrew will be joining us in just a few minutes. Among today's top stories, General Motors reporting third quarter earnings and revenue coming in above the street's expectations. The company also raised its full year earnings forecast. But GM struggled in China, losing more than $100 million in the quarter. Here's what the CFO, Paul Jacobson, told us about China in the last hour.
We're making real progress, and we've got a number of meetings with our partner in the fourth quarter. We've talked about needing to make changes to the business, bringing costs down to be competitive in the new market that's there, and we think that we can turn it around.
In other corporate news, activist investor JCP Investment Management wants the Cheesecake Factory to look into spinning off 3 of its smaller brands into a separate public company. Cheesecake Factory shares are up on that news by about 3.6%. And Wall Street Journal parent Dow Jones and the New York Post are suing artificial intelligence company Perplexity AI, saying that the startup is illegally copying their content. In the lawsuit, the news publisher said that Perplexity was engaged in what they called a brazen scheme to compete for readers while simultaneously free riding on valuable content, basically taking their content, using it without making any payments.
What are the lesser brands of Cheesecake Factory?
There's some new ones that they mentioned. I had never heard of them. One's called Flower Child. It's there's another one that's an Italian brand that they were going to spin off, and a third one. And I can understand wanting to spin those off and have them do things. This activist investor has offered to help fund that by investing in the spinoff. But at the same time, if those brands were developed when all shareholders were kind of paying the freight for it, you might think that Cheesecake Factory has its own plans to say, okay, we're going to spin it off and we'll create create value for all the shareholders.
You don't know anything
there the whole time.
about the individual concepts.
No, they looked pretty good. I can understand why they
What's a
said
flower child? Is that like
it's like it's healthy eating.
Ugh.
I'm gonna look it up. I looked at it. I was like, you see all of these small.
Cheesecake's not healthy. Let's price of Bitcoin near the 67,000.
So much.
That's a shocker. Don't tell. If it isn't, don't tell me.
It's
I don't want to know. I don't want to. Thank you.
Cheese and
I don't
cake.
want to know. I don't want to know. 67,000 this morning. Crypto, it's up about 100. This currency up about 125% over the last year. Joining us now is Eric Golden, CEO of Canopy Capital Group. We haven't had much, developments since the ETF. Have we? And that's really what has caused this recent move. We got as low as 16 at one point, 16,000, didn't we, in the last year and a half or 2 years?
Yes.
75 to 16, now back to 67. Most of it on the ETF or hash rate records. What is it?
I think it's been 3 things. The first is that in September we saw central banks around the world cut rates, and 21 banks cut. We haven't seen that coordination since COVID or the Great Financial Crisis. Stocks are all-time highs, bond spreads are at all-time tights. We're stimulating a very robust economy, which is going to push risk assets higher. The second is the election. We have, whether you believe the betting polls, the actual polls, the market sentiment you have on your show, people believe Trump's in the lead, and if Trump wins, that's bullish for crypto. And the final thing is the point you made, is that the ETF is probably the most successful product in recent memory. Spot Bitcoin is now at $65 billion AUM. It's raised $20 billion in 12 months. That's 5 times faster than gold got to that level. And so I think every asset management firm, somewhere ahead on crypto, somewhere behind, every asset management firm now has to decide what's our position on Bitcoin, what are the products we want to launch.
There was, I'm trying to remember, what was the most recent surge in gold to new highs? What do you think? That was partly the Fed, I think, in printing more money, but there are a couple of other things where Bitcoin was non-correlated with gold. It almost looked like gold was doing what it was supposed to do, what it was designed for, and Bitcoin was just acting like a risk-on, risk-off asset. Is it really what it's cracked up to be in terms of only $21 million debasement means that it's going to be good for Bitcoin? Because it doesn't act like it's truly going to do that. You think eventually that will be borne out?
No, I agree with you. If you zoom back out to March, Bitcoin's been a nothing burger. So yes, year to date it's been high, but we have so much volatility in this asset class. It's not yet gotten to the point where gold is truly the flight to quality.
Right.
I think both candidates are talking about increasing the deficit trillions of dollars.
Right.
Inflation isn't going away. The Fed's cutting. There's lots of reasons that investors are concerned.
If it really was truly a digital gold,
It should be up.
It should have been doing better.
And I think it's acting more like a risk asset. And
Right.
what's happening now is what I'm surprised at, which is that the Fed cut aggressively and then told the market it was going to cut even more. What the volatility we're seeing in the bond market right now is the market bringing back that timeline of they're not going to cut that aggressively, that rapidly. But if the Fed did follow that path, you would expect all risk assets to be higher. Independent of who the president is, I expect risk assets to be higher in 25.
We've had people on that everybody's got an axe to grind, obviously, but now I'm being told that that Vice President Harris is now amenable to crypto, or at least been for people that like crypto and don't want to say, vote for Donald Trump. They're now saying, I'm hearing good things from Kamala. Has she been intimating that she's friendlier toward, because Elizabeth Warren and many Bernie Sanders, people on the left do not like crypto.
Yeah, I think the Democrats on messaging this is a little too late in the process to start, to your point, intimating that they might be pro crypto. So I don't think it's falling. I think it's falling on deaf ears.
And if she wins the election, then would you jump on the bandwagon and say, okay, you said you were going to warm up to us?
I think people are hopeful. I mean, yesterday you had Mark Cuban on, and I think it was Andrew who pointed out, look, the Democrats, they sidelined Elon at an EV event. They're isolating Silicon Valley. You're going after crypto. I think there's been a lot of relationships that have been mishandled. And I'd love to see, if Harris becomes the president, I'd like to see those relationships rebuilt, because this is a growing and important asset class for the world. And we can't just turn our heads because there's a couple of senators that really dislike it.
So it's an asset class for the world.
I think it is.
If you listen to the story, the unbanked and individuals that are in high inflation countries that all you need is a phone, really, right? I mean, you can be banked and protect your hard-earned cash if you're in a place where there's 20% inflation. It seems like the unbanked, it's a natural for the unbanked, but I'm still, is that really happening?
The biggest story you're completely correct, that in developing nations, Bitcoin is a core and important asset.
It is?
To your point, if you're runaway inflation, it could be an asset that's a safe haven. The point I was going to make is that stable coins will be the most important topic, in my opinion, over the next 12 months. Right now, there's $6.5 trillion in money market funds. Just this week, you heard that Stripe acquired Bridge for $1 billion. I think it's a huge moment for stable coins, and I really think that will be the killer application that lets people adopt crypto.
You might have heard that Strip acquired Bridge for $1 billion. Did you hear Strip acquired Bridge for $1 billion?
No.
Okay.
News.
You told me that I heard, yeah, so you were wrong. I had not heard. No, it's okay.
It's all over Twitter.
Now I've heard it. It is?
Yeah.
Okay. I need to pay more attention. But we have to know so many
Yeah,
things.
you do. I don't know how you do it.
You don't know how we do
I
it?
have no idea.
Good. So you're impressed.
I'm very impressed.
Okay. Fantastic. I'm impressed with you too, Eric. Thank you. All right. Let's get Dom. I don't even have to say it. Every day what you do impresses me, but you know that.
I feel a lot of love from you, Becky.
You
and
always do.
Andrew.
You get a lot of love from this show. You get a lot of love from this show.
There's not a doubt in my mind, which is why I wake up early with you guys in the morning, and I come out here and I do the morning.
Well, that's a little
movers.
TMI. But go on.
All right, guys. Let's start with your morning movers here, and some movement here with regard to the names that we kind of know and understand, blue chip names. We'll start with 3M, which is up 5.5%. After the industrial conglomerate reported a beat on the top and bottom lines. The maker of building materials, adhesives, medical supplies, post-it notes, scotch tape, everything else, posted its third consecutive quarter of positive sales growth. It also raised its full-year adjusted profit forecast in anticipation of a possible boost in consumer spending due to potential future interest rate cuts. So to kind of tie in some aspects of that conversation you guys just had, 3M is up 5.5%. Verizon also reporting before the opening bell. The stock is slipping by just about 3% right now after missing estimates on revenue but beating on third quarter EPS. It reaffirmed its full-year guidance. Now, CEO Hans Vestberg is touting Verizon's pending acquisition of Frontier Communications as helping, quote, set Verizon up for disciplined growth. So Verizon shares down about 3% there on the mixed story. And GE Aerospace will round things out with down about 5% right now, despite beating estimates on both profits and revenues and raising its full-year earnings per share and free cash flow guidance Adjusted revenues was a miss for the quarter. The stock is still up more than you can see there, 81% on a year-to-date basis, so perhaps a little sell the news type situation developing at GE Aerospace. Becky, I'll send things back over to you guys.
Okay, Don, thank you. Great to see you. When we come back, former Boston Federal Reserve President Eric Rosengren will join us. And a little later, don't miss our special interview with legendary investor Paul Tudor Jones. Stay tuned, you're watching Squawk Box, and this is CNBC.
Haven't seen any information that would suggest we wouldn't continue to reduce the interest rate consistent with achieving that durable expansion with price stability, 2%.
That was San Francisco Fed President Mary Daly speaking yesterday with the Wall Street Journal. Also yesterday, Minneapolis Fed President Neil Kashkari repeated his call for modest, his words, rate cuts over the next few quarters. We've heard similar messages from Kansas City Fed President Jeff Schmid and Dallas Fed President Lori Logan. At the end of the week, Fed officials will start their communications blackout period ahead of next month's interest rate decision. Joining us now, former Boston Fed President Eric Rosengren. He's now a visiting scholar with MIT's Golub Center. Eric, it's good to see you. Let's just focus on what you just heard from San Francisco Fed President Daly. She seems to be saying that this very difficult line that the Fed is trying to follow, that that they're being successful, that inflation seems like it's headed in the right direction, the price stability component of the dual mandate, and labor market is doing pretty well too. So that's such a difficult needle to thread. Do you think the Fed is on the right track, or are there trouble signs?
I think the Fed is on the right track right now. As you just pointed out, inflation has come down, and while core PCE inflation's at 2.7%, that's still higher than the 2% inflation target. As a result of oil prices being a bit soft, we have a total PCE number that's 2.2%. So that's pretty close to the 2% inflation target. And the unemployment rate is 4.1%. The committee, when it met in September, thought we would end the year at 4.4%. So the labor market already is doing better than the Fed expected at the last meeting. So I think it's well set up for a 25 basis point cut at each of the next two meetings.
All these data points, unfortunately, are things that happened in the past. And if the Fed were to try to look ahead, they'd have to use market signals. And that's where I think maybe there's at least some eyebrows being raised about how, whether 50 basis points was necessary and whether we get another 125 or whatever it is. And I'm talking about the 10-year. It's gone up, the yield has gone up almost every day. Eric, gold is hitting new highs. I don't know what that's saying. We are running a pretty large deficit again, and we've got very high total debt. Stock market was down yesterday, but it's within a hair of an all-time high across the board in all of the assets. And you've got forecasts for GDP up at like 3%. What is the reason? How do we know that things aren't hotter than they should be to be cutting rates?
Well, you have to rely on a forecast. One of the challenges of forecasting right now is we have an election coming up in early November, and the fiscal policies that are being suggested by both candidates probably is fairly significant deficits going forward. And at least one of the candidates is highlighting significant increases in tariffs. So it makes it a little bit more difficult to forecast. You're right that ideally you don't want to be looking at where we were a month ago, which is reflected in the current data. You want to actually estimate where you think the economy is going over the next 6 months. And I think some of the movement that you've seen in the bond market is in part reflecting people thinking a little bit more carefully about the fiscal policy implications. So highly stimulative fiscal policy means we don't need as stimulative monetary policy. So if you're anticipating significant cuts by the Fed, it's probably assuming that the economy continues the way it's been going and that we don't have a very stimulative fiscal policy. If instead you start thinking fiscal policy is going to be very different, that brings some uncertainty into the market. And I think some of the market movements we've seen over the last week reflect that.
Eric, just very quickly, we had Rohit Chopra from the CFPB on earlier talking about these open banking rules where the big banks are going to be required to share consumers' data with any third party that requests it. Rohit suggests that this is needed for more competition. The big banks will push back and say that they're worried about safety and privacy issues or just fraud, straight out fraud, if they are forced to give this information to third parties that they don't trust. What's right? You used to oversee the banks. Which is the better opinion, you think?
Well, I think we do have to worry about privacy and how data is used. So, as you know, in Europe, they pay much more attention to the privacy of individuals' data. And I think there is a trade-off between more competition and the advantages that data provide and potential costs of giving people's data in a more widespread way and possibly allowing people that shouldn't be seeing it to actually see it. I think this is one of the areas where the election may make a difference. That my guess is that at least one of the candidates is unlikely to go forward with those proposals. So there are a number of areas that could change depending on the outcome of the election, and we do have an election where the two candidates have different views on things like bank regulation, but also on monetary policy.
Yeah, I guess I was just saying, if you were just historically to tell someone, yeah, wow, the stock market's been ripping and the economy's ripping and, you know, gold is up and and we're cutting rates after what was very difficult, you know, to get back to normalcy at up 500 basis points. That was hard work to get there. And here we are. Just for what reason? At 4% unemployment. For what reason? Instead of price stability, why focus on 4% unemployment at the dual mandate?
So I think it's a combination of both, but right now the Fed funds rate is trading between 4 3/4 and 5%. So if you think inflation is currently, let's use the 2.5%, that's very tight policy by historical standards. So if you think that the economy is continuing to grow at 2% or stronger, and that inflation is coming down, and it has been coming down pretty consistently over the last year and a half, then monetary policy is probably too restrictive for the current conditions that we have. That doesn't mean that we're going to get down as low as maybe 3.25 and 3.5 very quickly if we end up having an economy that's stronger than people are anticipating, either because of inherent growth in the economy or because fiscal policy ends up being more stimulative. So I think it's pretty clear what the Fed funds path is likely to be over the next couple of months. I think forecasting out through next year becomes more problematic until we have a better sense of what the candidates are saying actually comes true.
Hey, Eric, I had a separate question for you this morning, which is that the Washington Post is reporting that Trump advisors have been mulling this idea of potentially trying to demote Michael Barr, who's on the board of the Fed, who oversees the sort of bank supervision aspect of the job. I'm curious what you think of that. Is that something you think is plausible? Could former President Trump, if he becomes the president, do such a thing?
So I'm not a lawyer, but I would say it would be unprecedented, and it's not even clear to me. They're nominated for vice chair for a 4-year term, and it is not clear what powers the executive branch has for the independent Federal Reserve officials to actually demote them. So I think it would likely be contested in the courts, not be decided for some time. It's only a 4-year term. My guess is the courts will still be deciding it by the time that the term is up.
Eric, I want to thank you this morning for your perspective on all of this. When we come back, we've got billionaire investor Paul Tudor Jones is going to join us for a very special and wide-ranging conversation. We're going to talk about the markets, the economy, the Fed, the election, and so much more. But next, we're going to cover some recent medical and pharma headlines with former FDA Commissioner Dr. Scott Gottlieb. Stay tuned. You're watching Squawk Box, and this is CNBC.
NBC.
Welcome back. There's the futures this morning, adding to some of yesterday's losses, but nothing too troubling yet, too significant. We shall see. It is October. And a programming note, Pershing Square's Bill Ackman will join us tomorrow at 8:30 a.m. Eastern on set. Yes, sir. Yes, ma'am. We'll look forward to that.
Well, let's talk to him about it.
Yeah.
All right, some big healthcare headlines just since the beginning of the week. Those include 4 workers in Washington state who are believed to have been infected with bird flu. Washington would become the 6th state to identify human cases this year. Separately, Novo Nordisk's oral diabetes drug cut heart-related risks in patients, and we're still following drama around copycat weight loss drugs. Joining us right now to talk about all of this is former FDA Commissioner Dr. Scott Gottlieb. He, of course, is also a CNBC contributor. And Scott, where should we start with this? You want to start with the weight loss drugs, or would you like to start with what's happening with avian flu?
Oh, that works. We can start with the weight loss drugs, certainly.
Okay. Novo Nordisk, this new oral pill that they have, looks like it is cutting risk of heart disease and many other things. Does this come as a surprise?
No, it's not a surprise. It's a good result. Remember, with this pill, Rybelsus, you're dealing with a much lower dose of the active ingredient, semaglutide, than with the injectable formulations, the subcutaneous formulations. So even though this pill is 14 milligrams versus the 2.4 milligrams that you're getting in Wegovy, the bioavailability, how much of the drug's actually getting into the blood, is substantially less. So only about 0.4 to 1% of the drug from these oral formulations get into the blood versus about 89% when it comes to the subcutaneous formulations. So to see this kind of risk reduction in cardiac events, severe cardiac events like heart attacks and strokes, with much less exposure to the drug, even though it's a 14 milligram dose, much less is getting into the blood and the patients are being exposed to less of the active ingredient. That's a pretty good result. Remember, you saw a 20% risk reduction with Wegovy in cardiovascular events. That was at the 2.4 milligram dose. That was in obese patients. This study was done in patients with diabetes but weren't necessarily overweight.
Does that suggest, just as a doctor, I know they want to get to these pills instead, the oral versions of the drug, because a lot of people are averse to having a needle injection. Would you think that it's better, if you're not afraid of needles, to do the needles so that you could have a lower dosage that doesn't go through your body, or you think it's just as well to go along with the oral?
Well, look, the 14 milligram dose is only approved in diabetes. Novo is actually testing a 25 milligram dose and a 50 milligram dose. That's been in phase 3 development for a while right now. People suspected that they were going to have results sooner. Perhaps they'll have them shortly. But they're testing higher doses for weight loss. So to achieve the weight loss, that kind of weight reduction that you're seeing with Wegovy, you're going to need a much higher formulation, a much higher dose of this oral drug. And, you know, it is possible that at those doses, 25 or 50 milligrams, you're going to unmask more of the GI side effects. So that's TBD. We have to see the data on that. I think right now, if you're looking to use these drugs for weight loss, you could certainly achieve a higher availability of the drug in the blood with these subcutaneous formulations. And as I said, the oral dose at the 14 milligram dosage strength isn't approved for weight loss. You're not going to see a lot of weight reduction with that low dose. The other companies that are formulating oral versions of GLP-1 agonists aren't using semaglutide. They're coming up with synthetic molecules that also have the same effect at that receptor. So they'll be much easier to manufacture and formulate at higher doses. One of the challenges Novo faces right now is that they're cannibalizing a lot of their active ingredient, semaglutide, with these oral formulations. And as you know, there's a shortage of those drug products.
Correct.
And so by manufacturing these pills, and if they do go forward with a 25 or 50 milligram dose, that's going to cannibalize the injectable formulations even further.
Well, let's talk about the shortage, because that leads into the next topic. The idea of the shortages has been where the FDA has allowed compounding of some of these make-it-yourself drugs because there's not enough to go around. Now you've got Lilly with a lawsuit going after some of these compounding companies. What is the right suggestion there? If these drugs are hard to come by, is it right to allow the compounding to take place?
Well, look, the FDA does allow compounding in limited circumstances under certain conditions when there's a shortage of a drug. FDA had stepped forward and said these drugs were no longer in shortage. Tirzepatide, the active ingredient in Lilly's drug, was no longer in shortage, got sued, and then stepped back about a week ago in the context of litigation saying we'll reconsider whether or not this drug's in shortage. I think it's problematic because it creates a perception that FDA is picking and choosing where it chooses to enforce its compounding regulations. Those were very hard regulations to enforce. They were put in place in response to some tragedies that resulted with contaminated compounding products back in 2012. Congress pushed back on a lot of those regulations, and this was one of the more difficult things I did when I was commissioner, trying to enforce those new laws and new rules, because a lot of these compounding pharmacies are prominent businesses in local districts, so you get a lot of pushback from congressmen. If FDA creates a perception that they're stepping back based on policy considerations and potentially cost considerations around these drugs, potentially ahead of an election, I don't know why they did it, and it creates a perception of picking and choosing where they enforce these laws. That's going to make Congress more likely to try to step in to block them in the future. So I think it's a mistake for them to back away from the enforcement.
Okay, Dr. Gottlieb, thank you.
Thanks a lot.
And coming up, legendary investor Paul Tudor Jones joins us for an exclusive markets conversation. Stay tuned. You're watching Squawk Box on CNBC.
Coming up next, the interview of the morning. We've got Paul Tudor Jones here, investing legend. He's going to join us live in just a moment. We've got so much to talk to him about. Squawk Box coming back with Paul Tudor Jones after this. Welcome back to Squawk Box. We are here in downtown Soho, joined by a very special guest this morning. Paul Tudor Jones is here. He's the founder, chief investment officer of Tudor Investment Corporation. Of course, he is also the founder of the Robin Hood Foundation, which is hosting its annual investor conference in partnership with JP Morgan right here. That's going to begin tomorrow, and we're thrilled to have you on the program.
So good to see you again.
So good to see you. We got to talk about a lot of things because we are now 14 days away from the election, and I think everyone is trying to make sense of this market and where things are headed and where things are going, and maybe, depending on who you think is going to win the presidency, how that's going to impact this. So where are we?
Well, for me and in the hedge fund world, this is kind of the macro Super Bowl coming up on November 5th. And I think this one, you know, some elections are not that binary. This one is binary, not so much because of which candidate wins, but it's binary in the sense that what is the market's response going to be to either candidate if they win? And so we can either continue down the path we've been on, which I'm going to kind of frame here in a second, or we may have that point of recognition where all of a sudden the markets have different ideas than what the candidates have been espousing. So
before you lay out where you think that piece of it is, let me just ask you this. So Stan Druckenmiller said that he's convinced by market indicators right now that Trump will win. And I'm curious if you agree with that thesis. Part of it is that he's looking at, you know, Polymarket and the betting markets. Part of it is he's looking at the shares of DGT. Part of it he's looking at Bitcoin.
Mm-hmm. Yeah, certainly the markets are saying he's going to win. I think they're heavily skewed by Republicans, so I don't know if I necessarily believe the betting markets, but I don't have any great insights. I really don't. I just would be more skeptical of them than I would normally. It's the same way, look, in football betting, right? You can get a huge home bias where the line doesn't reflect reality. So, yeah, I know what they're saying, and I respect them.
But what about other investors? Dan Loeb recently came out with a report to his investors saying that he's positioning or repositioning his portfolio around the thesis that former President Trump will become the president.
And I have also, if I'm being honest, primarily because I see the polling numbers have clearly moved in this direction.
You say also, meaning you've repositioned as if former President Trump wins.
Yes, I've moved in that direction for sure.
And what does that mean?
It just means more inflation trades, which I'd love to get to, but I think it's really important that we frame where we are right now, and where we are is an incredible moment in U.S. history, and what I really want to talk about is the debt trajectory that we're on. So we've gone in the space of 25 short years from debt to GDP at the federal level from about 40% to almost 100%. 60% in 25 years. And if you look at what our trajectory, what CBO projects our trajectory to be, as well as what we see is and we're going to project further than CBO. So I'm going to show you a chart. This is debt to GDP. So CBO says that we go from 98 to 122, I think 124. That's very conservative over the next 10 years. If you extrapolate that 30 years, you get to 200% debt to GDP. And so that's something, obviously something that can't go on forever, won't. And the question is, after this election, will there be some point of recognition, particularly with all the tax cuts that are being promised by both sides and the spending plans? I mean, they're handing out tax cuts like they're Mardi Gras beads, right? We're doing tax cuts on everything from tips to toucans. So it's crazy what's being promised. After the election, I think the fact that you've got 7 to 8% budget deficits as far as the eye can see, the question is, will the markets allow either candidate? I think under Trump, the deficit goes up by $500 billion per year. Under Harris's plan, it goes up by an additional $600 billion plan per year. I have a feeling all those are just pipe dreams. I think the chances of any of those being enacted are...
You mean that the tax cuts that they're putting on the table during the campaign?
Those have zero chance of being enacted in my mind. I think the markets will, the debt markets for sure, the treasury market won't tolerate it. So
why do you think that the treasury market continues to tolerate it now?
Well, you know, it's so funny because financial crises percolate for years, but they blow up in weeks. That's kind of the history of them, right? And so for me, this election becomes one of those seminal points where all of a sudden, let me really think whether this proposition that the U.S. government is making me is something that I actually want to participate in. And I want to try to frame in layman's terms. Let's assume that I'm making $100,000 a year. You've lent me, because we're such great friends, $700,000.
Mm-hmm.
That's what you've lent me. And I come to you and say, okay, Andrew, I'm going to pay all that back to you in 30 years. But between now and when I ultimately pay you back, I want to borrow $40,000 every year for the next 30 years. And then at the end of 30 years, I'm going to pay the whole thing back. Would you lend me that money?
Unlikely.
You son of a bitch.
Right.
I thought you were my friend.
Well, this is the problem that we have.
Okay, so that's actually the proposition that the U.S. government makes to every bondholder today. That's the exact same proposition. So think about this. We owe $35 trillion. Our tax take is $5 trillion. So we owe 7 times what our tax take will be this year. Our revenues will be this year. And our deficit is $2 trillion, and it's $2 trillion right now as far as the eye can see. That is literally the proposition that the U.S. government is making to someone who buys a 30-year bond.
So I'm not disagreeing with you. The question is, life is relative, so some people would say, sure, you can either buy bonds from the U.S. or you could buy bonds from some other country that has an even worse situation.
Or you cannot buy bonds.
At all.
Right. So anyway, I was watching this Vince McMahon documentary, and in it, and I loved wrestling, particularly when Stone Cold and Rock and all of them. So in it, there's a term that I'd never heard of called kayfabe. And in wrestling parlance, that represents the unspoken, unwritten, tacit agreement between the wrestlers and the fans about the illusion that's going on in the ring, the suspension of disbelief that what's going on in the ring is actually, we know it's scripted and we know it's a performance, but they ask us to think it's genuine and real.
And so that's what you think this is?
Yeah, we're in an economic kayfabe right now. And it's not just the United States, we're in it in the UK, in France, Greece, Italy, Japan being the biggest of all. It's this economic kayfabe, and the question is after this election, will we have a Minsky moment here in the United States and U.S. debt markets? Will we have a Minsky moment where all of a sudden there's a point of recognition that what's going to happen or what they're talking about is actually fiscally impossible, financially impossible?
So are you betting on a Minsky moment?
I am clearly not going to own any fixed income, and I'm going to be short the back end. a fixed income because it's just completely the wrong price. But I just want to add one more thing.
Yep.
And this is why this election, I think, is so, I find it so interesting because the candidates and the parties are so interested in winning this election. But if you look at it, certainly from a fiscal standpoint, you're winning the booby prize. And let me just make this a little more complicated. In addition to the problems that we have fiscally, the United States has a net international investment position that is negative 80% of GDP. I think we've got a
chart on that. Yep.
And so minus 80% of GDP, it's roughly over 20 trillion. And that kind of shows, that traces the history of our net international investment position. So let me define that real quick. It means foreigners own $20 trillion more of U.S. assets than we own of foreign assets. That's how you get to the minus 80% or the 20 trillion. How do we get there? It's actually a good thing. Why do we have so many of our assets owned by the rest of the world? Because we're the leader in technology.
Right.
We're the greatest arena for free markets that there is. We promote and engender. Can I use that word today? Engender. We promote and engender. We promote and engender entrepreneurialism. We generally hold in high esteem the people the best. So anyway, so think about this. The problem with having a $20 trillion net international investment deficit is that you're also beholden to the kindness of strangers. So now we're going to have this election. The next president's going to come in, whoever that is, and they're looking at, okay, I've got $20 trillion that could have wings on it, as well as I've got a fiscally unsustainable path. What do I do? And that's why I'll tell you, I don't know if you've ever seen those goats that kind of perch themselves on the side of dams, and you go, gosh, how do they do that? How do they hold themselves on the side of the dam like that? That's what I think the next administration, whoever it is going to be facing. You're going to have the smartest and the most sensitive president, Treasury Secretary. That Treasury Secretary damn well better be from Wall Street, no markets. It cannot be a corporate head who does not understand the plumbing of the financial system.
So who do you think is going to get you that Treasury Secretary?
I don't know. And frankly, and then let me just say one last thing. And our Fed chairperson, our Fed chairman, and the next chairperson after that, the three of them have to be brilliantly connected to be able to stick this landing. Because again, if I look at debt to GDP, the path that we're on, it's rising faster than the ocean.
Okay, but let me ask you this, and maybe we can show this chart, because also the only way to solve this is to figure out a way to raise enough money where at least the math starts to make some semblance of sense.
Yeah, but before, let me just quickly show where we are in terms of our tax take relative to the rest of the world. So I think there's a quick chart on that.
Yep.
It shows 5 countries. And it goes from the U.S. at the lowest end, 29.3% of GDP is what our tax take is, to France at the highest end. And you can kind of see there's Canada, Japan, the U.K.
Now, before we get into our own math, let me just ask a question. One reason why some people would say the U.S. is as successful as it is because it is less of a regulatory state, less of a tax state, and is probably representative of that on the screen. And when you go down that list and say to yourself, how successful is the U.S. relative to how successful is France, do you say to yourself that France is less successful because its tax rate is higher?
I would unequivocally agree with that. It's like everything. There's a fine line. There's a needle that you've got to thread, right? You could also say one of the reasons why the U.S. is so dominant is because we fast-forwarded so much future income by spending so much in a deficit standpoint, right? And it's really occurred, to be frank with you, the guy that started it was Trump, right? He inherited a 3% budget deficit in 2016. In 2019, that was close to 5 pre-COVID, before COVID. And then, of course, Biden gets in and sees what Trump has done and says, here, let me raise you one with the Inflation Reactivation Act. And, here we are today. So can I just say, between Trump and Harris, you've probably got the two people least suited for the job that's ahead of them. Least suited for the job that's ahead of them. And that's why it's going to be, again, after the election, it's going to be so important.
Let me ask you.
And I do think they know, I think we're doing also a political kayfabe with them. They know that they're not going to do these spending programs. I think they know that. It can't happen.
Okay, but if both of these folks you think are the wrong people, but it's still a binary choice, what is your choice?
I'm going to keep that private, and the reason I'm going to keep that private is because there's a lot of causes that I'm really invested in. Robin Hood's one of them, the environment, and I'm going to end up working with people on both sides. We're a really divided country right now, and I want to make sure I have great relations with whichever administration goes on, because I want to continue serving the millions of people that I do, and the billions of critters that I love.
Let's talk about taxes, though.
Okay.
Because that's how the money is going to get raised,
Correct.
one way or the other.
Correct.
I think we have a screen, if we could, that puts up a little bit of a menu here.
Yes.
Of, I don't know if it's options. Actually, they may not be options
No,
at all.
there are plenty of options. There are plenty of
But
options.
there's not many ways to get where you need to go unless you start to do some of these things.
Correct.
Maybe. So the question is, of what's on the screen, you can let the tax cuts expire.
Well, can I just say this?
Yep.
You have to let the tax cuts expire.
You have to.
You have to let those expire. That's $390 billion. We're going to have, again, we're gonna be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either. I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
But if you think we're going broke, and you think Trump is going to be the president, he's not going to let those tax cuts expire if he can avoid it.
The thing
he does not want the corporate tax rate to go to 25%, as you're suggesting it'll have to. He's suggesting it should go to 15%.
I'm saying that just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to...
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's what I was going to say, it's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
Now, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that. There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest costs, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robin Hood and this conference. But before I do that, is this, given all of the things you're saying, are you off buying gold and Bitcoin and
I think all roads lead to inflation. We're going to end up,
But does all roads lead to inflation, therefore gold is a good investment? Is Bitcoin a good investment to you?
I'm long gold, I'm long Bitcoin. I think commodities are so ridiculously underowned, so I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that, and I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out, and you have a small tax on the consumer, and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation, and that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.
We're going to run out of time, but I want to talk about this because this is also your Super Bowl of the year.
Best day of the year, best day of the fall, and that's our investor conference. It's sold out. It's fantastic. We've got everyone from Seth Klarman, Jamie Dimon, David Einhorn, Bill Gates finishes at the end of the day. I have a great talk with Ken Tropin. Most importantly, you have to think about, I think about Robin Hood and I think New York this way. You're only as strong as your weakest, the chain's only as strong as the weakest link. The weakest link in any society are the most needy, the underserved, the people who are at the bottom. So that's what we do. We're the spear point for helping those people in this city so we can keep a strong city and a strong society.
Paul Tudor Jones, KFAB, right? That's the phrase.
Economic KFAB.
Economic KFAB. Fascinating. Thank you for this. Appreciate it very much.
Thank you so much.
You bet. Joe, I'm going to send it back to you, sir.
Very good. All right. Thank you.
He was saying the quiet part out loud. This is what people won't say about the Treasury markets and what's happening and the potential
We got to inflate it away
to get things under control.
Ask. I didn't know. It's a total aside, Andrew. We love Paul's daughter, and we're big fans. And I don't know if everyone knows Zach Brown Band. He doesn't brag much, does he?
This guy?
Yeah. Zach Brown Band.
He's not a bragger.
No, not a bragger. But I just found that out, Paul, and we're both fans, right?
Impressed.
Very, very impressed. Yeah. All right. Well, tell him. I don't think he has an IFB, Andrew, but I think Carolyn, is that her name? I think we were talking about Carolyn Jones. Programming note, by the way, Pershing Square's Bill Ackman. We have Paul Tudor Jones today. Bill Ackman will join us tomorrow at 8:30 a.m. Eastern time. Here's a final check on the markets, and if I had talked to Paul, I would have. I keep thinking about the 420 on the 10-year and the new high in the gold, because he's saying these things are going to happen then, but these are little things that may be indicating what he's talking about right now.
He also told Andrew, he said that he would not buy treasuries and that he would be short on the long end of it.
Right.
And I think
all roads lead to inflation,
right.
Which means bonds aren't. That yield may continue. We may still be early.
By the way, this is stuff that is, again, whispered about, but not very often said out loud.
Right.
And not somebody saying, look out, beware. Right now you're looking at the 10-year at 4.18. You're looking at the 2-year above 4%, 4.03%. You can talk about a lot of reasons that might be, but I think Paul Tudor Jones just laid out some big issues.
The only other, you still do have to, that's why I get excited about the idea that Elon Musk could wring some of the excess problems, regulation, spending out of it, and then hope for growth, because we're not going to solve it just from raising taxes. I don't think that's, a lot of people, it's going to be a combination.
You need to raise taxes and cut spending, and that is not what the political parties are laying out right now.
But it's going to be solved through growth. It's going to be solved through growth, and I think there's a reason. Andrew's right. France is at 52%. We'll never be France. And I mean, I love France, but in terms of entrepreneurship and everything else that we do so well here. Make sure you join us tomorrow. Squawk on the Street is next.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 of the New York Stock Exchange. David Fabers at 13D monitors Active Passive Investor Summit in New York. Meantime, futures under some pressure amid this global bond sell-off. 10-year yield briefly pierces 420. Meantime, Q3 earnings rolling in. Got some raised guidance out of GE, RTX, 3M, and others. Our roadmap begins with the earnings blitz. We're going to hit the numbers out of those companies, including Verizon as well and GE Aerospace. NVIDIA inching closer to Apple's market cap, aiming to claim the crown as the world's most valuable company. And later on this hour, Faber's going to sit down with Starboard's Jeff Smith, talk about his latest moves, including those involving Kenvue and Pfizer. First, though, let's begin with this morning's barrage of earnings. Is the headline GM or not?
I think it might be GE, and I want to take the other side of the trade. GE Aerospace had unbelievably good numbers. Larry Culp delivered once again. I think that people don't understand if there's any slowdown at all. I mean, there was one bit of, because of Boeing, there's some issues, but I think you got to see right through them. Defense was not as strong as I'd like, but down 11, I mean, come on. I mean, this is like an insult to what Larry has built here. I want to take the other side of the trade on that one. Verizon, no. Verizon's just too hard for me. I don't know. I mean, this has now become a serial, let's just sell it, whatever they say. It is hard to find anything that's really glorious today other than 3M, which really, Bill Brown is energizing that company like you can't believe. Beautiful, beautiful quarter. And RTX, I like the RTX defense and the aerospace. So we have a mixed bag as opposed to the futures, which indicate we just have a bad bag.
Right, which has a lot to do with what bonds have done, as we said. Right?
Yes, it does. And interest rates coming down here. And then there's these Apple. I mean, oh my God. Now we got the guy down, the guy up, the guy down. Enough. Let's just let the quarter happen already. And then Sherwin-Williams was the absolute real bad. And actually take RTX, I'll take the other side there. I want to take the other side of these negatives. And in honor of David, Jensen Huang speaking in India on the 24th. And that's going to be the first time. It's very, very big. Don't sell NVIDIA even after that run.
NVIDIA now, I think, 36 times bigger than Intel.
Well, I mean, they had a better year.
Yes. David, some thoughts? I know you've probably been trying to keep an eye on these earnings as well.
I have been trying to keep an eye on the earnings, been trying to keep an eye on the presentation from Jeff Smith that you mentioned earlier, of course, given the press attention that's already been accorded him for positions that Starboard has in both Kenvue and Pfizer, which we will be discussing with him. And, Jim, I'm sitting here now in part of the show, but also listening to you kind of as an audience. What happened to Sherwin-Williams?
You know, that is, I have been trying to figure out exactly what happened. I will tell you the wrap, which is this is why we need a rate cut. This is what it's about. And I'll buy that. I think that Sherwin-Williams kind of peaked. The same-store sales for the stores weren't that good. Maybe we need a little bit better rate cut, kind of like what the U.S. hardline statement. I've referenced this. This is a UBS evidence lab. I know you pay close attention to the evidence lab. They're saying at Home Depot, they did their survey, 51% of respondents reported an intention to perform a home improvement project during the upcoming 3 months. I'm saying Sherwin-Williams might want to buy it off the idea that this evidence lab says you got to go to Home Depot. I like that call. So I'm not nearly as negative. David, the one I want to know, people are taking up Kenvue price target on what's about to occur there. I mean, isn't that a little aggressive?
Well, it went up yesterday, of course, on the reports of Starboard owning a stake there. And I think the sense you want to get certainly is what is the real case for activism. Sometimes you can make an investment, obviously, over a long period of time because you think something is undervalued. In this case, the argument that Starboard seems to be making is simply the portfolio of products is the strongest amongst any of its peer group. And that peer group includes the likes of whether it's Kimberly-Clark or Colgate-Palmolive or Clorox, or Dwight, Church and Dwight, or on from there, and yet trades at a lower multiple, and has had a stock price, I think, that's down roughly 15% since the IPO, or since it was spun from J&J. And so, we'll get into it with Jeff Smith and discuss exactly what it is they want to try and see there. As for Pfizer, even larger market value, of course, there it's going to be questions, it seems to be, about its historical internal R&D efficiency, its capital allocation, forecasting and budget, and expected future returns on R&D. So these are two names, Jim, that we're going to be spending some time on and hopefully get a little more insight from Mr. Smith in terms of what exactly their approach is going to be. Interestingly, he began his presentation this morning with a reference to Salesforce, which, if you recall, and I'm sure you do, it was 2 years ago during the same conference that he introduced Salesforce as an idea. He and I sat down, devoted most of our interview that morning to Salesforce. And of course, Mr. Smith was then followed into the stock by a series of other activists. And it's gone well, Jim. It's gone quite well during that period of time, of course, in terms of getting margins up substantially. Now, he wants them to pursue the so-called rule of 50, meaning that your revenue growth and your adjusted operating margin added together are above 50, the number 50. That's where he thinks they can get by fiscal year 2028.
Yeah, I wish it was just gross profit margin and not adjusted, because that's the best way I'd measure the rule of 40 plus. David, I think what's interesting is after Jeff Smith took that position with Salesforce, and of course Elliott took that position with Salesforce, Ben App called me and said, why did you tell me these guys are like the greatest guys? I'm like, learning so much. Jeff Smith's a terrific guy. I mean, it's the exact opposite of what you typically hear. He said, the Elliott guys, I'm sitting down with them. I learned so much. I think that one of the reasons why that stock is where it is he sat down with the actors and said, hey, tell me what to do. I think you guys are really smart. And then he did it. It wasn't for show.
Yeah.
Now, will Borla sit down? I don't know. We got to find out exactly what happened. Obviously, with Ian Reed, with Frank D'Amelio, what happened? They were like in favor of Smith, and then
I'm going to try and find out. I'll try and find out.
That's
for
good.
Sure. We'll see if we
But
can
I'll tell you,
get an answer
David,
on that.
I want to know why Kenvue doesn't have an unbelievable relationship with Amazon, where all their stuff is delivered same day. That's the missing piece of the puzzle. In the new world, you don't want to sell at Walgreens and CVS. You want to sell through Amazon. Ask him about whether his online strategy is where it should be. I bet he says it isn't. I bet he says it isn't.
Yeah, I mean, I'm looking here again at the presentation. 18 times is where Kenvue trades in terms of a multiple on calendar year 25 earnings. And that is towards the end, towards the lowest, multiple. Kimberly-Clark's above it, Haleon, Clorox, P&G. You go on from there. Colgate-Palmolive, all of them sport higher multiples, in part because the growth has not been there in the way that there had been an anticipation it might be after the spin.
Right.
I would point out one other thing,
the missing Kimberly.
Yeah. There is an entire industry that is employed on Wall Street to help companies combat activists. It keeps a lot of people employed. One of the arguments that's been made that really needs to be dropped, I think, is that they're short-term. I mean, nothing about this is short-term, and nothing about any of the ones that I've been following lately is short-term. I mean, look at Salesforce. They still own it. It's 2 years later. So there are certainly plenty of arguments, perhaps, that can be made to combat a certain activist in a certain stock at a certain time. But I'm not sure that one that they're short-term in nature really is one that has a lot of resonance at this point, Jim.
Well, I think that Jeff Smith's terrific, and I've seen him get involved with situations and actually win over the other side, and then have some of the other side people join Smith in the next one he does. And a lot of it is because exactly what you said. They are so not quick draw. If anything, what they really are is, can we please sit side by side and make a lot of money together? And I think that's terrific.
Yeah, and listen, as for expertise in healthcare or consumer products in the healthcare industry, unclear to me whether they have any real expertise there. So we'll find out.
Well, David, how about Cheesecake Factory in Darden? I mean, the Cheesecake Factory, somebody took 2% stake in something I have to know who they are. I rely on you for Cheesecake Factory.
I've never heard of them. I'm not discussing it. I'm sorry you brought it up.
Jeez, what is that, like the Panthers? Are you giving me
how
like the Panthers?
How about we get back to GE? That's more interesting. $210 billion market value. I had to remind our executive producer this morning.
Well, it's back to where, if you take a look, it's back to where GE was 40 when you add all the pieces up. So there you go. You're now whole, David, on it if you kept your RSUs. Down 10, I mean, the stock's
They expired well long ago. Management did get re-upped at $3 a share. So good for management. That was very nice of GE to do that to us. But none of us, Jim, got anything. All of ours
Well,
expired.
I got RSUs.
Yeah.
I got RSUs, and people. I guess that was because Jeff Immelt loved me. Maybe not. Maybe not. What do you think, Carl?
But your point is a good one. When you add up all the spinoffs, what was the number now? How did you get to that number? What did you just share?
I have a CFO.
41.
My CFO, Noreen, just gave me the add up, and it comes to $41 per share. Not bad.
Which is right back, kind of not bad. No, not bad at all. Oh my God!
But then
I mean,
they
you know how many
sell.
people? Yeah.
Go. What? How many people did not do well?
Right. I mean, how many people? I remember being at 30 Rock. I've shared this many times when that stock was on its knees, and so many people wondering about their retirement and everything else. It was pretty painful.
Yeah. Well, you know, that's what Medicare's for. Carl,
That was cold.
I'm gonna hand you the ball, Carl. Just not unlike the way the Ravens, which I think are the best team in the NFL, handle the ball.
We do have some sound from Larry Culp. Speaking of GE, I think this is regarding some supply chain issues. Take a listen.
On balance, are encouraged by what we have seen here in the third quarter. You saw the results of it, I think, more pronounced in new engine deliveries and in spare parts growth than necessarily in our internal shop visits, which were lower sequentially. But I think on balance, what we need to do in concert with our suppliers is underway. I think we're developing momentum with them. And that I think is what gives us the optimism embedded in the guidance raise here for the fourth quarter.
It is the third guidance raise of the year for GE.
And, you know, Larry's very forthcoming. I mean, he talked about, I asked him, I said, how about the supply chain? Are we beating that problem? He goes, no, we haven't. There's still an issue. But I think that people have to recognize the service revenue is what matters. The service revenue just gets better and better as long as Boeing's in trouble. Don't forget they also have Airbus. And service revenue has great margins. The stock has been an amazing stock. It has sold off before, and you have to buy it. Not unlike American Express, which sold it badly Friday and sold it badly yesterday. You have to buy these stocks when they're down because the businesses are so good long term. I think the GE, look, is RTX better than GE? It's 6.5 dozen because RTX's defense business is so strong.
Double beat.
It's got quite a multiple,
RTX
though, Jim.
and raising the guidance as well.
Oh, David, quite a multiple? David, maybe it deserves.
Yeah,
maybe these deserve a multiple.
It may deserve it, but if it comes anywhere near even kind of I mean, it's a rich multiple. Is it in the 40s?
Well, look, you have to look at the forward numbers, David. Forward numbers are very good. And you
Yeah,
have to be a
I'm
little
aware
more
of
wishful.
forward numbers,
You
thanks.
have to be a little more wishful and positive and not your usual, kind of downers thing that he just gave me.
Wishful
What was
about
that?
defense spending.
Yeah, I mean, unfortunately, defense
Talking
spending.
about
you know,
the reality
pay
of PEs is a downer for you? Yeah.
Defense spending, they pay on time, David. That's what's interesting. You know who the payer is?
Yeah.
You.
Speaking of that, we're going to hear what Paul Tudor Jones and Larry Fink have been saying about the race for the White House, the fiscal deficit, Election Day, of course, 2 weeks away. Already 15 million Americans have voted early. Take a look at the pre-market, as we said. Got some pressure as the 10-year back above the 200-day moving average. Dollar up almost 4% in a month. Best gain since 2022. Stay with us. Stocks on track to open lower this morning, adding to yesterday's losses. The pullback comes with 2 weeks to go before Election Day. Earlier this morning on Squawk Box, Paul Turner Jones weighed in on the expiration of those Trump tax cuts. Take a listen.
I think under Trump, the deficit goes up by $500 billion per year. Under Harris's plan, it goes up by an additional $600 billion plan per year. I have a feeling all those are just pipe dreams. I think the chances of any of those being enacted are...
You mean that the tax cuts that they're putting on the table during the campaign?
Those have zero chance of being enacted in my mind. I think the markets will, the debt markets for sure. The Treasury market won't tolerate it.
Sobering discussion bordering on almost sort of a Liz Truss moment forecast.
Totally, which is why I like the Wells Fargo piece this morning, which says the election could be a sell the news situation. That people, you get kind of bullish stuff from the candidates, then you get election, and then not so good. Particularly if there's a contested election, I think that could actually hurt the market.
Yeah, Chris Harvey goes into a tied electoral college, and then what happens next, where the House picks the president and the Senate picks the VP?
It is if this happens, I think that there would be a chaotic time. Against that, I think that you could have a Mary Daly situation with Federal Reserve and just they'll be cutting, and I think that in the end we have to be more less concerned about politics, more concerned about will the Fed stick with the plan to be able to cut over time. And I think we'll be okay. It's just that I think that there'll be momentarily, it's not a 2016 situation where it's like, wow, hey, let's take them up. I think that what could happen is, as Paul Tudor Jones said, these numbers just don't make any sense. But it is true that you can wave a wand and change tariffs. You can change the Mexican tariff. Now, a lot of people are very worried about that. I had Ana Butin on last night. Banco Santander is one of the top 3 banks in Mexico. It's a big issue. It's a big issue because Mexico's really doing very well, and it would be a big blow for Mexico. Larry Fink, by the way, follows Mexico very, very closely. But it's really questionable whether you want to raise taxes. If you want to include the tariff as a tax, the American people would be poor. It's just true.
Right. Interesting to hear Fink this week argue that over the long term, election cycles really don't mean much to markets.
I have learned if you bet against Larry Fink, you're a sucker. You really should. He's a Dodger fan, by the way. Good for him. But I do think that Larry has been true north, so I'm just going to say I'm going with Larry. I don't think there's anything wrong with doing that. When you see someone smarter than you and knows more than you, it's okay to say, you know what? Shut up. Just say shut up. I mean, I don't need to rethink this. Okay.
Meantime, the Goldman desk today looks at implied moves on the election 2%, which they're saying now is maybe a little bit too low.
Well, I don't know. I mean, I look. I think that in the end, I think that it's a very exciting race, but no one can really do anything unless you get a full sweep. If you have a sweep, then we suddenly have to start focusing. If they're split, then I think it's much ado about nothing.
Brings us to Katie Huberty's table you might have seen this morning, looking at Dem sweep, GOP sweep, divided, and what that all means to the deficit. I mean, Morgan Stanley's view is that a Republican sweep scenario will likely raise the deficit more than other outcomes.
Yeah, I mean, look, I know everyone's just, this is like the new refrain that Trump would raise the deficit big, and I know the Democrats are not going to be any friend of they can raise the deficit too, so I don't want to do that. The piece I didn't like about from Morgan Stanley was the idea that maybe Apple's numbers, the estimates are too high, and I always remember Morgan Stanley, Katie Huberty, Apple, very close. I think Morgan Stanley's got a beat on the Apple news. So I think that, look, I care about the deficit, but the deficit's one of these things that it's so ephemeral. I don't know. It's like, okay, what do we do? And then you get, like yesterday, I thought the interest rates was just, wow, it's just all over. I come in today and rates are down. The stock futures are down. Somebody's wrong. I bet that the stock futures are wrong.
You're never a fan of the stock futures.
No, they're so idiotic. I got up at 3:15 today, and the futures were down. I tweeted while they're down, and then they just get worse and worse and worse. I went to go back to bed, but what the hell, why?
Pajama game.
Exactly. I was telling Larry, call me at 3 o'clock. I don't need, when you get those numbers like that, I need them at 3. I don't want to wait till 6. What's that all about?
We will get Kramer's Mad Dash and countdown to this morning's bell. By the way, tomorrow, don't miss an exclusive with Boeing's new chief, Kelly Ortberg.
That's going to be very, very big.
On everything from earnings to this new tentative with the IAM, that's a big...
Yeah, I mean, if everything comes together for Boeing, that's going to be one of those moments where you just say,
heck, we're open.
I can't believe we got a chance to buy it on this secondary at, say, 152. That's what I want.
You can't miss that. One more look here at the pre-market. Speaking of a soft open, we'll get the opening bell in 8 minutes. Don't go anywhere.
What do you mean 8 minutes? We're already open. Huh. NVIDIA down 89 cents. Okay, we're retesting the double bottom. Yeah. Dumb?
Going to be
How
speaking with
dare you.
Jeff Smith, of course, the man behind Starboard Value, significant stakes in both
Jimmy's
Pfizer
here.
and Kenvue. Some press around both of those in recent weeks. We're going to be discussing why and what next for Starboard in both of those companies when he joins me just a few minutes from now.
Tesla down 170. You got Apple. Apple at 233. McDonald up 57 cents. NVIDIA down 55. Up, moving up. So it's consolidating at these high levels. What, TSM with a little knife. SPY down $2.71. Consolidating. Three black crows. So we're going to find out if we're bullish or not here in a few minutes. Yeah. We've got China. Pot stocks up a little bit. We're nearing double top on the SPY. Nile had a little pop. Trust securities.
Let's get to Kramer's Mad Dash as we count down to the bell.
Very constructive piece out of Morgan Stanley about Disney. Now, Disney is a club holding for me. Investment year ahead, and this is fiscal year, which starts it's the October fiscal year, so you're not that far away from that. But then it says inflection, reiterate, overweight, and that's part of that is the cruise ships are coming. You know, one of the things that's incredible is no matter what day you have, Norwegian Cruise raising price target, Viking raising price target, we had Royal Caribbean raising price target, so it is going to impact, it's actually big enough, the cruises, to help Disney. I have to go to David on this. David, I haven't really heard you opine on what the change of CEO means, and particularly I'm talking about Gorman being chairman, which does feel like a Howard Schultz moment for Iger. Is that what's happening?
I got to ask you, what do you mean with a Howard Schultz moment?
Well, I mean, is Iger really going to be gone? Is Iger gone? Because if Gorman's the chairman, that would mean Iger gone. I don't know if I don't want Iger at least kind of given his thoughts to the new CEO. I don't want Iger gone. That would be a mistake.
We do want him gone.
I have every reason to believe, as I understand it, that Bob Iger will be the CEO of this company 2 years from now, winding down his second stint as CEO as 2026 comes to an end, with his successor having been anointed months earlier. Jim, that's the scenario I'm following at this point. Now, Gorman may continue as chairman after that time, but that's what I'm expecting will happen.
Now they're open up. So what's going on here? I'm confused. Okay, we double top here.
Coming up, so this is kind of setting the stage for software companies and kicking it off on a pretty good note with shares up 3% right now. And as you said, a really impressive past year, up now almost 80% over the past 1 year.
Okay. Wow. Seems like the companies right now connected to any type of consulting for cloud and potential AI implications, trying to match up the world's businesses with the new tech and how to integrate. It seems like a pretty good place to be. So we'll kind of watch for Accenture, Atlassian, some of the others here that kind of share some of that overlap, because the SAP chart looking really good. And Raytheon too, and General Motors. All right. Thanks, Caroline. Nice look at some winners for us this morning. Appreciate that very much. Good earnings start here. Let's prep for Tesla. Looks like being a car company, it's just fine, judging by General Motors. And strength there. But Tesla, of course, has many a complication, including robo-taxis and cyber, all kinds of stuff that the market has been less convinced about lately. We'll be right back.
We're going to find out any moment.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Schwab.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds.
Boom!
Go deeper with Thinkorswim, our award-winning trading platforms.
The 5850s
Unlock support from the Schwab
are up
Trade
a
Desk,
buck.
our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. All so you can trade brilliantly.
The market seems a little bullish.
Got Tesla earnings as a highlight this week, and General Motors setting the bar a bit high. Joining us, Seth Goldstein, is an equity strategist covering energy and resources at Morningstar. Tom White going to do some trading with us in a moment. Seth, welcome back to the show. When we're looking at Tesla, are we thinking about this as a car business, or are we thinking about it as a robot biz going into earnings?
Robot.
Well, autos will still be the main product, and that will be the main driver of revenue and ultimately profit when Tesla reports. But longer term, Elon Musk wants to invest to position the company as more of a software and robotics company, moving away from autos over time. But that being said, we still think autos will be the main business throughout the rest of this decade and the major source of profit.
Okay. So right now that stock's been super choppy, what's sort of the baseline expectation for valuations? Just kind of starting from the top here with Tesla, what's reasonable? I mean, should it then be valued as something with a lot of growth potential still?
I still see potential for a lot of growth. We might not see deliveries growth really accelerate in 2025, but if Tesla maintains its timeline to launch the new, more affordable vehicle next year and really ramp up deliveries in 2026, then we could see deliveries growth start to resume the traditional double-digit pace that we've seen in most years before this year. And then we could see revenue accelerate also with the energy generation and storage business continuing likely double-digit solid build out and deployments. We will likely see Tesla still, maintain these strong levels of growth that are currently priced into the stock. And I still think it is a very high growth stock.
Okay, so then the standard here, what do they need to do to prevent the shares from dropping more? What do you think the bar is set at for their earnings? What's the most important figure? What do they need to hit on?
Well, I think we need to see three things. First, I want to see how automotive gross profit margins do with deliveries resuming growth. We saw 18.5% through the first half of the year in both Q1 and Q2. So I want to see either margins remain flat or some margin expansion.
We got a flag here. 1, 2, 3.
I want to get an update on full self-driving, either adoption or miles driven, because ultimately that is the catalyst to train the software to make it ready for robo-taxis to be a real thing. And then third, I I want to hear an update on the more affordable vehicle. I want to hear, is that still going to go into production next year? And is the timeline for 2026 to see double-digit deliveries growth ramp up? Is that still a reasonable timeline? I'm hoping we'll get all three questions answered on the earnings call.
Okay, and further deliveries in the actual car production, we're talking mid-single-digit growth. Is that going to be the forward look too? Because they're going to report basically around single-digit trailing numbers. The outlook, is that consistent that they're going to be around the same pace?
I think in Q4 we could see a similar level of growth. We could make up much of the decline from the first half of the year, and I think Tesla could get to about 1.8 million deliveries again for 2024. And we might not see growth versus 2023, but at least would see 2 quarters of growth in the second half of the year heading into 2025. So I think we'll see much improved results through the rest of the year, setting us up for a better results in 2025 versus 2024.
Okay. All right. So Seth, it sounds like you've got a reasonable confidence in their ability to live up to some of these growth expectations, but your $200 price target, 2 stars, right? I mean, that seems like more of kind of a cautious stance as far as the rating goes. So are you waiting for them to deliver something really impressive here, or walk me through kind of the way you're thinking about the returns expectations?
Yeah, when I look at my $200 fair value, I'm assuming long-term we see margin expansion as their longer-term cost reduction, unit cost reduction initiatives go through, as we see about 30% compound annual growth. The Educator to the storage business, from storage deployments rapidly rising, and a deliveries growth in 2026 as they launch a new, more affordable vehicle. So I still see a lot of growth priced in, but the big wild card has been the FSD software and the market expectations for robotaxi, and I think that's why we saw the stock sell off after the robotaxi day, somewhat disappointed versus where the market was hoping we would get more clear guidance on an actual path to robotaxis launching to rival Waymo, whereas we got more, maybe 2026, Musk even laughing that he's bad at predicting the future, versus tangible plans for how to get to the FSD today to robotaxis being on the road.
Boeing might be resolved tomorrow.
The affordable car as a more important potential product, how much clarity do you think they're going to be able to provide at this point? Do you think they've got that as an ace up their sleeve? It didn't seem to be too much of a focus on the last event, but that was pretty clearly all about the AI stuff.
Yeah. Last quarter they said we're not going to get into new product details unless there's a product launch event. So I wouldn't expect anything like prices or range or any specs on this new car, but I'm hoping at least we get a timeline, and if Tesla's maintain their timeline for this new car to go into production early next year, then I think we're okay. But if we start to hear management say, well, maybe it'll be later in the year or in 2026, then we could get a market reaction to a more delayed timeline.
All right. Thank you, Seth. Appreciate that analysis. Good one. Seems pretty reasonable. Heading into the report with a lot on Tesla's, agenda here. Tom, the cyber stuff, the self-driving, the cheap car. I mean, we've got a lot that they could pull from here to impress the market. But to Seth's point with the $200 price target, might be an uphill battle at this juncture.
Yeah, competition. What did China numbers look like this past quarter? Because demand's been waning a little bit over there. Competition really heating up. So I looked at this from a trading perspective, really short-term positioning, and it's all about implied volatility, Oliver, because implied volatility is elevated going into this report. Option market's pricing in about a plus or minus 5.5% move, and the shares just about $12 either way. Seems kind of low, but maybe maybe the move's already in because we pulled back after that cyber taxi event, that We Robot event already. So with that in mind, we got some disparities between implied volatility levels, and I want to take advantage of them. I'm going to show you a bullish and a bearish trade. Start off with a bearish one. I think lining up with his $200
$17 still to go.
Right. So
looks like it wants to break.
Dispersion. So we're looking at a put
Michael
to the downside, where I'm going to go out to really short-term positioning. November 1st weekly options expires in 10 days. buy the at the money 217.5 strike put. That's basically at the money, right? And then about that 1 standard deviation, I'm going to sell a put in the October 25th weekly cycle that expires in just 3 days with that higher implied volatility. Sell the 202.5 strike put there. So $15 wide, bearish put diagonal to the downside. You're paying $7.50 debit roughly for it. So it's half. The price is half the width of the put diagonal. Why is that? Well, because that dispersion that I said about implied volatility, I'm buying basically a 64% implied volatility in the November 1st weekly 217.5 strike put. Selling about an 87% implied volatility on aggregate in the October 25th weekly, the 202.5 strike puts. That's why it's condensed the price of this, because of that dispersion there. Takes advantage of any downside move. You break even around 213. Maybe 212 or so to the downside. So you don't need a massive move on a percentage basis to get below that break even. And as you get closer to expiration over the next 3 days, you can roll that short option or just close it if the stock does move down. But this is definitely a bearish directional trade, taking advantage of the different implied volatility levels to lower the risk in the price.
Okay. All right. Seems like a pretty good approach, reasonable one. Gives you some range of outcomes, but also betting against a big move to the upside.
Right.
So, all right, 213 to break even there. You got another one for us?
Yeah, and this one it's the same concept. It's a really short-term positioning, a 1 week wide call calendar to the upside. So if you're more bullish and you still want to take advantage of those that vol disparity between the option series, this does it also. So I looked at a call calendar here, where I'm going to go out to that same November 1st weekly options. I'm going to buy the 230 strike call. That's about that 1 standard deviation move that the market's pricing in at this point. Buy the 230 call in the November 1st weekly option. Sell that same call in the October 25th weekly options that expires in just 3 days. Now, this is going to be lower cost entry point price trade, about $1.75 debit or so. You're going to be your risk on this particular position, but your break evens are going to be about 220 and about 240 on this one. So you're still taking advantage of that, buying a lower volatility, selling a higher volatility due to the earnings event that takes place tomorrow after the close. But this one's going to be really lower priced as far as the input cost and the risk on this particular trade, but still taking advantage of that vol dispersion. Now, you could do either or of these strategies based on where you set the strikes up on this. So you could do a call diagonal if you're more bullish, but this one on the call calendar, I don't want it to explode too.
He does not want to
the upside, and I don't want it to go down.
He does not want to go down. Neither do I, my friend.
Strike, but you've got a nice
vol fade.
Yeah.
Right.
The Donald's up again today.
Which, by the way, doesn't seem like a bad way to play it either, because you could take that line from the lows for Tesla, and it gets you to kind of where it is. So if it holds that,
I don't think this SPY is going to stay here all day.
Somewhat of an uptrend that it's got. It kind of broke that around 220, but that would suggest that it might kind of have a little bit of a pin around that 220, and that would pay off for you here.
Yeah, you want it to grind up towards 230 over the next 10 days,
Oh.
but yeah, it would between about 220 and about 240.
Right, that's where it starts to make money. Okay, all right.
Yeah.
All right, interesting approach. Thanks, Tom. Good stuff. Get us ready for Tesla. Let's come back and trade some Boeing. After finding some support yesterday, shares were in focus this morning as we talk about potential comeback stories. This is the toughest one out there. A little changed on the day, but with GE's numbers, some possibility that perhaps the demand is there, and if Boeing can straighten things out with their employees in time, perhaps we can see a turning point in the shares. Stocks still down a little bit. This election season, stay out of the muck and the mudslinging. Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
I can't wait till it's over.
Crazy political year. Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome back to Morning Trade Live. We're in hour 2, 30 minutes into the trading session. Not much has changed. Stocks still under a little bit of pressure. Tiny bit of selling, about 0.5% across the board. Also NASDAQ, pretty much in the same place, but you see some firming of
I don't think we're going to stay here.
Moments. Alphabet turns positive. Microsoft does the same. Nvidia just below 144, only down about 20 bips. Seems like it could very well wake up. We've got bonds turning red a little bit, so some more selling in treasuries. Dollar firms up. Looks like we're getting more of the same there. We do have a little bit of economic data. Our only print
I will be right back.
Comes from the great state of Virginia, the Richmond Fed, which hits a little better than expected, but still a pretty big negative print. Not the type of thing that you expect to really move the market whatsoever. But,
Oliver.
Worth pointing out. So that number is
Stop being so negative.
but slightly better than expected. We got a little selling in Bitcoin this morning, down about 1.2%. Dollar firming up. Gold hanging in there. Gold has been unstoppable, but maybe running into a little bit of pushback, and the rates market selling off.
I'll be back soon.
Something to watch. So bonds flip a
Today's
little red, but
Tuesday.
good calm there. We're gonna keep talking to some stocks. Boeing is on our list. Sure, it's a little change today, but decent bounce yesterday on reports that they might be finding a middle ground with employees, but still a lot to be done there as the strike continues. Volatility in the election we'll be talking about, and earnings with a focus on tech, but also consumer staple Coke going to report. So Chartmaster going to take a look at those for us. Right now, let's check in on the session with George Tillis, senior markets correspondent. Let's start from the top down, George, with the macro side. Bonds were firm this morning and they flipped now, so even though it's a pretty small amount, the magnitude
George!
big. The fact that bonds
George is here!
Finding, higher yields, even when we start out the other way, seems like kind of a conviction trade building.
Yeah, I mean, there's a little bit of a give back today. We're seeing essentially the 30 years down. If you look at 10 years, also down. I don't know about this market, OJ. It just feels like it wants to be volatile. Obviously, the VIX is still moving very sort of aggressively, if you will, relative to the way the market's moving. There's a lot of disparity between performers, especially in the technology space right now. You look at the leaders in the S&P 500, you're seeing, of course, companies like General Motors higher, some of the diagnostic companies, but overall there's some poor performers out there like Pulte Homes. And then even if you look at GE Aerospace and the industrial space to the downside. So kind of a mixed market, to tell you the truth, OJ. If you look at, like I said, the technicals, there's a multi-month pennant forming, if you will, or a wedge. Can't say which direction it will break out. I think earnings will give us a little bit more of a pulse on the direction of the markets. But I think, still folks are overly perhaps bullish right now. There's not a lot of bears out there, and that might be a contrarian trade to consider.
Okay. George, that's where it seems like it's developing a bit. It's kind of been that contrarian trade with the Fed cutting and yields going up. I think for many that was a little bit of a surprise. We did talk about it here early on that was a very real possibility as long as the economic data held in, and they have. They've generally beaten expectations. We were talking about Jeff Kleintop this morning, the economic surprise rate here in the U.S., better than the rest of the world. So I don't see why our dollar wouldn't stay where it is, at least for now.
Yeah, I mean, it's firm. The economy right now is still sound. Obviously, the labor market is still, based on last month's report, still sound. I mean, if you look at, regional areas, like you mentioned, the Richmond, Virginia area manufacturing, and of course, index for new orders, that's been down 11 months in a row. So there are pockets of weakness out there. I think inventories, just looking at the auto market and even inventories of new autos, they seem to be piling up. So maybe manufacturing is a little bit weak. But nonetheless, I think the long-term yields rising really messed a lot of traders up with the expectations. Yeah, the Fed is lowering rates, so therefore everyone's going to pile into long-term bonds as a defensive measure. That has not been the case. So, gold markets as well, you have to consider hitting new highs. The producers, if you look at the commitment of traders reports, are very short the futures, but they're okay with taking losses on futures because they have physical deliveries. So, but just keep in mind, producers typically really have a pulse on the entire market for the gold market, or at least in the commodity space, but they can certainly wait a long time and take losses on the shorts on their hedges, their futures, because they're making it up on their physical delivery spot prices.
Okay. Yeah, gold, real resilient, really impressive stuff. And the reliability of that trade has been pretty incredible. So gold's working, dollars holding in, bonds selling off, and VIX too. George, the last point is to put it all together. I mean, vol, to your point about the market just wanting to keep that vol in, it seems, some would argue election related. That point I feel like is debatable. It seems like the last 24 hours it's more treasury related, as we're talking about here, the kind of surprise sell off of bonds. But still, just, VIX at 19, pretty stubborn, for the better part of our post kind of August move in markets. I think many are kind of surprised that we haven't been able to retain those low teens levels. Instead, we're in the high teens and almost going back to 20.
Correct. Yeah, correct. Typically, when you're seeing, markets at highs, at least the broader S&P, you see the VIX in the mid to lower teens, and it's not the case this time around. So, I can't say exactly what it's telling us, but obviously there's hedging going on, based upon the election risk, because there's going to be a lot of uncertainty in terms of policy, obviously, who's going to win. But just expect volatility going into that event. The other thing I'll just quickly mention, heating oil futures, if you look at those, they're actually moving slightly higher today. I've noticed the airlines in the past few months have performed exceptionally well because heating oil is a proxy for jet fuel. And we do know that producers or refiners have been cutting back output, so that might be something to take a look at, as well as perhaps the crude oil market.
Okay. WTI bouncing a little bit. We're back above $71. So that's something kind of interesting the last couple of days. But WTI has kind of been scrunched into this 75 to 65 range now for a couple months. So it's hard for me to get too worked up about it just yet. But kind of similar to the way, bonds selling is welcome until it's too much. I feel like crude oil's strength is welcome until it's too much. But I feel that that's probably not anywhere with a 7 handle, George. I'll give you the last kind of thought there. WTI, I think a lot of people expected this to be a lot more of an issue at this point for like the reflation story, and it just hasn't. No matter what happens in the Middle East, it seems like we got enough pumping from everywhere else.
Well, that's the thing. Obviously, we're producing tons of oil now in the United States, and so they obviously are very price sensitive. Based on the inelasticity of demand for, gasoline and distillates, and of course, crude oil. I suggest they're probably going to cut back production to offset some of these price declines. So that's something to just take into consideration. And like I said, you see the cyclicality in the airlines, which are obviously very sensitive to fuel prices, and they've, as a group, have performed exceptionally well. So I'm not saying, looking at distillates or heating oil, we're moving into, of course, the heating season, so that's something to also keep in mind. But a lot of the refiners as well have not performed well in the past few months. And so with production being cut back, we may see some prices firm up.
Okay. Thanks, George. Good look at the market here. Nice job taking us through pretty much all of it. WTI back above $71. Nvidia also just turned green, so tech is getting close to even on the session now. Russell still a little bit lower, but we're seeing the market shift back towards some of the mega cap winners. Jeff Pierce joins us for a look at Boeing earnings tomorrow after a bounce yesterday. That enthusiasm is on hold until the report, Jeff. So what will drive the stock in Boeing? Because we've got earnings, but we've also got this whole, labor dispute going on too.
Yeah, and I think that's a big piece of the puzzle, right? Is that vote that's going to come out on Wednesday. That could certainly in this production issue that we're now having with the 737 MAX and 777 planes, it's costing the company roughly $100 million a day in lost revenue by some estimates. So we know that obviously this has been going on since September 13th. Been a big, very big issue for Boeing, and that's on top of the delays and production issues that they've had going into this. In terms of expectations for the report, earnings expected to come in with a loss of about $10.34, revenue about $17.9 billion. That would compare to a loss of $3.26 a year ago with $18.1 billion in revenue. This will be the first earnings report under the new CEO who took over in August. Earlier this month, Boeing sent a warning to the investors out there saying that they were looking at a much bigger quarterly loss and weaker sales. They've also said that they've had a cash outflow of about $1.3 billion in the period. They did announce plans to lay off about 10% of the workforce. That could reduce annual costs by a range of about $2 billion. And we know last week they filed for about $25 billion to offer equity or debt over the next 3 years, along with some new credit agreement with lenders. Now, if you've been following Boeing, you know they have not delivered a profit since 2018. While they've made it through this strike so far, they need to make planes to make money. We know the 787 is constrained by supply chain issues, along with the 737-7 and the 10 and the 777X. If we look at the start of the year, there was a time where we expected them to deliver about 700 planes, generating about $5.4 billion in free cash flow. Now, a lot of analysts are expecting about 430 planes and using cash of around $10 billion. There's also the issue of credit ratings firms. The company needs to preserve cash. They could get downgraded to junk levels if they're not able to do that. And we know that they were burning through cash before the union walkout. Estimates are that this is costing the jet maker about $1 billion a month with this strike. So there's a lot going into the report. Investors are going to be paying close attention, although we've seen a lot of data and there's some optimism around the end of the strike. Tomorrow could be a very big day. It could be very volatile for the company.
Yeah, seems like there is a lot that needs to still be addressed as far as the financials and the bottom line goes. Opportunity to hear fresh from the CEO on the strategy, but the market's response yesterday suggests that the labor situation has been a negative force on the stock, given that we saw just as a step in the right direction, nothing confirmed, but the potential for some conclusion to that was good for a rally. Just kind of hard to know if any of this stuff will be sustainable, but we also yesterday spent a lot of time talking about the airlines that look like they're in good shape. A lot of demand there. GE's aerospace numbers pretty good. It seems like everything around them suggests that the stock should be doing better.
Yeah, and I think, it's possible after we get through the strike and we see maybe the CEO lay out a plan that we start to see some effects of that in the stock. Right now, after the strike, there's the question of what sort of production delays we're going to see, when we're going to see them return to pre-strike levels. It's already a very fragile supply chain right now, a lot of uncertainty around that. And then, of course, you've got the kind of hangover from the Alaska Air incident. You've got other issues. You've got, regulators paying close attention to the company every step of the way. The CEO has, been pretty clear about what they're trying to do in terms of layoffs, in terms of raising cash, even looking at potentially spinning off or getting rid of some of their areas that aren't making as much money for them to be able to focus on the commercial plane division. And that's something that I think we will see laid out once the strike is done. Maybe not in this earnings report. Maybe we don't hear that sort of commentary from the CEO. That's going to take time as they try to kind of rebuild their track record while they try to preserve some cash and pay off this debt as well.
Okay. All right. Good stuff. Thanks, Jeff. Good perspective. Appreciate that. Good setup for a company that's got a lot of complications to it right now. Jeff Pierce. Let's bring in Tim Bigham. He's the option strategist at Buy Alerts. Looking at the trade for us. Morning, Tim. I feel like I have confidence you're gonna make lemonade out of lemons here.
Yeah, hopefully, going forward, I think it's almost so bad, it's almost got to be good in Boeing. And I think they're nearing maybe the end of all the negativity, you alluded to kind of the hangover in the previous spot with Jeff, but I think they're finally maybe getting over that hangover here. And, certainly they're expecting another big loss on the earnings side, but revenue's actually not that bad, still coming in decently here. Stock is pretty cheap on a price to sales basis, approaching the lowest multiple we've seen in a very long time at just over 1x price to sales. So certainly, fairly cheap on that aspect. So I'm just going out looking for kind of a relief rally, perhaps, that it's not as bad as expected here. And you alluded to the fact that, the strike, may be settled. That's probably the biggest news as well. Some of the problems that were, kind of really driving the stock lower have at least slowed down here. So I'm just going out buying next week's 167.5 calls, selling this week's 167.5 calls, paying just under $1 for that spread. Just as importantly, selling about a 70 IV this week. Hedging with under a 50. Market makers expecting about a 4% or so move based on earnings. That puts it right at that 167.5 level, give or take, and right at the overhead resistance. So really just looking for not a big event post earnings given what's happened with the stock, but we're finally seeing glimmers of hope both on the actual fundamental side and on the technical side. The stock did make a low and bounce off there, so I'm looking for maybe a grind higher from here post earnings.
All right, so you don't have to hit it immediately, such as the point of the calendar structure. You give this a little time, a little breathing room, a little opportunity to marinate after the report.
Yeah, absolutely. Marinating is a perfect term for it. And I think that's what the stock may do post earnings, is kind of just move out more sideways here. We finally saw that, kind of maybe a bottom put in a few days ago, and then some good news perhaps out of the, strike front here. So I think the stock probably needs time to heal, not looking for it to, take off, no pun intended, anytime soon. But a move slightly higher would be ideal for this trade structure. Or even a move somewhat lower, right, may actually be profitable as well, given that term structure volatility edge embedded in the trade.
Okay. All right, so as long as we're within a pretty good range here, $3 to the downside, you don't want Boeing to fall apart, but you also don't need it to go vertical. You just need it to kind of grind it out. And also, I think with so much going for the company that is sort of exogenous, not related to the balance sheet, that the time you give yourself outside of earnings allows for some of those other things to maybe come in to play to some degree. Maybe earnings are not a big deal, but then a week from now you get an update on the strike or something, your trade is still going to be live.
Yeah, absolutely. Have a lot of, as you just alluded to, embedded potential catalysts for the upside, especially here, especially given the fact this stock has been by far one of the weakest performing stocks, certainly in the indices out there. So I think Boeing, maybe the worst is about over for it, but I don't think, the best is yet to come for a while yet. May take certainly a few quarters for the stock to really start to get back to where it was.
All right. Okay. I like the trade. Thank you, Tim. Appreciate that.
You bet, anytime. Take care.
All right. Tim Bigham, option strategist at Buy Alerts. Look at the call calendar and Boeing, giving it some time to firm up after earnings. Let's talk volatility when we come back. VIX pretty close to 20 again as we continue to see equities chop around, keeping volatility bid. So we are getting closer and closer to that election. Some of the odds markets seem to have skewed, but vol is pretty well pinned, just at 19 this morning. Looking at the NASDAQ, trying to flip positive. Nvidia's green. Mag 7 firming up. Microsoft now 2% higher. Bitcoin catches a little bid. We might be able to go risk on this morning after all. We'll give it some time.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
VIX back near 20 this morning with just a few weeks away until the election. Some have argued vol is a bid because of that, but we also saw rates markets get a little volatile again with yields rising. Joining us to put it together and talk volatility is Henry Schwartz, Vice President and Head of Client Engagement for Data and Access Solutions at Siebel Global Markets. Welcome back, Henry. Good morning.
How's it going, Oliver?
Pretty good. So let's talk first at the top level here. VIX, vol, pretty sticky around this 20. Doesn't seem like it wants to give. Why is that, you think?
Well, actually, we just had the SIBO Risk Management Conference last week, which was a lot of quants and traders talking about volatility and kind of how to make sense of things and how to position into the election. That was by far the primary topic. And what you're seeing right now, VIX is very sticky around 20, but what's really interesting is the realized volatility is nothing near that. In fact, we're realizing basically 9 or 10 volatility, meaning that people selling options kind of in the short term are doing well. And that's called volatility risk premium harvesting. But if you look at the term structure of VIX, there's a very significant hump, right, which has been around it's actually been around for most of the year, and that reflects the perception of greater risk as we get into the election. And then what a lot of the discussion centered around at RMC was kind of how long we might see some elevated volatility after the election.
Okay. You've got a good chart that looks at that term structure of at the money implied vol. Here it is. Black line up top is as of October 7th. Then the green and teal lines, the 14th and 21st. So we'll update it as of yesterday. You've got the strikes on the bottom there, so that you can see that hump around the first week in November, that election cycle. The fact that vol's come down a little bit overall since October 7th, has that made the hump more interesting because it's now kind of a bigger percentage bounce?
Well, as people are paying attention to the polls, and we had a great political scientist at the conference as well, talking about kind of the issues with polling, and the reality is this election is a toss-up, right? There are polls that say that Trump's ahead, and there's others that say that Harris is ahead, but the margin of error is significant, and so we really won't know. And what everybody's kind of looking at is some fear about kind of things getting volatile right after the election, and really how long things might drag out. And so this has been very persistent. We've seen kind of some increases and some decreases, but really if we're going into the election with a 50-50 toss-up, it's going to kind of stay there, and it's going to kind of be at the maximum level of kind of additional volatility, again, just for a few weeks, and then kind of things seem to get normal.
Okay. That's pretty fun look to see the way, compared to a couple weeks ago, it's maybe come down a bit, but still it's very clear that there's an event catalyst there. I wonder how you think about some of the other forces at play. I mean, the whole regime of vol still kind of elevated. You got that hump for November, but it seems even if we assign that some of the credit for vol, we gotta have something else too, because at the moment, right, we're still pretty elevated across the curve.
Well, there's definitely kind of a lot of fear out there. We have geopolitical unrest that's been around for a long time, and unfortunately, it almost feels like kind of things are normalizing, and everybody's just used to that. But it's also, I think there's a lot of games going on in terms of people trying to kind of decide, what are they going to do if one side wins versus the other side? What sectors are going to see outperformance? I do think we're going to see some pretty rapid kind of sector rotation, depending on who ends up in the White House and kind of what happens in Washington.
Okay. The potential for rates to disturb the peace, is that something you're thinking about at all yet, or is it too early to bring that back into the foray?
I mean, my colleague Mandy Zhu and Ed Tom have both talked about the factors that are really kind of coming into volatility, and VIX specifically are the Fed and the global unrest and the election. So you really do have kind of a confluence of factors. But it's important to look at, there's more than one VIX. The classic VIX is a 30-day measure, but there's a one-day VIX, which is very, very popular for people that are active in the zero-day complex. And that's what's interesting is the short-dated vol is really not that high. This chart is showing exactly that. So you have the traditional VIX, which has really been elevated, but you actually can see in that green line, which is the one-day VIX, and this is just kind of the morning level of that. The price for an at-the-money straddle in SPX is kind of on the low end of things, and so that's kind of equilibrium. What's not quite in equilibrium right now is the 30-day VIX, and it's really because the participants are kind of waiting. I think there's a lot of money on the sidelines. I think there's a lot of people trying to figure out tactically what they might do depending on how things go. But there was a great comment at RMC, which was we've seen Trump get in the White House and we've seen the market do well, and then we saw Biden get in the White House and the market actually also did well. So I'm not kind of in a much of a panic mode. Obviously valuations are pretty high historically, but we kind of have these tailwinds of falling rates, which you can't argue with.
Yeah. Okay. All right. I like that. Henry, thinking about the other trends that you watched that we've talked about, wanted to get an update on the kind of trading behavior. Looks like volumes for options still very high, and it's I would guess kind of some of the elevated volatility adds to that. So it seems like we generally have quite a bit of participation in the market still. Take me through this, which is looking at the total combined daily volume of options in the purple line there, but also on the bottom x-axis, you've got ETF options, single stock. Seems like single stock options are still pretty huge.
Yeah, single stock. I mean, we're seeing levels that are actually kind of similar to what we saw in 2021. The kind of the height of the meme stock craze. This is a kind of a directly due to the fact that we had a really strong market year, right? With the S&P up 22%, that really keeps retail traders, who really do kind of gravitate towards the single stock options, very, very active. And then on the index side, we're seeing growth there. That's that 0-day option trading trend by retail, but also by institutional and kind of semi-professional traders continues very strong. And then the ETF volume is probably where we're seeing actually kind of the least growth, but it's up about 1%. Overall, the market's looking at growth of around 7.5%. We'll hit 12 billion contracts this year, and retail remains a huge factor in that. I mean, that just kind of continues really strong, basically, as the retail brokerage community innovates and just reduces friction and makes it easier for customers to interact with the market.
Okay. Yeah, it seems like there's still a lot of activity going on, so healthy, and mostly the tech-oriented stuff still getting the most option activity. NASDAQ, Qs, the playground for the 0-day options traders.
Well, yeah, I mean, the 0-day, daily options is really what they are. It's just that most of the activity happens on the final day, so we call it 0-day option trading. But, those are available in the big products, right? SPX and SPY, NDX and Qs. And actually in NDX and Qs, it tends to be about 60% of the option volume is in the 0-day contracts. In SPY and SPX, it tends to be about half of the activity. And what's interesting, and we saw this on August 5th, right, when we had, when Tokyo was down 12% and there was a little bit of panic out there, the 0-day option traders basically stayed home. They didn't actually trade very much on that August 5th and 6th day, because what's really interesting about the 0-day flow is they're not in the trade until they decide, today I'm going to make a trade. And so, it's really interesting. I mean, they just sit some of these days out. I personally know many that sit out Fed days, just because, if there's a day you're going to see, a potential for a really violent move, they just don't make the trade.
Yeah, okay, understood. Henry, always a great perspective. Love the stats, love the snapshot look at what people are doing, and like the analysis too on why maybe VIX is doing what it's doing. Good stuff.
Thanks, Oliver. Great to see you.
Likewise. Henry Schwartz, SIBO, Global Markets. Good look there at volatility and some of the explanations for the VIX curve too. Still pricing in some election vol coming up. Charts on earnings. Seagate and Texas Instruments coming out this afternoon. So a nice little dosage of tech. We'll also take a look at Coca-Cola coming out tomorrow for a consumer staple.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. let's talk some charts. Let's get ready for some earnings with Ducat J. Horn. Joining me as we've got two tech names this afternoon, Seagate and Texas Instruments. Seagate's actually had a pretty good year, Jenny, for a kind of legacy memory play that had been otherwise sort of omitted from the growth conversation. What's going on?
It has had a pretty good year, but I will say it's the only name of our group and of most of the names we talk about in tech, frankly, that's still several years away from all-time highs. I mean, I know it's only about 5% off of those highs, but if you look at a 3-year weekly chart, I mean, we've gone pretty much nowhere over the last 3 years. So even though it hasn't felt that way, I think that context historically will tell you that. But as far as now their earnings report is concerned, we're expecting about 45% growth actually as far as top line is concerned. Also, earnings have been revised upwards by about 2% over the last 60 days or so to $1.48 a share. They're now focused on this heat-assisted magnetic recording products, which could last much longer than their conventional discs. So overall, shipping hard disks of around 30 terabytes with this new HAMR technology. And demand is expected to only pick up for that segment of their business. They're well positioned to benefit from the ongoing demand and this memory and storage component of the AI trade, as well as data processing. But the company also stands to benefit from the mass capacity drives, given the rising need for enterprises to capture just more data. So they've also seen, I think encouragingly so, profitability improve as of late. Operating margin fell from 14% back in 2021 to around 1% in 2023, but recovered to about 6% in this past fiscal 2024 here. And that is a sign that we like to see, that they're not only improving their margins, but accelerating it while doing so. So Street likes this name. There's 13 buys, 11 holds, 2 underperforms, no sells. Average price target right now is around 117, so that would get us right about back to our old all-time high. But again, we haven't been able to trade above levels seen 3 years ago, which I think is what is frustrating about this story.
Okay. Yeah, that's a good take, I think, because it's certainly one that's going to be in the same kind of vein as the data center build-outs and all these stacks that need to have different memory needs. But also, though, it fits into the potential for this kind of broader cyclical rebound and refresh. I mean, it looks like, Rick, it's a pretty solid trend.
Yeah, I mean, trending upward nicely for much of the year, up about 74% from our low point that was almost a year ago here. And, you know, we did have a little bit of a downside excursion here and here from our blue trend line, but held up pretty nicely. Never even really got close to our purple 252-day EMA there. So now we can see that we are above our moving averages. Recently, the yellow 21-day EMA was supportive. It also gave us the basis for creating this white dashed line, our upward sloping trend line, beginning from this low point in August. Now, however, we can see that we have struggled to make our way above this red line. 113.57 was the old high that we had back in July, and we did manage to make some intraday highs beyond it, and a new closing high as well just a few days ago here. But, you know, not really making any big gains that are lasting beyond that resistance point here. So RSI, kind of a triangular shape momentum, making a series of somewhat lower highs over and over again here, but you know, prices continue to rise here. You can really get burned trying to make a play on divergences like that when you got nothing else backing it up. It's kind of when it just exists in a vacuum by itself, not maybe the greatest idea to base serious trading decisions on it. So nonetheless, we are trending upward now. We're above the 50 midline. We're hanging out above our green trend line here. If we were to break to the downside more, yellow 21-day EMA matches up with our recent low and our trend line right around 109.26. Beyond that, old highs, subsequent lows, orange 63-day EMA, all converging together, 105 approximately. If we were to move to the upside, +1 standard deviation channel gives us a potential resistance area, 120.73 at this current time.
All right, a few areas of support there. It seems for Seagate, if it doesn't go perfectly, it should have some pretty adequate technical support at those lines you've got in the high volume area too. So it should be challenging for this to get below like 104, 105. You would think that that would be kind of the first stop by the dip, but also, you know, it's right in the middle of this kind of channel. So it could be a fun trade in either direction at this point.
One of these other industries, it's just hard to see people needing less memory in the future. You know, it just seems so obvious, like, but you know, every company's different, blah, 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 whatever, but just the broader theme, you know.
Absolutely, no, I'm with you. And I think that's why the chart generally looks so stable. Texas Instruments, very different, much more analog and industrial focused, but I mean, chart's not terrible. What's going on with the story here, Jim?
No, the chart isn't terrible, and actually relative to some of its peers in analog, it actually looks pretty strong. I mean, I was looking at like on NXPI, looks really better than those names, I will say, but any recovery in analog is expected to be pretty uneven. Last quarter, there was the tone from management that we could see there's light at the end of the tunnel. But again, the unevenness, I think, is attributed to the overall softness in seasonal demand for automotive and EVs, as well as a softer outlook in the broader industrial market with no real recovery timeline in sight and a domestic analog scenario in which competition is continuing to increase from some of these global companies. So other concerns do just include the overall supply overwhelming now demand in silicon carbide markets amid this weak EV demand. So as such, I saw nothing but more cautious analyst tones as we went into this report. Again, I was looking at a note out of Mizuho where they actually reduced their December quarter estimates for not just Texas Instruments, but also NXPI, Microchip Technology, onsemi, and Allegro Microsystems. The overall street is still expecting, I mean, some modest improvement as far as like its top and bottom line are concerned on an annual basis, but this Mizuho note did mention they like that they believe the analog and industrial lead times continue declining and inventories remain fairly elevated with customers not seeing any real mass demand. So for that reason, they don't see an imminent recovery, which will be an interesting story. I mean, obviously, we'll at least get some context when Texas Instruments reports, but unfortunately for them, they somewhat have the hard job of going first of like most of these semiconductor names. And it trades actually slightly below the forward multiple of the semiconductor industry at around 35.3 times. But that's expensive for a company that has not seen consistent growth in several quarters.
Definitely one of the more lackluster names when it comes to growth for sure. So that's where the underperformance comes from, about 10 percentage points to the S&P so far this year. Directionally, though, Rick, I mean, is it a terrible situation?
It is moderating a little bit from the gains that we've seen earlier in the year. Once again, the low came in about a year ago, like a little less than that, but up about 39% from that point here. And we did break above the old high point that was established here, right around 211 or so. Poked our heads above that here, but only really for a couple days here. And we did manage to make a significantly higher closing price at 214.66. But a rapid breakdown and really not much success at making our way above that resistance threshold at this point. Now we can see downward sloping trend line going across the high, competing with another upward, longer term sloping trend line going across the low that we saw shortly before earnings in April there. And we can see now, though, a little bit of a breakdown here. We are breaking below our previous lows. We're breaking below our trend line. Our green line, there's the previous lows, 194.67 here. And we are, recovering a little bit from the open here, but still down, a good bit from yesterday here. So RSI, once again, a situation of just trending lower and lower and lower. Once again, below the 50 midline, red trend line still in play. More of a bearish outlook now. Two shorter term moving averages, yellow 21-day, orange 63-day trending down. This was a critical point right here where there's two moving averages lining upward on top of our volume profile point of control. So that could be a key area for traders to keep an eye out for. If we do keep moving lower, purple 250 2-day EMA near 187. Next low spot, our light green line, 180.
Okay. So at this point, if it gets kind of squeezed into this $200 level, you expect it to kind of pop out at some point. Obviously, the negative momentum on RSI kind of seems like the bias would be for it to slip out, which it sort of already is, but not like a full break. This little guy here.
Actually, the momentum kind of surprised me a little bit. Often momentum kind of just moderates as you head into an earnings event here, but this is kind of a more acceleration to the downside. It's actually kind of a little stronger than I would have expected. I kind of would have thought it would just bounce around the 50 midline for a little bit, but breaking to the downside below an important price threshold.
Yeah, all right, kind of slipping out ahead of the earnings, so maybe a difficult one for Texas Instruments here, which has kind of been the story for the last year and a half or so. All right, last one in the staple category. Coke, pretty solid. I mean, decent move on the year.
Back in time. Look at there.
Okay trend. Definitely a little different than Pepsi, where the market has been really kind of doubting. It seems like Coke's pretty solid, Johnny.
It is pretty solid, but I will say that there's now this concern because of Pepsi's guidance last week that we could see some of this same weakness in Coca-Cola. Pepsi did actually lower its full-year organic sales outlook, which it said was a cumulative result of the overall inflationary pressures that continue to impact budgets and spending patterns. And some of the analysts I was seeing did say that this could impact Coca-Cola's results, particularly in their international markets like China, Mexico, and the Middle East. However, we are expecting some contraction as far as revenue by about 2.5% annually. Earnings expected to rise modestly to 74 cents a share, but we're seeing various segments of their business do quite well, which is offsetting some of the declining volume we're seeing in other businesses. So, like, for example, a quarter ago, their unit case volume rose 2%, driven by a nice 2% volume rise in their overall trademark Coca-Cola and 6% growth in their Coca-Cola Zero Sugar. Well, sparkling soft drinks improved 3%. Sports drinks also rose 3%. Coffee, though, slid by about 4%, and water sales dropped by 1%. So it's been a bit of a mixed picture, and they've been saying they've been trying to trim down their brands, focus on those that are most lucrative and profitable to the company, which I think that you have to do so when you're such a wide-scaling beverage giant like Coca-Cola is. You have to make sure that you're still catering, of course, to the consumer's preferences. So Street is still projecting organic growth of around 6.7% in terms of their Coca-Cola brand, 4% growth in North America, and around 8.3% growth internationally. This is an international company as much as it is domestic, and so I think it gives a good read on the consumer and some of these trends we are seeing overseas, whereas I just tend to think of Pepsi more being like a North American snack giant. Coca-Cola to me is like the most global beverage giant that really we can talk about.
Yeah, this has been pretty reliable trade compared to, I think Pepsi in particular, but also just kind of the notion that there were all these competing products and energy drinks and such, and they've made through it all right. I mean, look, we'll get 18% on the year. It's pretty darn good for a staple.
Yeah, same theme again. The 52-week lows came almost a year ago. We're up about 25% from that point here. A period of sideways movement, pronounced sideways movement for quite a while here, centered around our volume profile point of control, then a bit of a jump to the upside, another period of consolidation, formed another volume node, then a steep rally. You can see that we, kind of reached this point here at 52-week highs, around 73.53 here, but things kind of trailed off after that. Downward sloping channel now between our two white dashed lines. A couple more volume nodes have formed, though. These are key areas to watch. We came pretty close to one today here. Now that we touched on this green line here that represents some lows here. Now we are struggling to retake our orange 63-day exponential moving average at 69.38. So between like 69 to 69.40, a supportive area. Beyond that, to the downside, another set of lows came in at 67.80. We can see RSI, bearish lean here, downward sloping trend line was invalidated, but also a failure to break above that 50 midline. So momentum remaining in the hands of the bears for now as we head into this earnings event here. If we do move
earnings
to the upside,
event,
21-day EMA, then we had a gap down. This was this red line was the high point after the gap, right around 71.43. So a couple areas to watch.
So a decent chart, but one that has taken a little bit of a turn for the worst in the last month.
Yeah, definitely. A lot of a slide from those high points that we saw down.
The IRS unveils a higher capital gains tax bracket for 2025.
Sure. Okay. All right. Jenny for the analysis. Helpful guys. Setting up for earnings tonight in the case of tech.
Yeah, let them spin.
Seagate, Texas Instruments. Tomorrow, Coke. And markets pretty much the same spot. The only development is a little more selling in bonds. That's about it, though. Not a whole lot of action. NVIDIA tried to rally, but it faded, so we'll take you through some of the boring session next.
accelerate your market knowledge,
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Morning Trade Live. Stocks having a little trouble getting started today.
Bounce straight up off of it.
Faded, but a few of the other Mag 7 trades are working. Caroline Woods back with us from New York, a senior markets correspondent. Dan Grant, senior specialist of retail trading, here in studio with me in Chicago. Caroline, we tried NVIDIA, it didn't quite work, but at least we got Microsoft in the right direction, up a couple percent. Amazon, Alphabet, so a few things that seem to be helping the NASDAQ stay within arm's reach.
Yes, Meta higher as well, although the overall tech sector is lower today. We are seeing some strength in staples and energy, but that's being offset by some pretty significant weakness in industrials and materials as well. And, you know, we talked about this a bit this morning, just there are a lot of earnings highlights today, a lot of beats and raises, and not necessarily seeing that reflected in share prices, though we have quite a few losers after earnings. Could be because shares had run up so much, but if you take a look, 3M was a beat and raise, they're moving lower. GE Aerospace, one of the worst performers on the S&P 500 today, that was a better than expected earnings report. Keep in mind, shares were up almost 80% year to date heading into that report. Pulte Group, top and bottom line beat, lower right now. Lockheed Martin, better than expected earnings. Sales did fall a little bit short. Raised their full year outlook though, still lower. RTX, we talked about that one as a winner this morning. That actually turns lower after a better than expected report as well.
Ouch.
There are a few misses though. Verizon was a miss, and that's seeing some notable weakness today, down about 4%. And then Genuine Parts, the worst performer on the S&P 500. That's a distributor of auto and industrial replacement parts. That shares are just getting clobbered right now, down about 18%. They actually slashed their outlook primarily due to continued weakness in market conditions in Europe and their industrial businesses. So seeing that one get absolutely hammered. So I guess that's if you actually miss, that's the price you pay. But we do have a few earnings winners still. General Motors, the best performer on the S&P 500, huge beat and raise quarter. Norfolk Southern, an earnings beat, also higher, and then we talked about SAP. So there are some winners, but just given the amount of beat and raises that we talked about this morning, not necessarily seeing that in terms of winners today.
Yeah. Ouch in terms of a few of those drops, particularly the fade in RTX. That's a pretty big, ugly candle there then on that stock. So thanks for the update there. Volatility, Dan, we've been talking pretty sticky around the 1920. Bonds, it seems like, too, can't really hold much of a bid right now.
No, and there's a lot of new shorts pressing into the market yesterday. We saw open interest in 2-year notes and ultra bonds, the 30-year bond contract. A lot of new shorts there, pressing the market, anticipating at least a quarter basis point hike coming in 2 weeks from now, and then next week. Cut, excuse me. Sorry, I get that backwards.
You sure did.
Up, right? It's down, but
you're fired.
Coming for about 2 weeks.
Okay.
Unemployment next week on a Friday, so that's coming in. That's gonna be interesting.
We need some fresh data.
Yeah.
The Richmond Fed, I was kind of like ignoring this morning, but I do wonder if maybe the beat there that came in somewhat surprisingly positive just kind of was a fresh piece of better than expected information, even though it's a small one or tertiary perhaps. But it's just the 10-year seems like it wants to rise in yield right now. We can't keep it down.
No, and it's more of the normalization of the curve. I think that's the most important thing. We're going to steepen back out. Does that mean we're going to have a recession coming in, that's usually the case, right? The 2s, 10s is back to being normal, and then the 3-month to 10-year note is still well inverted, but showing some upward pressure coming back.
Well, the 2s are repricing in such a hurry too that the curve's getting pinched a little bit right now.
Yeah, and you got to watch that.
It is.
Yeah, it's the 395. I think I saw the 2-year this morning, maybe a little lower. I'm not sure there. So
yeah. Fed speakers maybe turn out to be relevant this week, Caroline. So we might not be, able to ignore that calendar, which does include sentiment on Friday, durable goods, and then we've got some bond announcements tomorrow too. Not a lot of big auctions, but it seems like we have to kind of balance our earnings analysis with some of the macro, with a few Fed members left this week, and a couple good data points.
Yeah, especially given the commentary that we've been
Seems
hearing
like
from
you'd
the
be
likes
getting
of
more out of these.
Kashkari and such in terms of a very gradual approach to interest rates, possibly contributing to that tick higher in the 10-year yield that we're seeing, just the fear that the Fed's going to cut even slower than
5840s are
expected. And obviously,
720.
economic data has been strong as well. We'll also get data on existing home sales and new home sales, I believe, and keep in mind we're seeing rates tick higher. We actually heard that from the Pulte Home CEO talking about that on the earnings call, saying they started Q3 with buyers less inclined to sign purchase agreements, and then as rates ticked lower in August and September, they saw a noticeable pickup in overall activity. However, now with rates ticking higher again, that could influence the housing market once again psychologically. So, it probably wouldn't be reflected in the housing data that we are getting, but it will be interesting to note as well.
Okay. Yeah, I'm with you. Housing going to be important. The home builders kind of struggling a little bit here. Appreciate it, guys. Thanks, Caroline Woods. Thanks, Dan Grant. Appreciate the look there at some of the stock moves in the bond market as well. Thank you for joining. Trading 360 with Nicole Petalides is coming up next. I'll see you this afternoon at 2 p.m. for Market on Close Central Time. Don't miss it. This election season, stay out of the muck and the mudslinging. Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
I'll try to understand that a little later.
It is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
No, I have not.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's no
where else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market.
He's a funny guy.
Market Overtime on the Schwab Network. Thanks for tuning in.
We'll pop here on ACB and Hillary and CGC.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. So glad you are with us. Coming up on today's show, our 360 Spotlight will dive into all the earnings, especially looking at GM. That stock rallying in reaction to its highest level since January of 2022. Our disruptor for Solar City, upgrading that stock to a buy rating. Our 360 round will break down the earnings from Verizon. Right now, stocks are under pressure again. This is the 10-year had crossed 4.2%. So after 6 weeks of gains, taking a little breather off of the recent high closes that we see, record closes for the S&P and Dow. But right now, a couple of days of selling. The S&P's at 58.38, down 0.25%. The Nasdaq's down 0.1%. The Dow's at 42,824, down 107 points. And the Russell losing 0.33%. Oil and gold right now. Oil's up $1.32, sitting at 71.85. 27.56 there on gold. That's also gaining. We've been watching new highs on gold. It's up $17, 18.87 on the VIX. The dollar's strong, sitting at 103.85. And Bitcoin pulls back slightly, 67,680. So we have a lot of earnings to discuss. We'll start it off here looking at GE. So Jenny Horn is with us, markets correspondent here on the Schwab Network, looking at the shares of GE falling after the company's earnings report. Could you take us through the numbers? Good morning, Jenny.
Well, that was a blooper.
All right, we'll get back to
That was a blooper.
the GE numbers later. In the meantime, we want to get a big picture on what's going on in the market. Joining me right now, Michael Ranking, Senior Market Strategist here at the New York Stock Exchange. Thank you for being with us.
Morning, thanks for having me back.
You know, we were just talking about GE, but you know, the truth is last week we saw 50 of the S&P 500 companies had reported as of the weekend, and it was about 75 that had been beating the earnings per share. We still have a lot to go.
Yeah.
Some of your thoughts on earnings season so far?
Yeah, so I mean, as is always the case, right, the beginning of earnings season is really dominated by the financials, and we saw really strong results coming out of that sector. In terms of kind of the commentary around kind of business and consumer, the commentary coming from those companies was also pretty positive. And now we're kind of heading into kind of the peak of earnings season. Over the next 2 weeks, we have, this week we have about, 20%.
The crowd's going wild here at Sports Arena.
This week reporting. And we're starting to really shift away from financials and hearing from more industrial companies, as you sort of mentioned. The response today has been, more, definitely leaned to the negative side of things. Kind of broadly speaking, you have some standouts in either direction. But overall, I'd say the numbers have been pretty solid. Even some of the stocks that are trading lower.
Yeah.
It's not that the numbers were necessarily that bad. It was just you've had equity markets and stocks moving higher for such an extended period of time that you're seeing a little bit of money come off.
Yeah, I mean, GE after its earnings down 8.5% today, but to your point, we had a lot of the financials in the beginning as we kicked it off. Financials have been doing very well, and so you saw a lot of earnings beats. We're waiting on Tesla and a lot of the Mag 7 names here throughout the next 10 days, let's say. So it's going to be very busy. Are you feeling more optimistic or sort of range bound? I mean, because we just hit some new highs. I mean, the S&P and Dow just hit highs. How likely are we to hit highs again?
Yeah, so over the last month, I've really kind of talked about the idea of the pain trade being to the upside, as everybody had kind of gotten to this point where they had suggested there would be volatility heading into the election, and you'd seen some kind of money coming out of markets. I was wondering if we would see kind of a turning point post options expiration. We didn't really get that kind of blow off move to the upside, so it feels like we're kind of in a consolidation phase at this point. Given what we've seen throughout the year, a lot of the gains have been driven by kind of multiple expansion, and we really need to see the earnings side of the equation, kind of live up to expectations to really drive things further here.
And the Fed and the election.
Yes, yeah.
That's right.
A few,
there's. So look, we saw some. We've seen a little bit of weakness over the last couple of days. That's coming in response to a move higher in Treasury yields. Right, so you've seen kind of the 10-year yield go from 4.25 down to 3.6, kind of on the day of the Fed's rate decision, and now we've kind of completely round tripped that move. That started to kind of concern markets a little bit. Look, there's been a trifecta of kind of catalysts that have driven
it's
that.
10 o'clock, 11
The
o'clock.
markets kind of applauded the Fed's initial kind of aggressive response, right,
Oh, my
suggesting that we could avert kind of this soft landing, or we could avert a hard landing and bind it to the soft landing narrative. We've then seen economic data come in better than expected. You've gotten all this stimuli coming out of China, so you're starting to see kind of some of those inflation expectations move a little bit higher, and now you're getting into this election, the potential election catalyst here, where you've seen betting markets start to shift in the way of Trump, right? And you're seeing a little bit of concern build in the market about potential higher interest rates if you have, you don't have a divided government.
Yeah, and look, concerns about tariffs and how that, could work. How, we had Steve Forbes on, who was concerned about taxes, and he was concerned about, prosperity, and if the Fed keeps messing with rates. There's a lot of different viewpoints on what's going on here. To your point, I think there are some people who think the market is frothy. Are we climbing the wall of worry now, right?
Yes.
When you think about the different sectors, any thoughts on specific sectors?
It's weird.
Right
Their
now?
timing's
We're
different
hearing
than
a lot from
mine.
Tech, NVIDIA has been hitting all-time highs again.
Yeah, and
I'm
so,
not complaining. I'm just saying.
Yeah,
I'm not sure
interestingly enough,
expected
right?
that.
One of the things that
Right.
I had kind of talked about was that the NYSE FANG index, FANG Plus index,
Yes.
which is your Mag 7 plus, AMD, Salesforce, and Snowflake, had just started to break above some August highs. We're not back at July highs. And if you would actually, depending on the makeup of that move, if you just move back to those, kind of previous highs, that'd be a couple hundred points to the S&P 500, right? We're seeing those companies start to outperform again in this recent pullback. It's like this, kind of the Back to the Future kind of defensive qualities that some of these companies have, because we're seeing companies that have been that have the most are most exposed to kind of the interest rate environment, small and mid cap names, underperforming. Energy is sort of an interesting play for me at this point, right? If you believe in kind of the China turnaround, if you believe that the economy is going to kind of work its way through, right? Energy stocks have traded sideways for 2 years now, right? So, and they're actually, if you look at the XLE, 3% dividend yield, and they're buying back a lot of stocks. So, kind of an underloved group, a little bit non-consensus, kind of interesting.
How about
setup.
this? How about two hot topics? AI revolution, I would say, would be one hot topic, and the U.S. dollar is the other.
Oh, that's a good one.
Will it always be the reserve currency? How strong does it need to be? Do you have a thought on each of those?
It's good.
So
Good.
Yeah.
Yeah.
In terms of AI, right, I think this is going to be an interesting part of earnings season to see how markets react to kind of the continued CapEx spending that we're going to continue to hear from kind of the mega cap tech stocks. That's going to be very, very key. We've seen within markets this massive move towards nuclear and kind of the talk about modular reactors. It's kind of interesting. That's still kind of a technology that's a little bit out there. You've seen some of that get pretty frothy. In terms of the U.S. dollar, it's not real. My focal point is more kind of equity markets. I think it's. We've heard these claims that the dollar is the reserve currency. Is the end of the dollar is the reserve currency for years and years and years.
Right. But that's not happening.
It hasn't happened. Right.
Okay. How about this? How about the Bitcoin ETFs that are trading here at the New York Stock Exchange? some thoughts on the popularity there. I mean, I know that it was extremely popular in the beginning of the year because there was a lot of anticipation. Thoughts on how those are doing?
Yeah, I mean,
overall?
look, I mean, you've
and
continued.
Bitcoin
Yeah.
is still holding up. It's near 70,000.
Yes.
Right?
Yeah. So you've seen a lot of money continue to move into those products, right? It's been a
Yeah.
successful launch for a lot of those products. We've recently seen the crypto complex starting to move higher again. Once again, that shifts back to the idea that you're starting to see betting markets shifting towards Trump. So markets are kind of viewing that as kind of a Trump trade. Bitcoin, we had talked about it kind of technically last week. It had briefly broken below its 200-day moving average. It quickly reclaimed that. Technically, like the setup here is very positive when you look at this from a longer term perspective.
And finally, just last question: the S&P right now, which is sitting at 58.38. Your thoughts on the range here, or what happens short term, long term?
Yeah. So I mean, it's a little tricky heading into the election, obviously.
Maybe volatility.
Yeah, that's the consensus belief that there is going to be some volatility. We haven't really seen it yet. The idea that we're going to see that volatility. I think the biggest risk right now from a market perspective is if you get the wave, if you get a red wave or a blue wave for that matter, right, where you'll have to watch treasury markets and see how markets respond, kind of given the fiscal deficits. From a technical perspective, the action's been pretty positive. I kind of talked about this inverse head and shoulders pattern, which we broke above, looking at a 6,100 target for the S&P 500, kind of in the medium term.
In medium term.
Yeah, in kind of the medium term.
Right. So 6 to 12 months or something like that.
We've gotten halfway there though, very quickly.
Goldman Sachs has been a little more cautious on its call, on its outlook recently. Okay, Michael Rankin, great to see you, Senior Market Strategist here at the New York Stock Exchange. We're always glad to have Michael on with us. Thank you.
Thanks for having me.
Good to see you, Michael. Plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us into technicals. Dan Deming takes us through the trades for Cintas, Synchrony Financial, GE Vernova. Next, Trading 360, Schwab Network. We will be right back.
The hell?
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Oh yeah,
Welcome back to Trading Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Time for the big three. Who's ready? Stocks, charts, trades. 3 of them for each one. Rick Ducat will take us through the charts. Here to take us through the trades, Dan Deming, managing partner at KKM Financial. Great to see you both this morning. Dan Deming, good morning to you.
Good morning.
I wanted to ask you, before we get to Cintas, just a quick thought on this market action that we are seeing.
Well, I think you're seeing a reaction to the rate environment, Nicole. Really, that seems to be the
Oh,
driving
come on,
factor.
man. Election jitters.
Post-expiration of some repositioning there. But overall, I think it's also the reevaluation of the interest rate environment and the potential impact on the markets moving forward. So I think that's really what's causing the hesitation here. But overall, I think when you look at earnings so far, they look pretty good. We'll get a big chunk here the next couple of weeks that will definitely dictate, I think, the price action in the market moving forward.
Very wrong.
Okay, let's get to Cintas. This is the first name you're going to be trading for us today. Why did it pop up on your radar in the first place?
Yeah.
Well, it's a stock that we've had in some of our portfolios over the last couple of years based on valuation metrics. I mean, it's getting pretty expensive now, but overall, just the general trends in this area, and particularly this stock relative to the S&P.
CTAS. Cintas.
Juggernaut, Nicole, and so that's one of the primary reasons. Also, just featuring it as, in that service sector area that kind of, these 3 stocks that I picked today are under the radar stocks that I think really should deserve more discussion moving forward.
Well, let's talk about it, my friend.
A leader in that uniform/corporate identity area, and you look at the technicals on this
CTAS.
some of the other metrics from a fundamental standpoint, I think it's still in pretty good position, even though it's not as cheap as it was a year ago.
Okay.
Yeah, understood.
Understood.
Let's see what Rick has to say about the charts. Rick?
Yeah, Rick.
It's the beauty of a chart. I mean, it's very straightforward. It's just going straight up. I mean, we barely have to do anything here other than draw a channel along our lower boundaries, duplicate it, put it across the upper boundaries here. Matches up pretty well. Gave us a spot to look for potential resistance, which is indeed where we topped out.
220?
37, our 52-week
Are you suggesting?
So, we're above our moving averages. We're hanging on above our previous highs that we established from back here, our green line, right around 209 or so. We can also see that we're above our blue linear regression line here, our line of best fit based on closing prices. Downward trend in momentum, our RSI has been broken. You can see the RSI has moved above our red downward sloping line, managed to hang
look at here.
line above the 50 midline. Momentum more geared towards the bulls. For
the
how
5850s.
Consistent the direction is, I was a little surprised to see how clear the volume nodes were as well. You can see very obvious spikes on the volume node here. These are key price levels to keep an eye on if we do start to trend downward here. So the first support area that many traders likely would have their eye on would be right here, very close to current prices here. The old highs that we saw from August around that area, matching up with our blue linear regression line and our yellow 21-day exponential moving average, all around 209. Then the next set of lows, 202.25. To the upside, recent highs, 215.37. Then our channel, then plus 1 standard deviation channel. 1 standard deviation above our linear regression line comes in at 231. One area to keep in mind to the upside if things continue to improve.
Okay. Any thoughts on that, Dan?
Yeah.
Yeah, I mean, I think Rick pointed out everything that I was looking at as well. I mean, particularly just the sheer magnitude of the ascension in this that's in the chart. And, it hasn't broken its 50-day moving average in, I don't know, it's been almost 2 years, I think. So if you look at it from the fact that the momentum type of scenario, it's certainly firmly in the upward trending camp. So I'm looking at a short-dated call spread here as a trade example today, Nicole, capturing that general trend, defining some risk though, but still be able to that the market has really exhibited here the last year. That I do think that this 210, 220 call spread trade example today should be able to capture further upside. We're pretty much in the money here with the long call, and if we see us take out that 215 level the next month, I do see us going through 220 and possibly, as Rick pointed out, to 230.
Okay, yeah, I think he wanted a harder chart. This one was the ascension, staying along the 50. Let's see if the next one's tricky. Synchrony Financial, Dan.
Yeah, another name that doesn't get the recognition of the big banks because of its niche type of market, but it's been able to dominate that market over the last few years as it continues to roll out new products and co-partnering or co-labeling with big banks. And
what do you think about that, Jimbo?
Here has been very strong to the upside. And in theory, if we continue to see the rate environment normalize with the long end of the curve selling off more, and we're seeing a spread, that overall I'd say Synchrony is in a good position. Now, certainly debt is a hot topic as far as consumer debt, so that could be one pitfall for them. But longer term, I still think that this stock looks like it's in a good position to move further up on the charts.
Still seeing a left to right chart here moving higher, but some choppiness on this one, Rick. Some of your thoughts?
Yeah, that's a pretty good summary. Once again, an absolute powerhouse of a chart, up 102% from its 52-week lows that were about a year ago here. But you're right, a little bit more in terms of bigger swings, a little bit more volatility, but still a pretty consistent uptrend here. Once again, just drawing a channel, starting from all the way back here, going across the lows, did the same thing, just put it across these two high points to give us a potential boundary to look to in the future here. If we do keep moving to the upside, in the shorter term, blue trend line going up, starting from the same point I just circled here, where our white trend line touched once again here. You can see that we have been, trending upward nicely here, and a little bit of a give back. We've fallen off very slightly off of our highs that we reached recently, but that's not really crazy. I mean, look how big of a breakout we had once we cleared above the old highs. That's why we look for these key price levels, because the reaction can be quite energetic when it is indeed surpassed finally here. Momentum also improving. A more gradual slope on the RSI has transitioned into a steeper slope. We are above the 50 midline. We did back out a little bit out of that overbought area, but as we head into earnings, earnings has transpired here, it's not uncommon for momentum to
SYF
wane a little bit when you have one of these events on the horizon. We just had it here, so not really super surprising that momentum is drifting off a little bit here. If we do move to the upside more, the old highs, the trend line, and then our +1 channel, those would be the areas to watch. So 57 and then 59.50 or so to the upside. To the downside, another nice confluence here. Old highs, linear regression line, 21.
Don't look too good, sir.
All coming together near about 52.70 or so.
Yeah, and I'm looking at some of the price targets here. JMP, the highest of the bunch, has a market outperform rating with a $68 target. Barclays with a 59. You have Jefferies at 65. So you do have some with a higher target. Not off the charts.
850s were at 270 just a second ago.
$12 higher, Dan.
Yeah, absolutely, Nicole. And, as Rick pointed out, it has lost momentum here.
They could have been cheaper.
We've had some troughs, and to me, that creates some opportunity as well. So in the trade example today, I'm looking to capture further upside, but I'm also trying to finance some of the cost of a call spread by selling a put. If we do see us drift
270
lower,
again.
I could see us going down and testing that level of 47 over the next couple of months. So this is a little bit longer dated trade example today, Nicole. What I'm looking at is in January, buying the January 55-65 call spread, so buying that at the money call and then selling 65 call, and then selling.
You gonna put that on quiet? We're watching this trade right here. 265. Yeah, just timing. I don't think you want to fight with the trend too much, like I've been trying to do. Another pullback. GEV. About missed it. The 5850s are at 240. We're at the 63. 225. Ooh. Okay. Ooh, look at that knife. Just like yesterday. $205. These are 205. And they're at 240 right now. I can get out of them. 250. But this thing can shoot up real fast and be like a. There's 255. Jingle bells. Jim, thank you. That was very professional. Well, once I noticed that we hit the 63 EMA and we formed a hammer, I felt it into my heart to go ahead and grab these as fast as I could. Now, I had an issue going on. I had a cup of coffee in one hand and a mouse in the other. So I had to find out which one's more important, the coffee or the trade. It was a tough decision. So I sat there at the battlegrounds and figured out, okay, I'll take a little drink of this coffee first. That way I'll quench my thirst. And then I can go ahead and do the trade. So I don't know how you did that, Jim. Did you get your tax notice? We're going to be raising your capital gains up next year. Yes, we can't live anymore with this tax cut. It's not fair. Because people up here in Washington. Although we don't get taxed, we should. Now that's kind of interesting to know, Jim. Okay, SPX. What about resistance? We're now at 255. Was that the same trade? Oh. Well, I figured I'd get more than that. Okay, I got to make a business decision. Are we going to get another candle? Yes! And we did. And we sell it here. James, is that true you put a sell order in at 295? 290. Oh, that was a good move. Yes. Thank you very much. There it is, 290. Woo! Okay. I'm done. I'm ready to go to the beach. I hope nobody has a problem with that. Oh, that's not what I wanted to put up in there. I did a double fist. You did, didn't you, James? I almost did a triple one. How come it's not doing that right? That's how you do it. Randy. Where is Randy? Did he get his teeth done? Magnificent. Where's Randy? We're at $3 right now. I think I deserve a good grade out of that trade. At work you believe. Okay. He's forgiven. Yeah, I heard something about triple M's. Also heard something about these here SPX calls from 205 all the way to 290. Now they're at 320. James, this is Jack. You know, the big guy. And I'm raising up that 10% that we had been going kind of agreed upon. We're going to raise that tax up to 15, plus the other 25 you're going to have to pay too. So I should bring it up to an equal of about 40% tax bracket there here. Yeah, payback's a bitch, ain't it? Yeah, it is, sir. 58.50 resistance. Oh, not a resistance, but what time is it? 10:34. Oh my God. In the 4 hours of this. Woo! It's almost too much for me. Okay. Well, speaking of lunch, I haven't had it yet. Need to go to Jim's Steakhouse tonight. Yeah, I said it. Hmm.
He'll give us all the details and example trade next on Trading 360.
My mister.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
It's trying. Very nice.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. A look at developing stories this morning. We're taking with Caroline Wood, senior markets correspondent here, taking a look at 3M shares, which started off in the green after quarterly numbers hit new highs, but now since turned into the red. So a lot of action on the stock today. Some of your thoughts on the report and what people are saying, Caroline.
Yes, as you said, we did see those gains fade despite the fact that this was a beat on both the top and bottom line. The company also raised its full year outlook in terms of earnings. The Post-it Maker reported adjusted EPS of $1.98. That was 5 cents higher than analysts were looking for. Revenue rose slightly to $6.9 billion. $6.29 billion. The expectation was for $6.1 billion, so a beat there as well. In
Very
terms
interesting.
of the main segments, organic sales for safety and industrial were up almost 1%. Transportation and electronics were up 2% on an adjusted basis, and then consumer saw some weakness due to some weak demand in areas such as packaging and home and auto care. So sales there, organic sales fell about 0.7%. So 2 of the 3 main segments were higher. Comparable sales overall grew 1% year over year. It's the 3rd consecutive quarter of consecutive sales growth. In terms of the outlook, earnings per share guidance was raised to a range of $7.20 to $7.30 per share. That's up from a prior range of $7 to $7.30 per share. And then 3M projects full year organic sales growth of about 1%, so in line with its prior guidance. Shares down about 1.1% right now. Different story than it reported when it reported over the summer and beat on both top and bottom line. Shares absolutely surged, but I think that this could very well be a case of expectations being very high heading into this report, because if you take a look, shares are up about 46% year to date, 86% over the past 1 year. So they've already seen this really impressive run higher.
Yeah, pretty amazing. I saw the low was all the 52 weeks ago, $71, the high $141 today. Thank you for that, Caroline Woods. Good to see you. Now it's time for our disruptors. George Sillis is standing by, senior markets correspondent, taking a look at First Solar. Citi upgrading this stock to a buy rating ahead of the earnings that are due out next week. We see it up about 3% today, over $200. Some of your thoughts?
Well, first off, I mean, if you look at First Solar, it was trading around $300 going back to June, so it's down about 30% since then. And there's been a couple things going on with the solar industry. Obviously, Tesla is encroaching on this marketplace, so I think there's some competitive threats that are still being priced into First Solar stock.
I never thought about that.
There's been sort of a boom going on, Nicole, in the backdrop of a lot of stocks. That
Never thought about that one. That's a good one.
Power stations, and so I think that's also put some pressure from an investment standpoint on the solar industry. But I think First Solar may look compelling here, considering that this is a company that doesn't really focus primarily on the residential solar side of the solar equation. That's an area where there's a lot of weakness just because of the non-turnover in housing. A lot of folks are locked into cheap mortgages, and of course the inventory for houses is very low. There's not a lot of transactions in the housing market, but First Solar doesn't focus in that area. They're actually more utility-grade solar installation, in other words, large solar farms, and they actually have contracts that go all the way out through 2025. And one of the things about this particular name is, and I can see where Citigroup is coming from with their price target now to $254 from $200. They have a buy rating from neutral. they actually see the election is actually quite compelling for First Solar in both ways, both candidates. One, Democrats are typically more favorable for alternative energies than solar, so if we see a Harris win, that'll be a positive. And the second thing is, if the Trump administration comes into office, tariffs might actually be beneficial for First Solar to shore up prices and keep international competition at bay. So they actually see a boom for both of these based on both candidates as well. Now, they do have earnings coming out next week, so we have to consider the risks involved in the earnings announcement. But I did look at the earnings estimates for the remainder of this year, and if you look at them, they're about $13.45. But if you
That's a
fast
good
forward
benefit.
to next year, for 2025, they're expected to earn $22 plus per share. So it's only trading as a stock 9 times forward earnings with over 132% earnings growth. So based on valuation, there's also something compelling there as well.
All right. So, George, how would you go about an example trade today?
So one of the things I noticed is if you look at the stock, it seems to be holding the 200 period moving average. Unless it closes twice or 2 days below it, it may have actually just closed yesterday below it and actually may rebound back above it. So what I'm going to do in this case is place a trade. It's a little bit more speculative because we do have the earnings coming out next week, but also the election. So I'm going to go out to November and I'm going to put on a bull call spread. And the reason I'm putting on a spread is because if I outright buy options, they're very expensive all the way through to the November expiration contract. These are the monthlies now. So I'm essentially going to buy the 205 call, and then I'm going to sell the 215 call against it. So it's a $10 wide spread, and I'm going to buy that for about $5 a share or $500 a contract. So in essence, it's bullish trade. It's a 1-to-1 return on risk. So you're risking $1 to make $1, or in this case, $5 to make $5. Max profit is achieved if the stock hits 215 or higher by expiration. But at the very least, you know what your max loss is, which is $5 on the trade, and that only happens if the stock closes below the 205 area.
Okay. George Still, it's great to see you. Thank you for our disruptor every single day and a good look at First Solar. And when they talk about election plays, in this case, you made the case for both, you know, regardless of who wins the election. That's that's certainly a special one. Thank you so much. Good to see you, George. Coming up next, it's time for our 360 round. We're breaking down the earnings, the numbers from Verizon. Now, the shares are lower in reaction. Find out what our panel thinks next on Trading 360.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks.
Okay, we've had a pullback here.
It's time to look forward.
Find the next trend.
Not holding up very well. These aren't these resistances.
There's no fear of missing out on next gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Trading 360. It's time for our 360 round. We want to bring in our panel to talk all about Verizon. Jeff Kagan's with us, wireless and telecom industry analyst, columnist with RCR Wireless. Sandra Cho, founder, president, Point Wealth Capital Management. Sandra, I'll start with you. They're saying that it was healthy earnings. It was met with a shrug. What are your thoughts on what really came out of this quarter?
Hi, Nicole. Great to be here. Thanks for having me. Yeah, so, it was a mixed bag. They just slightly missed revenue, but their earnings per share came up slightly above expectation. And, they had some large one-time charges. So at the end of the day, they are building something up and they're investing heavily. It's going to cost them. And, but it looks good for the long-term
Might be another chance
run for Verizon and communications in general.
When we think about profit falling here, Jeff,
58.50s at 220.
Is the two big ones. T-Mobile came on pretty strong when it came to 5G, for example. What did you make of Verizon? And then I want to expand the conversation to the others in the pecking order a bit.
First of all, hello, Nicole. Verizon, it's a mixed bag. There parts of the story were good and parts of the story were not so good. But what we really need to do is understand what's happening in the industry. We need to pull the camera back and get a longer-term historical perspective of what's happening in the industry, because big things are happening. As I speak to wireless companies that are my clients, I'm getting a picture of a changing industry experiencing slow growth. This has happened before in this industry and it'll happen again. But this is both for carriers and for network builders. The wireless industry today is searching for that next holy grail of growth. Last time this happened was about 2 decades ago, about 17 years ago, when the iPhone and the Android first got into the marketplace. Wireless was slowing, but then they spent several years conditioning the marketplace to want to use the wireless data and the apps, and the app market exploded. BlackBerry back then they had a few hundred apps, but with the iPhone and the Android, it exploded to 2 million apps, and that growth was what the wireless industry is looking for again. The next question is, what's the next step for the industry? AT&T and Verizon took a wrong turn several years ago. They acquired AOL and Yahoo and Warner Media and all the rest. That was a big mistake. Today, they're searching for growth in wireless areas like FWA, wireless broadband, private wireless, and all these areas are great, but they don't move the needle as much as wireless data has done. And that's the big challenge for carriers and for network builders. This is not just a Verizon story. This includes Verizon and AT&T and T-Mobile and Qualcomm and Ericsson and Nokia and the entire industry. They'll find the next growth area, but they haven't done it yet.
Sandra, let's talk about, thank you for that, Jeff. Let's talk about some of the subscribers and growth prospects going forward. T-Mobile is the best performer as far as the stocks go. It's up 37% this year, AT&T 28%, and Verizon up 11%. The competitive landscape tells you what, Sandra?
So Verizon has 11.9 million subscribers, and that's up 16% year over year. As far as their competitors go, they've done a pretty good job. They've acquired Frontier. They're up in subscribers, and they're investing heavily in 5G fiber infrastructure. So they're really poising themselves for the long run. I mean, this is a marathon that they're doing, and they know the investment in 5G is going to be worth it. And we would say so too. So they've been more flexible with their plans, and they are looking for the next new. But I would say that their expansion into 5G and just really embracing it and investing in it should pay off in the long run. In the short term, it's going to be a little bit painful, but like all growth, periods, that should pay off, and it should come to fruition.
Yeah, and we think about, the dividend-paying side of this. Citigroup maintains a buy on T-Mobile. They have a $254 target. When you think, Jeff, about the next big thing and where this battle, you talked about how they went off the mark with some of the other sort of entertainment side of things. They seem to be back on. We'll add Comcast to this conversation. Final quick thought, Jeff.
That's a good point, and I agree with what Sandra was saying as well. These are strong companies. They're not going away. Wireless is one of the most important trends of the future. For growth and for investors, though, that's a challenge because wireless has not grown steadily over the course of over time. It's been around for 50 years, and it grows in steps. And as you hit the growth, the period of growth ends in one step, it takes a while for them to come up with the next step. They've always come up with the next step. They will come up with the next step again, and they're searching for it today. And that's just the story of wireless.
Yeah, and I'll give you the last word quickly, Sandra.
Thanks. So, it is important, like Jeff said, the strategic partnerships, it is a step process. And what we haven't spoken about yet is that though the market is saturated, where they're always looking for kind of like, getting revenue from people that are upgrading their cell phones, right? And that's when people tend to make changes with their plans and whatnot, these incentives. People are not upgrading their phones nearly as much. Inflation's been high, that's been a struggle, but we're gonna get through this time period, and when we do, there's gonna be more opportunity.
Great to see you both. Thank you so much. I look at Verizon and the whole telecom group. We really appreciate it. Jeff Kagan, Sandra Cho, great to see you both. Thank you for being here today. And thank you, friends, for being with me here on Trading 360. I'm Nicole Petalides. Download our free Schwab Network app. It's available in the Apple App Store. Tune in 247schwabnetwork.com. I'll see you at 2 o'clock for the watch list. Please join me then. Fast Market is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself, find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. And welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, and we'll have some earnings discussions, some market discussions. We'll take a look at some option strategies. First, we're going to cover Boeing, which is down nearly 40% so far this year, into their earnings tomorrow morning. And then Texas Instruments, which is off about 6% so far just this month, into their quarterly results. And like Folio breakdown consumer sentiment data in the buy now, pay later stock Affirm. That's pulled back about 11% so far this year. Traded choppy over the last couple of months. But now let's take a look at the major indices, which, as I mentioned, in the red. The S&P 500 down about 0.25%. Dow off about 78 points. NASDAQ 100 off about 0.2%. And lagging to the downside, Russell 2000 small caps down 0.4%. To help me break down this market action, let's bring in my co-host. That's Kevin Hinks. Kevin, we've got the 10-year yield at 4.2%, causing a little headway for equities, second down day in a row.
Well, I will tell you this. Today's market movement is another flesh wound, right? I thought yesterday's market movement was a flesh wound, but here's the problem, Tom. Eventually, flesh wounds start to add up.
Start to bleed heavier.
Exactly. So, yes, this is day 2 of a flesh wound. Nothing down more than the Russell down 0.7, the rest down between 1/4 and 3/10 on the two big. Not a serious down day, but another down day, and eventually these are going to start adding up.
But
yeah, we've got some of the Mag 7 names that are positive. Microsoft having a good day, up nearly 2%. Google, Alphabet, and Amazon and Meta. All positive. So not a complete red day across the board, but definitely some weakness, and I think it's caused by those yields. Let's expand this conversation, bring in our next guest. That's going to be Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nate, give me your take here on market action, because in my opinion, and what I've seen over the last couple months of trading is, hey, we're due for a pullback or at least some consolidation, right?
Yep.
Certainly. You won't see it on the RSIs, but it's just been this persistent kind of melt-up mode that we've been in. And then I think you're right that the higher yields are the culprit, but it's not necessarily that higher yields are bad, but it is about the velocity of the move. And the 10-year has moved 20 basis points in 5 days. And as you guys mentioned, it's breaking out a little bit into technical space, meaning it's at the highest level since July. It looks a little bit on the 10-year like an inverse head and shoulders over the past 3 months or so, if you look at the charts there. So, look, bulls are fine if yields are rising as long as the economy is strong. IMF upgraded their growth forecast. Atlanta Fed GDP is at 3.4%. But if yields are going to move swiftly to the upside, that's going to create a little bit of, potential for profit taking and some volatility. If you look at the Russell last week, I was really encouraged to see the Russell finally register a 2-year high close. Since then, it's kind of rolled back over because of the rise in the 10-year.
Yeah, and I think that's a good point to bring up, Kev. We've been talking about that because stocks go up, historically
but
when
not
yields
in a straight line.
Not in a straight line, but they typically go up when yields go up because it means the economy's healthy. But at what point, in what level, obviously it's 4.2%, that where people start to get nervous here a little bit, because if you look in the middle of September when they cut 50 basis points, we were at 3.6%.
Right.
I mean, that 60 basis point move to the upside over the last month.
And the dollar was 100.75. So you've got a higher dollar, you've got higher yields. You've got the ECB promised to cut rates while our data is getting stronger. That keeps putting pressure on the U.S. dollar going higher. And, we're in earnings season. So the micro stories are going to affect the individual names. However, at the same time, the macroeconomic triggers or drivers are also affecting stocks. Mm-hmm. So you've got that dual experience going on right now where if you don't have earnings coming out, look at the macro. If you have earnings and an event on the calendar, look at the micro. Because the individual story will always trump the macro. However, the macro affects the entire market.
However,
there's a lot to sift through here as we get into earnings season. That said, Tom, next week is when things get really interesting with earnings.
Yeah, we get Apple, Microsoft,
large cap tech, and that's where the rubber meets the road.
Yeah, that's going to be. I think that's going to be key. Even though we've got basically 22% of the S&P 500 reporting so far. Nathan, just give me your overall take here of earnings, because on the EPS, it seems like it's been going pretty well. We're beating, by about 75 to 80% clip on EPS. Revenue may be a little bit light, but as Alex Coffey mentioned to me earlier today, margins are expanding. So that's a good thing, right?
Certainly, yeah, and because that translates to the bottom line, generally speaking. And, I don't think that the beat rate is super important on the revenue side, just because over the past 3 or 4 quarters, the revenue beat rate has been subdued, meaning it's been coming in anywhere, let's call it the 50s, roughly 50% around there, high 40s to high 50s over the past 3 or 4 quarters. Probably more importantly, you want to look at the revenue growth rate. And right now, yes, we're only 96 out of the 500 S&P 500 companies who reported, but 3.2% growth on the revenue side, which is encouraging. You'd like to see a revenue growth rate have more importance than an EPS growth rate. EPS growth rate currently 5%. That's not bad. Let's keep an eye on Q4, forecasts and 2025 forecasts, of course. But 3.2% on the revenue growth rate, that is looking encouraging. At least, look, guys, at a forward PE of 22, you better be coming in with some pretty good earnings to justify this multiple, and then we better keep an eye on those future EPS growth rates looking out to Q4 in 2025 and make sure that there's not too much of a pullback there. We would anticipate, I think it's roughly 14% for Q4 EPS growth and roughly 15% for 2025. If history serves any guide, we expect that to come in a little bit. It's going to come down a little bit as we approach Q4, as we get into 2025. But to what degree? And I think that's really going to determine, how much of a cushion we have under this uptrend that we've seen really here over the past couple of months.
Yeah, and one of the takeaways I have, especially with today, because we got a lot of S&P 500 companies that reported, Kevin, and most of them are down. And a lot of them that are down, well, whether it's Lockheed Martin, LMT, RTX, GE, that's down 8% today.
Yeah.
You know why they're down? Because the bar was so high. We're at all-time highs. These valuations on these stocks are just so elevated. These were good reports.
You couldn't earn enough. American Express last week.
Yep.
I mean, we're starting to get this flow of names that, remember, there's the trade before the earnings event, there's the earnings event, and then there's the trade after. And you have to look like GE, in the aerospace. Look at how far that stock had run. Yeah. What could they have done to impress the street more? Stock's down 8%. Yeah. That you're going to see that. You've got to define not only the story, but if you got to define, is the bar low or high? We're going to talk about some names where we have to decide where is the bar sitting, right? Mm-hmm. And so names like Boeing that we're going to talk about in the first segment, bar couldn't be lower for Boeing. So other ones, it's kind of dicey. So yeah, it's going to be an interesting.
He's right.
You gotta understand where these stocks are and how far they've run ahead of that event.
Yeah, 3M, which had a decent report. I thought that
SPX.
was probably the worst one out of all.
I think.
But, you know, that stock was up over 45% this year. That stock hit a high of 141 in today's session. It's back down near 134. So this is,
that was up pre-market because that stock seems to be, but spread out to 3 years, spread out to a 5-year chart, it's still way off its highs.
Yeah, and GM, which was popped on earnings, then fell in negative territory, now up about 9% in their results. Nate, these were some big industrial companies, some defense names. I mean, what's your take? Do you look at it that way, where maybe it's profit-taking, maybe expectations, the stocks have run up too far, too fast? Because that's kind of my take on it, because a lot of them, the RTX report was really good. Lockheed Martin was good. GE's was decent.
Yeah, you know, Lockheed Martin, I think, you know, the EPS was a little bit light, if I'm not mistaken there, and so maybe that hit it. But I think you guys, what you're alluding to generally from a more broader kind of holistic approach, if you're trading around these earnings announcements here, is the setup. You know, how much has the stock run over the past, you know, month or two heading into the results? And, you know, it's but look, if you're a long-term investor, it's probably not that big of a deal. You're not going to be making too many adjustments around earnings, so you're just kind of holding for the long term, provided the fundamentals remain intact. But if you're trading, you certainly have to consider, you know, just how much the stock has either sold off or run up into the results, and what are the expectations. The standout for me from a technical perspective, I'm not trying to get too idiosyncratic here, but GM breaking out to more than 2-year highs here on heavy volume. You've got a nice big green bar that it has today. And at that 50-ish level, 48 to 50 around there, it served as resistance for quite some time for this stock. The stock has not been getting a lot of love. It's had a PE of 4.5 to 5. And today, when I see this type of price action on the heavy volume that I'm seeing, with the green bar that I'm seeing, this is the market saying, okay, we're ready to kind of upgrade our view on GM, technically speaking.
And we talked about GM yesterday.
There's a name for a trade like this. It's called the Roach Motel.
But this is the highest.
You may not have trouble getting out.
But that's what we said on the Future Show this morning, because we had noticed that too, Nathan, that the 50 level had become a serious area of resistance. And when I saw the stock fall into negative territory, it was under $49 a share earlier this morning after these results. The conference call started coming out. I was like, maybe that 50 is going to hold again, but up 9%. It was a pretty good, surprisingly large beat on EPS and revenue.
And this is something we talked about yesterday, how they may have, you know, the hybrid might be where the car industry settles, somewhere in between EVs and internal combustion engines. And if they get that right and they expand into that, that might be that thing that helps them compete worldwide.
Yeah.
It might be somewhere in the middle.
Yeah, and you know who's doing well selling hybrids? Honda and Toyota. They basically just kind of said, we're not pushing all that money into the EV space like Ford and GM did. They said, hey, we're going to take our time. We're going to stick to our guns with our hybrids, and they've been killing it due to the fact that they didn't go all in on that. Nate, real quick here, I wanted to get your take here on the gold market, because I think this is also an interesting point of where people are putting their money, where traders are going, because gold has just been exploding so far this year, and it doesn't seem like, even if the dollar's moving higher, it doesn't matter. Gold doesn't care. And typically we see that inverse relationship, but not over the last month or two.
Yeah, and that's actually a really bullish indicator. If you look at gold, the history of gold, the relationship, you go back to the 90s and early 2000s, it's just inverse relationship with the dollar, not a big deal. Then you have the GFC in 08. And gold gets a little bit more wonky in terms of trying to get a sense of, you know, what is it tractor beaming to? What is it correlating to? Interest rates used to be something that gold would kind of tractor beam to, at least to some extent, as a store of value. Bonds versus gold. Higher the interest rates are, the less demand for gold. And yet, as you pointing out, Tom, this commodity here is just taking off and breaking out into space, fresh all-time highs. with no correlation against what's going on with the dollar or interest rates, that's actually a very, very bullish sign. And I think most would agree, if you look at, well, what's going on here with gold? Why is there so much demand here? I think it does have to do with budget deficits, central bank, fiat money systems, etc., and really wanting to have some kind of backstop in the event that the budgets do get a little bit of hand. Now, look, we've been dealing with budget deficits, and maybe every generation says the debt's too high, the deficit's too high, etc., but it really feels like this move is signaling that the unsustainability of some of these budget deficits across the globe are actually translating into a bullish thesis for gold.
Yeah. Here's the thing, Tom. Is gold going to save you? I mean,
it's gonna.
There would be my question to anyone who wants to invest in gold. What is the saving quality against all these things? That's always been my trouble with trading gold or looking at gold as a hedge.
Yeah.
I don't understand why that is the hedge, I guess.
Right. Yeah, and I
58
think it's
50s
central
are now
bank
$2
pressure right now. I think that's part of it. I
They
think
should buy gold.
Yeah, central banks are buying it. They've got a ton of money. You can go to Costco. You can't even find the gold
They're at
bars that they're selling there
$2.
because people want some diversification. And somebody's out there saying, "Hey, if central banks are buying it, equities at all-time highs, it's a little bit of a hedge." I'm still wondering about why yields are going up. It's not negatively affecting gold, and why the dollar rising is not negatively affecting gold. That's why I feel like it's a safety play at this point, because nobody's going into treasuries right now.
I have trouble connecting the dots. I can connect the dots if you want to hedge your account. You know what hedges your account? Puts.
Yeah.
Short calls. I mean, hedging.
Yeah.
Not buying. I don't know if gold is the right hedge. I just can't get there.
Yeah.
You know.
A lot of people done well on gold this year. All right, guys, let's take a quick break. When we come back, we're going to discuss Boeing, aircraft maker stock, up this week, but down nearly 40% so far this year into their earnings tomorrow morning. Stick around. Fast Market's coming right back.
Do.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. We're talking more earnings. We're going to kick it off here with Boeing. Stock's been pummeled. It's just been headline after headline of negative news. They've got earnings tomorrow morning. They got a vote later on in the day from the 33,000 machinists on strike to approve that pay deal. Let's bring in Caroline Woods,
to approve it,
correspondent here. Caroline, big day for Boeing tomorrow. It feels like it's like a coiled spring. I don't know if this stock's going to dump 10% or go up 20%.
Go up.
That's the thing with Boeing, you just don't know. It's
Yeah, you do.
Flat right now. Of course, if you just take a look at this week's performance and this month's performance, it's actually doing all right, but giving back a little bit of the gains that it saw yesterday after the news that they reached the tentative agreement with those 33,000 striking machinists. So an end could be in sight for that strike that's been about a month long. A little bit
Good
more
idea,
than that,
baby.
If the vote goes in favor of the contract, as you said, the ratification vote is Wednesday. We'll also get a better sense of how much cash Boeing's actually blowing through because of this strike. Of course, it's paralyzed production of the 737 and other planes and cost the company a lot of money according to estimates. So we'll get some clarity there. And of course, it's Kelly Ortberg's first earnings report as CEO. He took over the helm in August, and about a week after the second quarter results. So the pressure is on him. He certainly has his work cut out for him. Of course, it's important to note that Boeing already pre-announced preliminary results for the third quarter, which came in worse than expected. Revenue of $17.8 billion was lower than Wall Street was looking for, and then the loss of $9.97 per share was wider than analysts were looking for. So I think the hope is that maybe the bad news is out there at this point. Kelly Ortberg said in the pre-announcement that Boeing was in a difficult position and said it's hard to overstate the challenges we face together. So we'll see what else he has to say when they actually report tomorrow before the bell. Boeing has also recently announced that it's laying off about 10% of its workforce. That's about 17,000 people. They're looking to raise up to $25 billion through debt and stock sales, and then they also said they secured that $10 billion line of credit from the big banks. So, a lot of headlines have already come out for Boeing, so it'll be interesting to see when they actually do report earnings, which way the stock moves. But as you can see here, it's basically going a whole lot of nowhere right now ahead of that report. But it is up about 3% this week, up about 5% this month. But take a look at year-to-date performance, down almost 40% year-to-date still.
Not
Caroline,
today.
they have a new CEO with an engineering background who is now going to live in Seattle and so be close to where the planes are being manufactured. They've got a 6,100 aircraft backlog. 77% of those are 737s. So there's the future of this company, is the 737s, and that plane, which is quieter, better gas efficiency. There's a lot of things going on. However, they got the machinist strike. Wednesday could be a pretty epic day for them. I mean, the CEO, who seems to be putting out the fires, if he gets the machinist back, if he gets cash raised to get through this period, I mean, the debt load is not cheap, but all this company needs to do is get back on track delivering and get the government out of their business, because the United States, whether we like it or not, we need Boeing, both for airplane manufacturing and defense contractors. So I think it's time, Caroline, for all of us to get the pom-poms out and start cheering for Boeing. Your thoughts?
Yes.
Well, I think a few important points that you've pointed out there, Kev. I think the ifs, there's a lot of conditions here. A lot of things need to happen for Boeing to get back on track. Seems like they're crossing some of those T's, dotting some of those I's. So hopefully that will be the case. That new contract includes a 35% wage increase. Previously, they had rejected a 30% wage increase, and maybe that 5% sweetens the deal. It also includes a $7,000 one-time ratification bonus, throwing some money for the 401k as well. So not the pension that they were looking for, but the hope is that sweetens the deal enough. And then, of course, the backlog that you mentioned. That's, of course, really the bright spot for Boeing, the fact that they do have that backlog. Obviously, the faster that they can get back to producing and delivering these planes, the better for Boeing. But I think that remains really the bright spot for Boeing. And I think that's likely why almost 60% of analysts still have a buy rating on shares of Boeing heading into this report, despite the fact there's been so many negative headlines around the plane maker, in what seems like for quite some time here. If you take a look, median price target is $199, so that's about 40% upside, or I'm sorry, $40 upside from current levels. 275 is the high, 109 is the low. Boeing currently trading around 160 right now. So the majority of Wall Street thinks this is eventually a stock that will run higher. I think that there's just question marks on will it be starting tomorrow, or are there going to be more kinks to work out? It's a big day for Boeing. We'll have to wait and see.
Yeah, definitely a big day, and I don't think any of the investors in Boeing stock have their pom-poms out because that stock has been a falling knife.
I'd like for Caroline to be more positive, please. I'm requesting a little more positivity, Caroline.
I think she was fine.
Hey, the charts. Hey, I told you, the positive thing is if you only look at this week and this month, Boeing is higher.
That's right, 5% this month. All right, great stuff. Thanks to Caroline Woods, Senior Markets correspondent here breaking down Boeing. Nate, let's bring you back in here because, as we mentioned, it's turned around a little bit. Hopefully they get through this stuff. They can start producing planes, start producing free cash flow. But your thoughts here on Boeing? You got an example trade.
Yeah, sure. So so bearish. Let's start with the bearish kind of stance here on Boeing. Number one, you've got that $25 billion, as Caroline mentioned, over 3 years. They're expecting to raise capital. They need capital. That's dilutive to EPS. You've got higher labor negotiations here, higher costs. That's bad for margins. The technicals are bearish here, and a lot of the investors have been really patient with Boeing basically coming back to, getting their stalwart type status, and it's these quality issues. You would think that after all that the FAA, their investigations and all these headlines that continue to happen, that they've had enough time to address these issues. But if we go to the bullish case, it is a duopoly. It's a unique company in that position. You would think that because there's so much attention on these quality issues that have been coming up, that at some point they've got to have them corrected. And then with the stock down 40%, like you guys mentioned, at some point you would think that would come into play. And because they're a duopoly, it's a little bit almost like the company's a little bit too big to fail at this point in time. But yeah, tomorrow should be one that introduces a lot of volatility. I'm not so sure that it's going to be due to the earnings. I think it's more going to be on that labor strike vote. And if I had to guess, I would say earnings lousy, and they would approve the tentative deal that they proposed on Monday, just because 25 to 35, that's a pretty big increase that we've seen on those terms.
Implied volatility levels elevated, but they've been elevated for a while as the stock's been pretty volatile recently. Expected about a plus or minus $7.20 move in the shares. Break down your example trade here, Nate.
Yeah, sure. So, if you expect some kind of a big move one way or the other based on that vote, I'm saying primarily the vote, but it could be based on earnings. But if that was your case, you look at the implied move, roughly $8-ish or so. I was looking at a long iron condor, and I was going to the 155, 152.50 bear put spread. That's one wing, and then going up to the call side, I was going to the 165, 167.50 bull call spread. So here's your iron condor. Those are the two wings. It's within that implied move roughly. The debit at the time, I think if you look right now, it's roughly $1.40, and you could potentially make $2.50 if you get one of those big moves one way or the other. You have till the end of the week, so it is going to capture both the earnings and that vote.
All right, let's break this one down. Really short-term positioning in this example trade that Nate bought. This is the need-a-move type strategy where you're buying the iron condor, where you're buying the 165 call, selling the 167.5 strike call, buying the 155 put, selling the 152.5 strike put, $2.50 wide, paying roughly about a $1.45 debit for this one. There's your risk on $145 per spread, with profitability of about $105, Kevin. But if this thing does move, I mean, it's right at its 50-day moving average. If it do get that 2 standard deviation move, this thing takes advantage of that.
This is the conversations that I love to have about trading is Nathan's not playing a direction, right? Often we do directional trades on this show. This one, he doesn't really care if it goes up or down. His goal for this, the trade that he has on, is the size of the move in either direction, right? And so he's looking for this $2.50 spread to go to $2.50, one way or the other. So it doesn't look like by the delta that he has much of a bet in either direction, like skewing the Iron Condor, but this is one that looks at move versus lack of move.
Yep, you got those break evens, 153.55 and then 166.45 on the upside. So you need it to dump or rip is what I like to say with the strategy, but it's an earnings play, but at the same time, you still got a couple days after earnings if you don't get that initial move. But maybe you need to do some trade management. If you do get the move right away, maybe you close a portion or one side of it or all of it if it does.
Yeah, and Tom, look at a candlestick chart of the past 3 earnings announcement. You'll see a big bar. This stock moves post-earnings intraday, so it could be one of those opportunities where the stock moves one direction based on earnings, another direction based on the vote. So just know there's likely, based on history over the past 3 quarters or so, a lot of volatility post-earnings.
Yeah, if it dumps, maybe you sell out of that long put vertical that you have, and then maybe you keep the long call vertical on, and maybe the vote changes the direction of where the stock went or vice versa.
Can't rule it out.
Yeah.
It's not a high probability, but it's also not zero.
Yeah, that's right. All right, good look at the long Iron Condor for need a move type strategy. Thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Coming up after the break, we're going to be joined by Andy Swan from Likefolio for taking a look at sentiment data in Affirm, the buy now, pay later stock, is up about 6% this month. It's still off about 11% this year. We're coming right back.
Doom, doom, doom. It's now 11:30, 12:30 Eastern.
The trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's market on close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. That's Andy Swan, co-founder at Likefolio. Welcome back to the show, Andy.
Hey, thank you.
All right, so we're talking Affirm. Buy now, pay later. It's here to stay. Is Affirm still one of the leaders according to your data in this segment, Andy?
Yeah, absolutely. I think, Affirm has a lot going for it. It's got a tailwind in terms of the buy now, pay later phenomenon that continues to grow. I think, you said it best. It's here to stay. We weren't sure about that a couple years ago. It seemed like an interesting idea that may not have been needed, but when you look at the way it breaks down generationally, millennials, even Gen Z, really adopting this, preferring it a lot of times to traditional credit card type of payment solutions. They really like the structured payments on the things that they buy and seeing that visibility well into the future on everything that they're going to have to pay. And so Affirm has done a phenomenal job of capturing this tailwind. I would say it's clearly the leader among the buy now, pay later companies. If you look at the growth in web traffic, which is very indicative of demand for their services, Affirm is leading everyone else at plus 30% year over year growth rate.
30.
And so it's the best at capturing the tailwind in its category. And I think that they have the best CEO. The co-founder of PayPal is the one leading the charge. So someone that really, really understands e-commerce, understands transaction volume driving revenues and leading the way to profits. And he said that it's more transactions are going to be what gets us to profitability. And the company looks very much on pace to accomplish that because they are outrunning all of the competitors in their field and providing a service that most of their customers tend to like and tend to repeat with over and over again. So overall, a really nice company. I've loved the way the stock has reacted in the last 3 months. It was a blowout earnings call last quarter, and I think we could be setting up for another one as we head into the remainder of this year.
Yeah, Andy, they've had a lot of blowout earnings. I mean, they've beat on earnings consistently across the board. And I get why consumers want to use this, right? It's basically no interest payments for them. You're just paying off where the fees are kind of reversed to the seller. The question for me is, I get why consumers want to use this. Are the sellers signing up to do this? Are you seeing any traffic in your data where it's getting more popular from the selling perspective? Because they seem to, after being, bad-mouthed and almost thrown and left for dead, they seem to be having a pretty solid comeback here.
Yeah, absolutely. I think the best indicator of that is that they've established a partnership with Apple Pay, which in my mind means they're here to stay. Sure. Apple doesn't usually partner with companies that that vendors don't like. And so I think Affirm is putting itself into a situation for vendors where whether you like their fees or don't like their fees, they're becoming a little bit of table stakes, which is a really powerful place to be.
Yeah.
But if you don't have buy now, pay later options on your website, on your checkout form, you might lose that customer and get an abandoned shopping cart, and they go to your competitor who does have the buy now, pay later option, and Affirm makes that integration extremely easy. So I don't think that the vendors have as much of a choice as we might like to think in terms of whether or not they're going to use a buy now, pay later solution. And if they decide they are, which I think they will, it's most likely going to be Affirm.
You look at that one chart that you have, the pie chart, Andy. I thought that was pretty interesting as far as e-commerce payment method. Adobe Analytics said we're going to see e-commerce sales during the holiday shopping season rise 8.4%. This is all about GMV for this company. And buy now, pay later, you've got right there 5% only. That seems really low. So that TAM, or total addressable market, for this space is massive, isn't it?
Yes.
Yeah, I mean, and what's really crazy about this chart for me is if you look at buy now, pay later at 5%, bank transfer at 7%, that means if they can get people to be as excited about, buy now, pay later services as they are about putting their actual banking information into the checkout process, that's 40% growth for this industry, which is incredible to see. And that doesn't even start touching debit card, credit card, and so on. So there's plenty of space for buy now, pay later to grow. And Affirm being the leader of the pack puts them in a really, really good spot as we head into 2025.
Yeah, and I think you better be ready because Walmart's saying that you can pay directly from your checking or savings account at checkout. So, I mean, that's big for these credit card companies. I mean, that's going to be massive if they lose any share there as far as swipes at Walmart.
Yeah, the swipes is where Walmart gets their data. And think about the millions and millions of swipes they get. And if they cut into that, which is, let's face it, it's the natural evolution of this business. They're going to start cutting out the middleman. Visa and MasterCard, as much as we love them, they serve no purpose if you can set it up yourself. Yeah. And these big companies can set it up themselves.
Yeah, or use a cheaper fee, which is a lot lower than the swipe fees of 1.5 to 3.5 that the credit cards charge right now.
Yeah.
Buy now, pay later is cheaper. All right, great stuff. Great data as always, Andy. Appreciate it.
Thank you. Have a good one.
All right, that's Andy Swan, co-founder at Likefolio. So, Kev, we don't have earnings for a couple weeks in this name. They report on the 7th. How do you want to look at this one from an example? It's been choppy, up, down. Andy did mention that they've got the partnership with Apple, but Klarna, their biggest competitor, iOS is going to, and Apple is going to let them use the Apple platform for checkout also. So that kind of hit the stock recently, but it's been, chugging higher, but fits and starts.
So whatever you think about this name, the strategy is what we're learning here. Right. So based on a November 7th earnings event, right? Understand what we're teaching here, which is I'm going to go past the earnings event. And by the November 15th 48 call, then go before the earnings event and sell the November 1st 48 call. Why? Well, if it moves towards 48, you'll have profits. However, Tom, the current debit, I have 190. I think it's closer to $2 now on the debit. But Tom, you have a chance to roll this into the event and extend duration into that November 8th week, which the roll is going to not be small, and it should whittle this net debit down to very, very small.
You might be able to take care of the entire debit on that one roll if it's at or near 48.
If you can roll this, if you get any movement towards 48, you're going to have a roll that's basically has a chance to wipe out the entire debit of this. So it's the strategy here and what we're looking at here in the trade. You go after the event and then before and then extend duration into the event when that week, and that should set you up, the right way. Now, it can be the 48 call like I did. It can be lower on the put side like I did. It doesn't matter the direction. It's the strategy that we're working on here today.
Yep, and that's why, we're going to walk through this trade, but that's why you look at the risk profile here, and it looks like, you can't make that much money on this type of trade because it doesn't have that roll potential credit that you're going to collect, which is going to be outsized because that implied volatility level in the November 8th weekly options is far above any other option series because you have that event risk. So let's break this down. November 15th monthly options, 24 days to expiration. Buy the 48 call. Sell the November 1st weeklies that expire in 10 days. The 48 call, 2-week wide 48 strike call calendar, paying roughly about $1.90 to $2 debit. The debit you pay is going to be your risk, so $190 on this example. But your break even is about 44.5 and 52.5 on the upside, and that could actually widen after you do the potential roll. So the idea is as you get closer to November 1st, weekly expiration over the next 10 days, you want the stock to grind higher towards 48, and that gives you that opportunity to, as time decay takes hold, roll that short option into the November 8th weekly cycle, get outsized credit for it, but it's key to have it be at or near the 48.
Couple things. If you look on your Greeks, you're actually paying theta, right, on this trade currently. Why? Because you're buying a 97 implied vol and selling a 72 implied vol. Right. So it's working against you. Then you're going to roll from a 72 into a 108 implied vol. And that, right now, as we sit, right, the November 8th 48 calls are trading, but it's basically 225. So it's the entire debit that you just paid.
Right.
Minus, of course, whatever it costs you in the front month, but they'll decay all week. So it's pretty interesting to look at the possibilities of this trade.
Yep, and I think the key is trade management. Market's
Yes.
open. You can make those adjustments or rolls that that are necessary in this type of position. All right, let's take a quick break here, Kev. When we come back, we're going to take a look at Texas Instruments. Chipmaker stock has rallied about 15% so far this year in earnings after the closing bell, but it's fallen off all-time highs. Stick around. We're coming right back.
Market looking a little bit better than it was.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Texas Instruments, let's get a quick market update here. Stock's kind of stabilized here. Got the benchmark S&P 500 off about 0.3%. We've got the Dow Jones Industrial Average basically flat now. We're making some inroads to the upside there in the blue chip names. NASDAQ 100 still off nearly 0.4%. And the Russell 2000 also digging into some of its losses, despite the fact that that 10-year yield is back above 4.2%. You see oil there up nearly 3% on the session, getting close to 72 bucks a barrel. Maybe some geopolitical rhetoric taking place here. Gold, as we mentioned, all-time highs. Got the VIX a little bit stronger, and then the dollar continues to move to the upside, causing a little bit of pain today here for equities. So keep your eye on those asset classes and yields also. I think that's really important. All right. Let's bring in our next guest. Take a look at Texas Instruments ahead of earnings after the close. George, tell us, when you look at this name, George, this is that old legacy chip maker that's basically involved in everything, right? From automotive, industrial, it's analog chips. I mean, but they're in everything, right, George?
They are. I mean, they're not as obviously exposed as in artificial intelligence, which actually may not necessarily be a bad thing considering the exposure that TXN has in what are considered the analog chip space, but also the embedded chip space. And when you think about manufacturing, you got to think about all the semiconductors that go into that area of our economy and the automotive space as well. And so essentially TXN's majority of the revenue is actually in the automotive and the industrial space, but factory automation is also quite technologically advanced and becoming more advanced over time. I think if you look at TXN, there's some weakness in the stock in the past, month or so, and that might be based upon the fact that if you consider the weakness in the areas in which there's exposure for TXN, the automotive markets have been relatively weak. I've noticed, just driving by car dealerships, there seems to be a lot of inventory. The other thing is if you think about manufacturing and industrial production, those two areas have also been weak. Because essentially there may be an oversupply right now. But with that said, TXN has got a weak quarter expected if you look at the numbers compared to the same quarter last year. So there seems to be sort of an underwhelming expectation this quarter around. So maybe a situation where they underpromise and overdeliver. But if you look at the numbers, they're expected to earn $1.41 per share. Now that's down about 23% compared to $1.85 for the same quarter last year. The sales are also for the quarter expected to be down to $4.12 billion, about 8% lower than the $4.53 billion for the same quarter last year. So this will be interesting to see because one of the things I've talked about is this sort of disparity or divergence between what's going on in the semiconductor space. In the digital semiconductor space, we've seen a lot of weakness in the equipment manufacturers, ASMR. If you think about the aspects of Lam Research and KLA Tencor Applied Materials all weak, NVIDIA very strong, TSM very strong. TXN is like right in the middle of all this. The performance of the stock has actually been quite robust this year. But a lot of the performance has been taken away from the fact that they pay quite a bit of a large dividend relative to earnings, $5.44 in dividends. And right now, based on 2024's earnings, the estimates are $5.28. So they're expected to pay more in dividends this year than earnings. They can afford it. They have about $10 billion in cash on the books. But right now, based on next year's earnings, they're expected to grow quite nicely to $6.67, and the forward multiple right now may be a little bit rich at 29 times earnings. This is for next year's earnings, not for 2024.
George, they have great long-term prospects, but what I read about the valuation is a little stretched right now. And George, comment on this. They've got a pretty big bet made, right? They have high inventory levels. They're increasing their manufacturing. They're making a bet on the future of this business and how much demand will pick up or keep up for these products. Are you reading the same thing? It seems like they're all in, and that seems to be at their valuation weighing on the stock a bit.
A little bit. So you got to think about a few things. Some of the risks right now are it does have an elevated PE. The expenses and capital expenditures have been quite high. They're not afraid to spend money. That may be reflected in some of the weakness we've seen. Again, those CapEx concerns. The automotive segment of the marketplace has been weak, so that's also been a drag on the business. But they are getting, if you think about the CHIPS Act, that received about $4.6 billion. So they're getting, assistance, if you will, in partnerships with the U.S. government to manufacture primarily embedded chips for industrial automation as well as automotive chips here in the United States. So a lot of the concerns about CapEx, they're spending quite a bit of money, but they are getting some fiscal grants to do so. So, that might be supportive of the higher multiple we're seeing because a lot of the costs are being pushed off the books to the public sector. But again, onshoring of manufacturing seems to be what the Biden administration has done to improve, the workforce and, of course, mitigate the risks of, all the offshore semiconductor production that, again,
big breakout on SPY.
Some exogenous risks in case there's some technical snafus from a supply chain standpoint overseas.
All right, great job. Backdrop for us here, George, going into earnings for Texas Instruments. Appreciate it. That's George Tillis, Senior Markets Correspondent here, breaking down Texas. Plus or minus about $9.50 move, Kevin, that they're expecting. So nearly $10 either way. I've seen some rips on earnings over the last couple of earnings where it rips, about that one standard deviation and maybe a little bit more, but it does move historically on earnings. So that's the setup I wanted to kind of look at for this example trade here. We have the long iron iron condor that Nathan brought us, where you want to move. We had your call calendar to the downside. So I'm going to kind of combine those, where I'm looking at a double calendar position where I want to take advantage of that implied volatility dispersion that we talk about, especially because of that event risk. So going out to the November 1st weekly options, I'm going to buy the 205 call and buy the 185 put. I'm going to sell those same strikes in the October 25th weekly series that expires in 3 days. Sell the 205 call, sell the 185 put. Double calendar position on the 205 strike and the 185 strike, just 1 week wide, paying roughly about $1.40 debit on that. There's your risk. It's trading about $1.30 right now, so you can get a little cheaper, but the debit you pay is going to be your risk on this one. I think the key, Kevin, is you don't want it to sit where it's trading right now. You want it to go towards either one of those strikes, which is about the 1 standard deviation move.
Pretty close.
But you got a nice wide range between just under 180 and above 210 that you can remain profitable on this one.
Yeah, you're focusing on about $10 higher at 205, about $10 lower, 185, $9 lower, and this is a 1 week double calendar spread. Now, the nice thing is you're collecting theta. You're long a little bit of Vega, but you're selling higher than you're buying. But the key is you want it to go towards one of the strikes, right? And the key is to pay as little as possible and have it go towards one of the strikes. You can have a nice little winner here. The risk is only what you pay, and the risk is it's staying either in right where it is now or moving way past your strikes.
Yep, and we talk about that volatility dispersion between option series. When you're buying the November 1st options, 47% implied volatility on aggregate in that series. And then in the October 25th options, you're selling about a 71% implied volatility. So there's that dispersion that we talk about, which lowers the entry price, which is your risk on this, right? About $140 per spread. So that's what you have to take into consideration. Really short-term positioning, you need to move at or near one of those strikes. Time decay is in your favor, where those short options that you sold in the near-term option series decay at a faster pace than your long options. But you definitely need to move towards at or near one of those strikes, but you got a decent range in that one. All right, good look at the double calendar position as an example there in Texas Instruments going into earnings, but that's going to do it for us today in Fast Market. Stick around, though, right here on the Schwab Network. Next Gen Investing's coming up.
Doom, 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 doom.
This election season, stay out of the muck and the mudsling. Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if You don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean?
Too crazy.
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
We got resistance at 582.68. That's what I got.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, we are seeing the second pretty substantial day of pressure today. I mean, not any selling off by any means, but a collective day to the downside in the S&Ps and all four of the major averages here. Again, not fast selling by any means, but another day of weakness led by the Russell, which was, of course, our outperformer to close out last week.
Yeah, so it's been a yields-driven move, I would say, in the Russell 2000. I think that's pretty clear when you see the 10-year Treasury note moving continually lower, yields spiking. We know that that's a more interest rate sensitive index. So setting that aside, what's going on with these other indices? Both times the S&P's finding some level of, let's call it, support at around, let's call it 58.25 or so. So we'll see if that can continue to be a critical level for this market. At the same time, running into a bit of resistance to the upside here about 58.50. So a little bit more of a range-bound market with the S&Ps. We know the NASDAQ was buoyed largely by NVIDIA yesterday. Not getting the same love from NVIDIA today, although the stock's mostly unchanged. It is getting some love from Microsoft. So it's almost like we're playing, kind of this game where we just pass around amongst these mega cap names the name that puts the market on its back. And today that name is Microsoft.
It is Microsoft, yes, and NVIDIA. I was looking at it earlier thinking maybe we could open higher, but no, of course, we're seeing weakness in Tesla, NVIDIA, as well as Netflix, and or at least a lot of these major cap names. Apple also lower, but still
no big deal.
Alphabet and Amazon on the session here. But as always, on this show, we have a lot of earnings to get through today, a lot of post-earnings reactions as well as earnings previews. We'll kick things off with upvote and downvote. We will be charting and trading our upvoted names to, of course, ahead of earnings due out in the next 24 hours. We'll also be looking at GM, which is ripping on the back of its quarterly update, up 9% here, leading the S&P 500 gainers today. And then we'll be previewing Seagate, which is one of those that has earnings out this afternoon, as well as AT&T, expected to release tomorrow morning. AT&T seeing some weakness today on the back of Verizon, which I know we'll get to here, but telecom space, I'm joking, this is like the Dow week of earnings, because I know we have Tesla, but it does feel very much Dow focused, a lot of these more like market blue chip names, if you could call them that, but to me, they don't garner a ton of volatility. So I'm like, this market is boring, but it's obviously not.
Yeah, and I think we've also just gotten so used to really, really busy market conditions. So the fact that it is kind of this lull from an economic data standpoint, from an earnings standpoint, it's like the calm before the storm. And that's not to say there's not a ton of names reporting. We talked basically our whole show is going to be earnings centric today. But it's none of those heavy hitters where you're like, oh, a move one way or another can truly impact the direction of the overall market, at least for that day. Now, collectively, they all start to say the same thing, positively or negatively. You could see some market movement on the heels of that.
but we'll see ultimately how things shape up as this week rolls on. So far, it's been a pretty strong earnings season once again. Let's do up vote, down vote, though, not endorsements, not recommendations. Now, every rule has the exception, so although it's been a strong start to earnings, not so much for Verizon.
Yes, not so much for Verizon, a name that's trying to hang on to, I mean, at least a modest gain on the year, up about 11%. It's one of the worst performers now in the Dow today, posting a smaller profit and flat revenue in their third quarter, as a lot of the workforce reduction charges did dent their overall bottom line. They recorded a profit of around $3.4 billion versus, for example purposes, a $5 billion were posted a year ago in terms of profitability. Adjusted earnings were $1.19 a share. That was slightly above what the street had been expecting at around $1.18, but higher prices and growth in fixed wireless connections did help drive up their wireless service revenue by about 2.7%. We also did see a net gain of around 239,000 postpaid phone connections compared to a gain of around 100,000 in connections last year. They also did report roughly 390,000 broadband net additions in the quarter, including around 39,000 Fios internet net adoptions. The bottom line did include around $2.3 billion, though, in charges related to special items, including this $1.7 billion severance charge related to job cuts and these voluntary separations for certain management employees in the U.S. So at least we know why there's these excessive charges weighing on, again, that profitability. It's incomparable when you look at it from this year to what we saw in the third quarter of last year.
Yeah, I didn't see a lot of, let's call it, super negative in this report, but the stock have been doing a little bit better, and the backdrop of yields starting to uptick. That's not generally good for, you know, a heavily indebted kind of telecom dividend style income investment type of a position. But I was a little bit surprised, I think, to see just how disappointing this reaction is. Now, a 4% move, you know, for some names is, you know, just a little bit of a dust your shoulder off situation. I mean, a name like Tesla can make that just on any other day. But for Verizon, that's a pretty substantial move. So market not satisfied with what we saw from Verizon's quarter. And so far maybe in line, just not enough to keep the party going. That's not even to say that Verizon's been a super strong performer. The chart's been okay, I would say, relative to its performance the last few years. Let's talk Enphase, though. We haven't heard from them yet, but they're on the schedule here. This is a name that I would say volatility a little bit more expected.
Yes, especially given its underperformance this year. But of course, I mean, making a modest move today to the upside of 0.4%. This name has fallen 31% this year. It's down about 20% this month. Actually, it's one of the worst performers we're seeing on a month-to-date basis, and so are a lot of these solar names. First Solar is another one, Sunrun. I mean, all of these charts look pretty blistering to the downside. We've also pulled back about 36% from recent highs, which, I mean, incomparable to all-time highs. So the street is expecting now 77 cents per share as far as earnings on a revenue of around $392 million roughly. Now, as far as earnings, that would be a sequential improvement, but it would be some contraction as far as what we saw a year ago when they saw or adjusted earnings come in over $1 a share. The solar stock has, of course, been under somewhat of a cloud, more notably slipping as of late, though, and I think that has to do with a lot of the resurgence or the interest right now in nuclear energy. Of course, this name operates in an alternative energy space, but solar adoption has been slower and more costly than expected, driven actually by a lot of the headwinds out of actually Europe, and in Germany is a major market for these solar names. They've just not seen the same spending ramp up that had been anticipated. So I do think clarity is always welcome for some of these names that have been beaten up, but unfortunately it's not an Enphase specific story, it's a solar specific story.
Yeah, and I always think that these are really fascinating earnings releases when you're in that spot where you're transitioning perhaps from a tougher time to kind of a recovery time frame. One of the, I guess, general feelings around this company in this space is some of that over-supplied inventory is starting to clear a little bit, particularly in the U.S. market. If that's to happen, we saw this in semiconductors a few years ago, it does allow for the recovery to begin. Now, the problem is it's really hard to time when that's ultimately going to play out. So perhaps the bottoming out of some of those sales concerns and troubles in store for this one. But whenever there's, kind of the horse before the cart, if you will, you got to start seeing the numbers. They're starting to think that. We got to actually see the numbers support it. So we'll see what Enphase has to say. Let's talk Coca-Cola. Tomorrow morning we hear from this company. Now, if Enphase was representative of a name that might make a big move and is a little bit volatile around earnings, Coca-Cola might represent the other cohort.
It definitely might, and I think that name, typically trading in a more staple nature, is actually welcome in many portfolios, given that it has that more defensive right now option. But expected to report revenue that would mark about 2.5% contraction annually, and earnings per share of around 74 cents. That would actually be above the 71 cent per share they reported a year ago. Investors will be watching very closely for price and mix shifts, though, across their geographic operating segments. This company does still skew towards North America, around 36% of its revenue as of its last fiscal year, but it is diversified. I mean, we do have some pretty sizable exposure to international markets. Actually, one analyst out of Mizuho was saying that particularly that international exposure could be a headwind, as China, Mexico, and the Middle East could weigh on their overall results. But what we know from Coca-Cola and from watching management commentary this year is that they're trying to focus on their most beneficial brands, most profitable brands, is I should better put. But they basically did see this trademark Coca-Cola rise about 2% in terms of its volume last quarter. Well, growth in their zero sugar Coca-Cola also rose 6%. Sparkling soft drinks actually improved 3% overall, and sports drinks rose 3%. Conversely, water sales dropped by about 1% and coffee slid by 4%. So they are trying to figure out the recipe that consumers right now are thirsting after, no pun intended. But last week we did hear from Pepsi, which lowered its full year organic sales outlook when it reported earnings. Management noted that the cumulative effects of inflationary pressures continue to impact budgets and spending habits. I will say that I am a soda connoisseur. Unfortunately, I drink way too much soda. I'm trying to cut back. I think I say that every time we talk about these companies, but I will never trade down for anything but Coca-Cola. I am Coca-Cola loyal. I think that the Diet Cherry Coke is cream of the crop soda.
I do think that that sentiment that you're expressing is shared. You know, there might be trade down for something, I don't know, maybe cheese, or maybe you see it in like milk or things like that, but it doesn't seem to take place for cereal, and it doesn't really seem to take place for soda. And so we'll see if that continues. Budget's constrained enough, maybe tough decisions must be made. But
tough
things
decisions.
that I'm focused on, you talked about the international nature of this. It'll be 20 straight quarters that they beat on EPS. That's an incredible streak, so we'll see if they can deliver that.
Apple did bounce this morning.
Although revenue growth is maybe a little bit higher if it were to hit the expectation, sort of that high single-digit mark, it's actually decelerating quite a bit from about 11% last year, which is pretty incredible when you start thinking about Coca-Cola. I don't think we ever really think double-digit revenue growth when you think of a consumer staple, especially
Make me
one
some more
like
coffee,
soft drinks.
and I'll be right back.
We'll see where those numbers.
This coffee's
shape
not
up
as
and
bad as
land.
that other stuff.
Last one, not earnings.
Gets me too buzzed.
That's Walmart.
That is Walmart. Speaking of a name that's been able to deliver on consistency, I mean, we're up now 55% on the year. Modestly higher this month and up 63% from its 52-week low. And so we did get some news. They just launched their same-day pharmacy delivery in 6 U.S. states. Those include Arkansas, Missouri, New York, Nevada, South Carolina, and Wisconsin. Also, with an analyst note today, Bernstein starting coverage with an outperform rating, a $95 price target. The firm did say they expect this name to continue to be best positioned, noting that Walmart is their top pick, and they anticipate the company to leverage their scale to offer great value to customers and to continue to grow its e-commerce profitably. So as Walmart's investments in omni-channel start to pay off, they expect EBIT growth to meaningfully now outpace sales growth. And I think that actually the same-day pharmacy story somewhat speaks to that omni-channel presence, in which obviously Walmart is continuing to really benefit from, because not only do they have their Walmart Plus, they also have obviously the physical brick-and-mortar locations, and we talked about their increased pet offerings, which I thought was really interesting because Amazon hasn't really capitalized on that quite as well. And now pharmacy, which I think all these companies are trying right now to somewhat mimic that success of the Amazon's pharmacy business. And you have, unfortunately, like the flailing businesses that is CVS and Walgreens. I mean, shoot, I'm going to switch my prescriptions to Walmart at this point.
This analyst covering 7 names, 3 others in the kind of outperform camp, Lowe's, Costco, Dollar General. So Target in the neutral market perform. So they like Walmart a little bit better than they like Target. Jenny, when you look at this name, you'd be confused, I think, if you just took the the name off the top of that chart and you said, hey, what stock is this? Took the scale off, you didn't know the prices, you might think that was a semiconductors chart when you see how impressive Walmart's performance has been.
I know, and every earnings period, it feels like they have the right recipe of like commentary, guidance. I mean, we'll have to obviously see when they report. They report on, like, I believe it's November 19th before the market opens. We have some time there, but really, really impressive track record of pleasing the street and consistently delivering, which is why this name is an outperformer in the staples space. I mean, significantly so. So all things considered, Walmart, great chart, but we'll be looking more at our names that have earnings more in the near term. We'll be diving into two very different names. Of course, Enphase Energy being more volatile and Coca-Cola being that staple type player. We'll also be looking at some example trades in both of those names. Stick around, Next Gen Investing will be right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time for our Chartmaster segment. And joining me, as always, is the Chartmaster himself, Rick Ducat, to help us break down the technicals. So we've got the more challenging one of the two to start off with here, which is Enphase, down over 31% on the year. As we know, it is a broader solar story where we've seen this weakness hit these names, especially, gosh, this month as of late. So walk us through what you're seeing here from a technical front. Of course, we have earnings due out soon. So I would say there's a lot of expectations running on a name that has underperformed pretty consistently this year, Rick.
Yeah, challenging is certainly a word to describe the recent price action. Challenging for the bulls, at least here, because what you can see is a longer term blue trend line here, starting at that low point, 52-week lows, all the way over there near 73.49, connecting these subsequent lows. And you can see here, that's where we kind of broke down. We had a pretty big red candle, that made for a big push to the downside after we did break below that boundary here. So you can see we also had a downward sloping blue trend line going across the highs, giving us kind of a triangular type shape here, but indeed we have broken pretty convincingly lower here. And actually we had another leg down as well, a large green or red candle here that broke below this red line, 95.65. You can see how many times this was a low point that we reached in our trading here. So another kind of important breakdown below a support level. Now you can see yesterday we touched close to our green line here, 88.55. Most of the trading activity has been within the boundaries of this very narrow, very tight white channel here, encompassing a lot of our activity that we've seen recently here. And look as well, a pretty heavy volume spike that we had during that big red candle, showing some conviction on the part of traders. But we're below our moving averages. Everything's trending downward. We continue to break below support. Kind of not a ton of activity today, but things do not look encouraging right now for bulls.
Yeah, and I would say that especially given the price activity over the last month, and I know I mentioned that, but I've been watching these names because they're volatile, so they're kind of interesting, frankly, to look at on a daily basis. They move without any news, frankly. So it's been a space that's interested me, and unfortunately not in the most favorable price activity. But momentum of this recent downtrend, are we seeing momentum pick up or any sort of easing here as we go into earnings?
Yeah, that's the thing about volatility. It cuts both ways. It can be beneficial for you. If you get caught the wrong way, it can be pretty bad for you here. But when we look at momentum, we can see here that since this point here, since we started kind of trending down, making a rather steep move to the downside, that was about where we topped out. In RSI, we made a little bit of a push above that 50 midline. It did not last though. We have a green trend line going down across those high points during this decline. We can also see that currently we are in the oversold area, that threshold below 30. In a trending market, this would be regarded as a sign of weakness here. This is some people might interpret this as being, oh, we're oversold, we're due for a bounce. That would be maybe how you would look at it if we were range bound and price was kind of bouncing back and forth between support and resistance. But in a strongly trending market, this is a sign of potentially further weakness to come. So definitely, once again, not what the bulls would want to see in this name as we kind of try to make some kind of assessment about the trajectory of prices. It definitely seems like things are more geared toward the downside by this measure as well.
Yes, and I would say that not shocking again for following this name very closely, but as far as some levels now we're watching in terms of support and resistance here, again, this name has earnings due out today after the closing bell, so what are we keeping on our radar?
So when I looked at this one, normally I use standard deviation channels to look for where a stock might be heading if it's making new highs or new lows and there's not really much prior price action. I chose to include it on this chart because what we're seeing is a great degree of variance here. The data is widely dispersed from its central points here, so you can see that where we are right now, we are very close to the -2 standard deviation channel. So 2 standard deviations below our linear regression line, our line of best fit here. That's an idea of fair value. Stocks, kind of just anecdotally speaking, tend to stay within +2 and -2 standard deviations. So we're approaching a relatively extreme point here. It happens to also line up with our green line there. That was a low point that we saw after a sharp rally to the upside here. So potentially a key area to watch out for. If we do break lower, the low point after a gap up, our light green line comes in near 83, and the point I was just referring to, right around 88.50 or so. That would be the next area to be watching here. So if we were to move to the upside, our red line, our repeated floor that we encountered here that we have since broken through, old support becomes new resistance. 95.65 would be another area to watch. Then our 21-day EMA up here near 100.8.
Okay, and considering we are making a modest move higher today, though not enough to dent the overall month-to-date losses. So with all this in mind now, Alex, walk us through how you think about trading the same, of course, for example purposes.
Yeah, looking at something going with the trend here. Danny, looking at a bearish example strategy. What we're looking at in this particular case is a put
I don't know if he said 21 or 23.
Consisting of an option being sold this week and then one being bought next week, centered around what that market maker move is. Right now, that market maker move just under $10, stock just over 90. That kind of targets in that $82 to $80 range if it were to perform as option prices suggest it may. What I looked at here was that in mind. So what we looked at was buying the 82 put next week, selling this week's 80 put. Looking to spend about $1 debit, which of course is $100. That would be your max loss. But most importantly, it's a $2 wide diagonal. The debit is less than $2, so it theoretically eliminates the downside risk in this particular strategy, which I think is important because, as Rick kind of highlighted, there's not a lot of price action, at least in the last year, below the current level. So if it is to continue to break down, there's not a lot of support levels to catch that knife, to use the old analogy, on the way down. So with this in mind, it eliminates that downside risk. It does increase the debit a little bit more than just a traditional calendar spread, but it will benefit, of course, from a move lower. If you're not bearish, you wouldn't look at this type of a strategy.
No.
You would not be obviously capitalizing on hopefully a move to the downside, obviously, if you're looking at that example trade. But now to shift gears and look at a completely different name, being Coca-Cola, which is definitely less volatile, at least historically speaking. We're not expecting as much of a move here just based on the options market. So Rick, walk us through this chart. Seeing some pullback from highs recently, but hey, this has actually been a really stable and steady player this year.
Yeah, that kind of describes these consumer staple type names in general. You wouldn't really go into this looking for big volatility and big swings here. But what we have seen is a pretty nice trend here. You know, we kind of didn't make a ton of progress in the first half of the past year here, but once we hit around here, we started trending upward. You can see here we've got our blue trend line accelerating our movement here, but it didn't last. Shortly after hitting our 52-week highs near 73.52, we started to trail off here. Now we've formed a downward sloping channel between our two white dashed lines here. In recent days, we have been struggling to kind of hold on to our two moving averages that we follow, our yellow 21-day and orange 63-day. You can see that our orange 63 was supportive, our yellow 21-day was resistance. Now we slipped below our orange lower boundary here, but we are managing to recover somewhat here. We also held on at this green line that I have highlighted near 69. That was a couple of low periods here that we encountered during our price action. So we held the line at a resistance area that stood out at least. So, or excuse me, a support area that stood out at least. So, you know, it could be worse, but definitely trending lower off those highs.
Okay, and how about momentum here? Because again, I can't imagine this name has, I mean, like a huge conviction, but at RSI, what are we watching again into earnings tomorrow morning?
Yeah, so we had some nice progress on the RSI during our rally to the upside, eventually topping out here, lining up with where we hit the high point for price. Since then, we trailed off a little bit. We formed our channel. The trend line on RSI doesn't match up exactly with what you're seeing in price here, but it's still a pretty similar read. You know, starting from this point, consistently being rejected at this area here, just kind of able to draw a straight line downward. We are below the 50 midline once again. Momentum more tilted toward the bearish side of the spectrum
to
here.
new low
What we
today.
would be looking for would be for the RSI to make new significant lows beyond a previous low as it struggles or eventually fails at a supportive area and breaks lower. That would be kind of the sign that you would be looking for bearish confirmation. On the flip side, though, what you would want if you were bullish would be across above that red trend line, invalidating it, and then also breaking back above that 50 midline here for the bulls to kind of reassert themselves in terms of momentum.
Okay, and last but not least, again, another earnings player, pretty much unchanged now on the session here, modestly higher, but as far as some levels we're watching, perhaps looking to recapture some old highs, what are we keeping on our radar for support and resistance?
Sure. So, like I had said, this green line that we have highlighted here, 69, low points, that's kind of an important area. And we did make a bit of a foray to the downside today, but we have recovered here. And now we are recapturing our orange 63-day EMA. So the 63 EMA, 69.39, then our green line, 69, right around those areas. That little zone gives you a supportive place to keep on the lookout for. If we were to get, some kind of bad earnings move, perhaps, and maybe start to push beyond the supportive area, another set of lows right here, our light green line, 67.80, pretty close to both the lower boundary of our white channel and our longer term trend line here that hasn't really come into play very much, but you can see starting here and here. That would still be noteworthy because it hasn't been breached just yet here. If we were to move to the upside, if earnings come in strong, if whatever, 21-day EMA first, 70.24. Then we had the high point after a gap down here, our red line, 71.43, and then the next high point, 72.75. So a couple areas of interest as you plan perhaps a potential trading strategy here.
Okay, yeah, and Coca-Cola, I will say, still actually outperforming a lot of these staple names. So great breakdown and great insight on the technicals. As always, Rick Ducat, our chart master. And now when we trade this name, say you were just looking for a lot more of the same, because I mean, we're not expecting a huge move by any means. I believe based on just the options market, we're pricing in, I mean, at this point, a $1.50 move in either direction. So looking to lean into a more neutral example trade.
Yeah,
exactly.
This is one that I struggle with when you look at a low volatility name around earnings. Unless you have a really strong conviction one way or another directionally, perhaps you just look for that neutral reaction. That's sort of par for the course for this style of stock post earnings. There's not a lot of volatility, therefore usually not a lot of movement. Without, of course, surprise. So what I looked at was buying a call counter, which oftentimes we associate with a bullish strategy, but I selected a strike that is essentially at the money, and it creates a more neutral risk profile. In this case, selling this Friday's 70 call, buying next Friday's 70 call, creating that time spread, looking to spend around 20 cents. That'd be only $20. So that's another thing too, Jenny, these strategies, we talk about aiming small, missing small, sometimes can be quite cheap relative to others. It may be something to implement when you don't have a tremendous amount of conviction or you have a very narrow potential outcome that you're focused on. So not the highest of probability trades, of course, because you need a specific thing to happen, but you don't necessarily have a ton of money at risk relative to other strategies in the event that what you thought would happen doesn't. The other nice thing, very customizable. If you are bearish, you are bullish, you have a different price in mind, perhaps a different strike would be available, and you can adjust this strategy to better suit that particular outcome. In this case, 70 is the best case scenario. That's slightly higher than the current share price, and it's been kind of a magnet for this stock for the better part of the last few weeks. So we'll see if that continues, and it has a chance to make a little bit of money on that $20 at risk.
Yeah, we'll have to obviously watch. Cope will report tomorrow morning. Will they be more of a Pepsi type mover with some disappointing guide, or will we continue to see some nice upside? The name's up 18% here on the year, but we'll leave it there for our Chartmaster segment. Now coming up next, time to talk a post-earnings move today in General Motors, which is up 9.6%, continuing to rip here on the session. The S&P 500's best performer today. We'll discuss what the street liked within their third quarter coming up next.
GM, huh? Ooh. This one guy's sounding really excited about it. I was going, what?
Empower your
GM. You have to say impressive. 3-year high. Woo! That's yearly. Here's your. So we get to 67, something like this. Right about in there. $54. You break it, we'll go higher. That's what Jimmy said. It's clear. He hates to do it, but it's debt. $49.78 support. Triple top break. I'm going to type in weekly. Wick. You typed that in wrong, but it's okay.
On the back of its outperformance this year, just goes to show when the bar is set high. I mean, we can always see some of these names consistently perform even better than expectations.
certainly the case, and we can see investors reward these companies for doing so, and that's the case for General Motors today, the best performer on the S&P 500, up more than 9%, as you said, after a beat on both the top and bottom line by a wide margin. In her letter to shareholders,
Your mic's not very loud today, honey.
through U.S. retail market share, well-managed inventories, and below average incentives. In terms of the actual numbers, adjusted EPS of $2.96 easily topped the $2.49 that analysts were looking for. Revenue rose by about 10.5% to $48.76 billion. Wall Street was looking for just above $44 billion, so a beat there as well. Total global vehicle sales fell 8.8% to 1.48 million vehicles as market share declined to 6.7% from 7.3%.
It's a pretty big deal.
In North America, though, sales fell less than 1%, about 0.8% to 790,000 vehicles, but market share actually increased to 15.9% from 15.8%. And then in China, which has been a weak spot, GM sold 426,000 vehicles in the third quarter with a 6.5% market share. If you take a look, that compares to the prior quarters, 373,000 vehicles, so a sequential improvement. But it's lower than the year-ago period's 542,000 vehicles sold with 8.3% market share a year ago. They did talk about on the earnings call how dealer inventory in China has been reduced by more than 50% from the start of the year, which it said will help with them to better manage pricing and costs. And they did talk about how the operating environment there continues to be challenging and that there's a series of shareholder and joint venture board meetings planned during the fourth quarter that will focus on restructuring efforts in that particular area to make the business sustainable and profitable. So they'll be sharing those next steps relatively soon. In terms of the outlook, GM actually raised its guidance ranges for adjusted EPS to $10 to $10.50 per share. That's from $9.50 to $10.50, so raise the low end of that adjusted EPS forecast. Sales are expected to be, or I should say, adjusted automotive free cash flow is expected to be around $12.5 to $13.5 billion. Previously, that was $9.5 to $11.5 billion. And then GM said it remains on track to achieve its 2024 EV production and profitability
much better.
So the previous target was for GM to manufacture about 200,000 EVs in 2024, so on track to do just that. Mary Barra, the CEO, said, "I'm proud that GM is delivering our best vehicles ever with strong financial results, but I want to be clear that we are not mistaking progress for winning. Competition is fierce, and the regulatory environment will keep getting tougher.
SPX, ooh, look at that.
Our internal combustion margins and working to make our EVs profitable on an EBIT basis as quickly as possible." So a fierce competition, but General Motors still able to surprise to the upside, and doing so on, pretty impressive pricing as well, given that, we know that, kind of falling demand, falling prices is kind of the name of the game right now for a lot of these automakers. Shares up about 9.3% right now, up 19% this month alone. And then take a look at the year-to-date figure, up 50%, up 83% for the past 1 year. So it's been a really impressive run higher for General Motors that continues today.
Yeah, a little bit of a delayed reaction too when the numbers dropped. Not much activity post-conference call and post some commentary from analysts like JP Morgan. It seemed that this was like a fine wine. This report got better with a little bit of age as the market really jumped after the opening bell. Caroline, Ryan Brinkman at JP Morgan talked about it being materially better than they were expecting. They talked about it being the company that is GM being on a roll with their go-to kind of execution strategy. So I thought it was interesting the fact that whenever we see those delayed reactions, maybe big investors coming in at the open as well.
Yeah.
Yeah. I think that also maybe
She said
the
it too.
Community is a bit delayed in reacting because you mentioned JP Morgan. I did see a note out from BNP Paribas, already had a buy rating, but kept a $59 price target. Basically just said strong results amid choppy demand and pricing environment. So not a lot of analyst movement after this report. If you take a look at the breakdown, the majority of analysts were already in the buy camp, but almost getting closer to evenly split. 15 buys, 11 holds, and then 3 sells. Median price target's $54, and GM is only 50 cents away from there at this point. So, it'll be interesting to see if analysts
now that they can process these results. The earnings call was this morning. If they make any changes to those price targets based on the fact that GM has had this impressive run higher. I will say the street high for the price target, the highest price target on the street is $88 a share, which implies a bit of upside. The low is $33 a share, but not a lot
The
in the way of
58,
analyst action
58
following
50s.
it. But I think that when you go in with a company, a stock that has risen so much heading into the report, which we saw with quite a few of the reports out this morning, you wonder if the bar is too high and if it could cause some disappointment. And we've seen companies, obviously different industry, but RTX, surprised.
Yes, the bar is too high.
Actually turned lower today. GM was quite the opposite. Despite these impressive
Get what you can.
gains, they're just adding to them. So
Right now they're at $5.
Good day to be a GM shareholder.
The 58.50s.
I was also looking at 3M was another one that was higher when I looked at it this morning, now lower on the session. So nice to see, this rally
See how
hold.
pretty
That's
that
exactly
is?
what I was thinking. I mean,
Snap.
9% plus gain has not really gave up, let up at all here on the session. So definitely a nice day, a nice year to be GM because as we know, they were one of the
570,
younger performers of last
590.
year. So appreciate the breakdown on this nice move to the upside. Caroline Wood, Senior Markets Correspondent for the Network. And now we trade this name, Alex, and I do believe, for example purposes, this is one of our most
I'm sorry,
bullish
G.
trades here today, and I think that benefiting, from a 9% jump on the back of its earnings.
We're going to have to kind of pipe it down for a second. It's 540 right now. Magnificent. Get the scorecard out. I accept. He's serious.
Often, that's sort of the loose guideline for these one in
Whoa.
the money, one out of the money spreads that are a little bit more directional in nature. Break even 53.75 is within a stone's throw, an arm's reach, if you will, of the current share price.
582.68 resistance
So
to
equal
break.
reward, break even kind of in line with the current share price. Going with
583.70 is next.
Now that's getting a little bit of fuel on the fire
Alex?
post earnings as the stock's making one of its biggest
Man, you're talking way too damn much. Okay? This is General Motors. Been around forever. Bringing up the fact that it's been bailed out by 3 different times by us taxpayers. And then how they screwed us over on this EV thing. Come on.
Next time to look at Seagate Technology, which is down.
We just hit.
% today into its earnings due out later today.
We come real
It's up
close
31%
on the SPY.
year. We'll discuss more on the overall
Watch.
tech trade and a lot of these names kicking off the semiconductor earnings period coming up next.
I had 583.70. Damn. You did it again, Jimbo. Dude, there you go. Bitcoin's down today, 410 points. Oh gosh. What's NVIDIA doing over here? AMD and Meta. Oh, Meta. Meta just had a new high. Meta new high. I said it. I think we need to go ahead and just remember that. Are you on the list, Meta? I have a problem here, a big one. I just took care of the problem. Okay. Jimmy's watching it. Is he trying to? Oh, we got a little pullback here on SPX. Okay, Jenny, are you going to talk?
Surprisingly performing quite well on the year, considering this is one I don't frequent. I know we talk a lot about these tech names and where they benefit from the AI story. This name is somewhat, I think, underreported. But as far as now expectations as we go into this print, they very much focus on this heat-assisted magnetic recording product, which is way more over my head than I could possibly understand. But we do know that AI has driven this demand for memory and storage to increase via data processing. So this is the world in which that falls. So they stand to benefit from this mass capacity drive, given the rising need for enterprises to capture more data. That's my understanding of this company, in case you're wondering where they fell in the AI world.
Yeah, and this is really good timing for the company as we watch kind of the AI boom work its way through different type of hardware products, different type of things, even like energy, as we try to build this infrastructure out to prepare for the future with so much power needed and so much technology needed to drive these models. This is a company that, if you were to go back a year ago at this time, actually lost money in the quarter that it's about to report. It saw tremendous declines in sort of that memory glut that we saw within the semiconductor and computer hardware
Think
world.
so, huh?
Well, this time around, it's expected to have really, really kind of almost explosive growth for earnings. It's kind of bouncing back here for the company. You're watching sequentially as it turned the corner in the second quarter, which was really the end of last year, their second quarter fiscally. So 3 quarters ago, it went back to positive EPS. It then tripled its EPS, and then tripled its EPS again. And it's expected sequentially from last quarter to grow around 40% quarter over quarter in terms of earnings. So really turned a corner a few quarters ago, and looking to continue to build on that as revenue expected year over year to grow almost 50%.
I mean, that's exactly what I was seeing, and I think that's a great point, because this is not necessarily a story of pure strength. It's more of a recovery story, especially when you look at, honestly, the 3-year chart, I think, illustrates this quite well, because as you can see, we touch all-time highs at around $117.67 a share. We have not been able to recapture that level. We only are about 4.5% off those levels, but still, all things considered, then you could look at the 3-year weekly chart and say we've gone nowhere in the last 3 years, which is not exactly the story you want to be the forefront narrative when you are in the tech and the over AI trade right now, because frankly, companies have been able to grow at a much faster clip, and I think the market is not as forgiving or as patient with some of these names that have seen their own specific hurdles. So they have seen profitability improve lately, as Alex mentioned. Operating margin has also been an improving story. We saw operating margin fall from 14% back in 2021 to 1% in 2023. Now in fiscal 2024, it improved to 6%, so that's a good sign. Going forward, operating margin is expected to continue to improve further. I was looking at like the street.
Very interesting.
On this name, there's 13 buys, 11 holds, 2 underperforms, no sells. But the average price target is around $117 a share. So
58.50s or 730.
All-time high. But of course, would imply about
40.
5% upside. Street high is 150, so that implies lots of upside. Low 65. So right now it does trade at about 16 times its forward earnings. It's actually a significant discount to the hardware sector at around 31.5 times, but the tech sector at around 34 times. So you could say right now you're getting things at a relatively good deal, but also it's a frustrating story when you see we haven't really gone anywhere in terms of its price in several years.
Yeah, and when we're talking about a turnaround story, one has to then wonder how much of the turnaround is already reflected in the price, which has made such an impressive recovery. Of course, when you were down at sub $50 in share price, that was sort of the peak of the uncertainty and that supply glut that we saw within this particular space. But we're basically back at the highs now. If it were to perform as the market suggests it may, with option prices targeting right now about a $7 market maker move, mean, that's targeting around 119. That would be a new multi-year high for this company. So effectively, if the numbers are good, it performs like the options are pricing in for a 1 standard deviation range, you're back at those highs, and then the question is, where do we go from here? Because the story, based off of how estimates line up, doesn't really start to slow down until really next June when we hear from their fourth quarter for this particular fiscal year. So acceleration continuing at least on the earnings front for a few more quarters, and then perhaps slowing down in the back half of their fiscal year 2025, which of course will coincide with the first half of calendar year 2025.
Yeah, and I think that's a good point as well, especially in this world that is, I mean, I read far too much about what this company does. It's deeply complicated, but all I know is that it's expecting to see this demand for these HAMR discs, and that's the world in which it sort of carved out its niche. So we'll be watching those results when they report today after the closing bell. We will leave it there. However, now coming up next, time to talk another name with earnings on the docket. That's AT&T, earnings out tomorrow morning, seeing some pressure today as a result, I can imagine, of Verizon's weakness. But we'll discuss what we can expect for this telecom company with George Tillis coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back to Next Gen Investing. It's time for Under 30 today, looking at telephone, of course known as AT&T, but the stock ticker T. Joining us now, George Tillis, Senior Markets Correspondent for the Schwab Network. George, one of its peers in Verizon, disappointing the street, or at least that's the reaction. Maybe some sympathy trade here, but one thing in AT&T's case that's a little bit different is it's really been focusing on sort of like, I guess, focusing its business on its core things, which is kind of internet services at home and wireless services. No more HBO and all these other things that it had going on in the past.
Yeah, that's the thing. That, you know, this whole story with Warner Media and even DirecTV, and that essentially didn't create a lot of value for shareholders. And you're right. If you look at the business now, it's gone back to its roots. Instead of fixed line, which it still has a fixed line telephone business, it's now wireless, of course, and of course the internet access or broadband services they provide, and it's rewarded shareholders. There's also another factor involved. If you look at the charts of AT&T and even T-Mobile going back to late May, T-Mobile is in the process right now of purchasing U.S. Cellular, and in fact, it's actually helping AT&T as well. What this is, the market is basically telling us with this about 30% move since May is that more consolidation in the wireless space makes pricing power more intact for fewer competitors. In other words, there's an oligopoly being established here with Verizon, AT&T, and T-Mobile, which, by the way, also bought Sprint many years ago. So further consolidation speaks to better revenue streams and more visibility in revenue as well as earnings. And this company still continues to execute from that standpoint. Now, if you look at the quarter, they're going to report for fiscal Q3, 57 cents is the expected print for earnings per share. That's actually down about 9% compared to 64 cents last year. But revenues are expected to be slightly higher by less than 1% at $30.45 billion. And I think the elements behind T-Mobile's acquisition, which is still going on right now, of U.S. Cellular, is actually going to help firm up the marketplace, especially with U.S. Cellular divesting certain assets, including towers and some of its other communications infrastructure to other companies like Verizon and AT&T.
So George, I'm curious, I know this has been outside of like the world of earnings, but if there's any impact from, like, we talk about this so-called super cycle, and I mean, I feel like this is the most I've heard people talk about their carriers in forever because they're upgrading their iPhones. Obviously, this is very much in the world in which I operate in, but I'm curious if that has any benefit in the near term to like an AT&T, Verizon, T-Mobile because of this interest in replacing your previous phone.
Yeah. Well, I think, when it comes down to replacement rates, they don't necessarily make a lot of money on new phones, but they can bolt on different services. A lot of times when people update their phones, they may update their family plan. They may end up changing their calling plans, which actually may be beneficial for AT&T and all the other carriers. So I do think there's some element of the cycles into which folks or consumers update their phones being a benefit. It may draw folks into their stores. They may buy accessories. You get my drift. There's other ancillary things that could be bolted on from a service provision standpoint. So I think that's certainly a catalyst. But what I actually see with AT&T is really stability. Outside of the last 6 months or so, which again I suggest was a conditioned move based upon further concentration in the industry space and essentially market power. The profitability profile for this business is stable, and it pays a generous dividend of about $1.11. It's a 5% dividend yield. The expectations for full year earnings this year is about $2.20. Next year, $2.28. So they're incrementally growing their earnings and revenues, but they're paying nice dividends, and it's a very profitable business now. And I think what they've done is a collective unit is really focused on what they're good at, which now is wireless and internet services.
Yeah, well said, George. When you look at that, I mean, I think that's the thing that we forget about too, is it's not just wireless, it is the broadband, particularly that move towards their fiber service that they're offering now, and it seems to be pretty well sought after in those different areas and communities where that's offered. So we'll see if they can continue to kind of drive forward this more focused AT&T into the future. One has to think interest rates impact these more income-driven investments as well. So we'll see how things shape up on that front. But George Chalis, we appreciate it as always, senior markets correspondent for the Schwab Network. Jenny, this is becoming a theme lately. We'll start the show, we'll have nothing happening all day, and then it totally changes over the hours. So we have green on the screen now. So a nice day for bulls shaping up here as the day rolls on.
I know, ask and you shall receive. I was saying how boring today was, and look at this. We're firming up here in 3 of the 4 major averages. So seeing some green, we'll have to see obviously where we close out today's session, but we'll leave it there. For Next Gen Investing, coming up next, we have the Watch List with Nicole Petalides.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Let's jab it
Stay
out.
informed, stay ahead. Tune in to our election coverage on Schwab Network.
Doo-doo-doo-doo.
The market is a multi-trillion-dollar beast.
Beast.
There, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Shot of whiskey, baby.
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales. Turns out, I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Question.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
No.
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Welcome to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange at 2 p.m. Eastern Time. We're glad you are with us. In fact, we've seen stocks turn into the green. We've had some back and forth action today, mostly red in the morning, and today, right now, we're seeing some green after yesterday's selling. Jay Jacobs from BlackRock is here to discuss the launch of 2 new ETF focus on expanding investor access to technology and AI equities. We'll focus on recent developments in China's economy with the boost from its latest stimulus stalling from the gains it saw last month. And our panel standing by to break down earnings from regional banks and how investors have reacted to the numbers so far. That being said, here's a look at the numbers. We did talk about markets under some pressure yesterday and today. This
That's looking nice.
Because of some high yields too. Yields have been moving higher. We watched the 10-year go above 4.2. Right now it's sitting at 4.2. Markets have adjusted and now back in the green here. So you're seeing the S&P at 58.57, the Nasdaq up 0.25%, and the Dow is up 0.2%.
Oh, these are 1060.
Fading down 0.25%. Oil and gold are both higher. The VIX is at 1840, and oil's at 72.07, and gold is at 27.61 a troy ounce. We've been seeing record highs for gold. Bitcoin 67,330, and the U.S. dollar holding that 103 handle, 103.88.
Boing.
For some of the biggest stories in the markets, we welcome in Kevin Hanks, host of Fast Market here on Schwab Network. We have a lot of earnings to get to this morning, and we got to throughout the morning. And so let's start now with this afternoon. General Motors is a name that you've been watching closely. Tell us a little bit about that story.
Hey, Nicole, yeah, earnings are starting to roll in, and the pace is starting to pick up. General Motors came out with earnings this morning. Their numbers, $2.96 a share versus $2.49 estimates. Revenues, $48.76 billion versus $44.3 expected. Revenue growth, 10.5%. Adjusted automotive free cash flow of $5.8 billion. Net income margin, 6.3%. You know, it looks like GE that has streamlined its business from as many as 32, 33 models down to about 4 or 5, and this new lean General Motors focusing on not only internal combustion, not only electric vehicles, but hybrids as well. Seems to be hitting the right note and coming into the sweet spot. The stock currently
looky.
9.6% as we get to midday, Nicole.
Wow,
Randy,
nice move there for
1390 ring a bell.
We talk about
1410. Excuse me.
Some of these defense stuff.
Could I ask you to be quiet for? I don't care. Right now we're watching something with 1420, the 5850s, 1440, 70. What would you do in a situation like this? Randy? What would you do? What would you do? Look at that. Don't jump in now. It's too late. $13.90, $1,400. I think that's good enough. $14.60. This is what we were waiting for today. So he looks over at the put side, and the crowd is wondering, Jim, what are you going to do? I'm going to go over there to the 5850s, and don't tell nobody this, but I'm going to grab 5 at $1.45. So you got to be shh. The crowd doesn't know what to do. I just don't know what to do right now. Strike is that and right now you're at 185, so you can make a business decision. You went back to the 9. If you breach the 9, oh Lord. This 9 right here, that's the 9. We'll go to 57.76. If we breach the 9, Nicole, leave him alone and interview me, please.
We have election uncertainty. We talk to companies.
Election
Companies are
uncertainty.
pausing
Finally,
hiring,
someone
pausing
says it.
projects, pausing M&A activity until we get more clarification after the election. They're putting hiring on hold. They're delaying. There's all this economic uncertainty. Also, if you look at third quarter earnings, I know we've seen some pretty good numbers so far, but keep in mind, FactSet, who provides earnings estimates for us, they've revised their guidance from the beginning of the third quarter from 6.5% down to 3.5%
Yes.
for third quarter earnings year over year. That's a pretty big drop in earnings. And then, of course, throughout all of this, high valuations. The PE ratio in the S&P 500 is about 22 times forward earnings, and we have high expectations, and we have high concentration.
What time is it?
The top 10 names in the S&P
Okay,
500 are 35% of the S&P 500.
8 minutes after
If I
2
pull back
Eastern.
One of those names, watch out. Increasing volatility. But the good news through all of this, we've been saying this since the October correction of last year. We've been saying this all of this year. Even if we have a pullback, even if we have a correction, and again, a correction happens once a year. It's a normal part of investing. We do believe it's a huge buy the dip opportunity because we don't see a bear market because we don't see a recession. You need a recession for a bear market. Also, earnings look great next year. Lots of cash on the sideline. Again, all those together, buying opportunities.
So you say a dip, you're buying financials, healthcare, industrials?
Love those
Can you
sectors.
explain that?
Yeah,
If you think names, but what kinds of financials?
Now we're at 185.
You say financials, healthcare, industrials.
Sure. I think if you look at everything
You make
right
a
now,
business
whenever the Fed
decision.
shortly cuts rates, market breadth.
I think we
widens.
go
So
down
market
more.
breadth widening. That's going to push us into a little bit more small caps, a little bit of an overweight to value. Within those value sectors, again, as we said before, financials, healthcare, industrials. I think of all those three sectors, my favorite now is healthcare. Healthcare, you get defensive growth. Healthcare does well in a potentially divided government. Historically, whenever we've had a divided government, healthcare has done pretty
Now's the
well.
next idea for
And
sure.
if you look at
Oh,
what
I forgot
Harris and
something.
Trump are proposing, they're not really proposing any major healthcare reform. Earnings expectations for healthcare may have fallen a little too much, and you're seeing earnings revisions rising a little bit faster for healthcare than the broader market. And of course, you got the big one, aging demographics. I'm getting old every single day. I'm gonna need more healthcare. Healthcare looks so attractive, especially after struggling for the last few years. So within healthcare, pharmacies, pharmaceuticals, hospitals are great opportunities. Long-term care are great opportunities within healthcare in particular.
Yeah, all right. At this point now, I like what you're saying, but the earnings season, we have a slew of the Mag 7 coming up. We have a big, let's say, next 10 days or so, right? What are some of your expectations there? What are you watching?
Yeah, I'm watching the Mag 7 carefully. I mean, I do think probably the more important data points, of course, are going to be the election coming up, in 2 weeks now. We also have, of course, we also have, the payroll report coming out, especially next week. But with all this said, though, I think earnings are going to be pretty
225.
good.
Ooh.
Revisions have been revised a little bit lower. I know FactSet lowered earnings estimates, but again, that makes it a little bit easier for companies to beat expectations. And keep in mind, even though the Fed has been cutting rates on concerns about the economy has been stronger than expected around services, around the consumer, around retail, around even hiring, especially in more cyclical sectors. That's a good sign for earnings for this quarter. So long story short, we think earnings are going to be pretty good this quarter because there's no
Right here.
guidance.
Right. All right. Gene Goldman, great to see you. Chief
Great to see you
Investment
too.
Officer at Cetera. Gene, thanks.
Good job, Steve.
Options Corner, Tom White is standing by. He will highlight unusual options activity we're seeing.
Talk the market down.
How investors are looking to trade on recent news of GE Aerospace, Tesla, and Microsoft. Stay with us.
Uh-oh. $58, $52.50. Are we going to see it? Jim says yes. Long shot. Get out right now. Lotto 5850s puts at 145 are now at 225. May I have another grade, please? I'm not out. I want to go up another big candle. It'd be like $1. Okay, now we can see some replica on the price here. Uh-oh. Uh-oh. Randy. $275. There it is. $290. Come on. You can drop more. You're not done yet. Let's take it to $350. Jim's still holding on. If he sees 3 1/4, he might get out. Mm-hmm. Uh-oh. 320. I think I'll take that. I think I'll take that. Randy's not here. He's missing out on a good day today. I mean, look at it. It's at what? It's at 225 now. I don't think we want it to break.
And the only piece of let's say, weaker news was about the commercial engines business that came up short. But the big picture is the stock more than doubling in the past year. Maybe investors were hoping for more or taking some profits here, as you were saying, Tom. So, but it's the commercial engines business that I guess we'll have to focus on going forward. How about Tesla, which of course has been all over the place, and we're waiting on earnings too. Bullish trade?
Yeah, it's been choppy recently since that that We Robot event that they had, where kind of disappointed investors. It slid since then. Remember, this stock was trading over 260 bucks going into that event, but you see there on the far right, this stock's been pummeled recently, down about 12% so far this year. They've got earnings tomorrow after the close. I think this is going to be a big catalyst. The option market's pricing in about a plus or minus 6% move in the shares, about 12.5 bucks either way on this. And now this stock's got a high beta, so typically we see big moves in Tesla post earnings, so you got to keep that in mind. Expectations of about 490,000 cars moving forward into the end of the year. And if you look at some of the numbers that they
Tesla earnings after hours tomorrow,
3,000 cars delivered. That kind of appeased a lot of the shakiness from investors after they released those. But their operating profit margin's been shrinking. That's down to 6.3% last quarter. They're expecting that to pop back up to 8%.
Very good.
And then automotive gross profit margins, excluding the impact of regulatory credits, similar story. That fell to 14.6% last quarter. That was down about 3.5 percentage points. Now, the street's expecting anything above that 14.6, what we had last quarter, anything above that. So if their margins start to increase a little bit, the street's probably going to like that. So this typically trades pretty volatile into earnings, but we did see some call buyers in here, probably setting up for some an upside surprise here to earnings after this pullback that we've seen over the last couple of weeks here. In the October 25th weekly cycle, so really short-term positioning, just 3 days to expiration, you'll capture that earnings event. Trader bought 10,000 to 220 strike calls, paid an average debit of about $5.70. So the break even just above 225 over the next 3 days. That's only about 4% above the current share price and within what the option market's pricing in as far as a 1 standard deviation move. So a lot of call activity in here today. People probably setting up for some type of move. This trader is setting up for some bullish activity post earnings.
All right, we will see. I mean, so much has gone on, and what happened to 271, the high that we saw? How about, last but not least, Microsoft in the AI revolution? We found someone with a bullish trade.
Yeah, this one's been languishing a little bit, of like a couple of the other Mag 7s, but you don't hear about Microsoft that much. It's up 2% today. It's having a great day. Probably on the back of a note that came out of Loop Capital where they raised their price target to 500 with expectations going into earnings on the 30th that they're going to be good, that they're going to show their business and sales expanded at a rapid pace. Azure growth is going to at least consolidate, if not re-accelerate a little bit. So seeing some call activity in here. And if you look at this, the all-time high was about 468 bucks, and that was back in July. So we've been, just kind of consolidating, trending a little bit lower. But I think the earnings are going to be a catalyst here on the 30th. I think that's what everybody's waiting for. What type of return are they expecting on that nearly $14 billion that they've invested into OpenAI? What type of return can they expect from that? There's some some underpinnings that the relationship is getting strained a little bit. So maybe we'll get some clarity on that. But they did just release some new Copilot features using a Copilot agent. So maybe that's going to be something that they're going to focus on as far as guidance moving forward. But did see some unusual option activity, probably setting up for a positive earnings event here on the 30th. Trader bought 2,000 of the November 450 strike calls, paid an average debit just under $5 on these. So the break even just under 455 over the next 24 days. That's only about 6% above the current share price. So not a pure earnings play for the earnings on the 30th of this month, but giving themselves a little bit more duration on this. It's held its 200-day moving average on a technical basis over the last 3 months. So that might be serving as a good base here for these traders. But this trader thinks that, hey, earnings is going to be a catalyst to the upside. And over the next 3.5 weeks, we're going to see this stock back above 455.
Meanwhile, they were saying over at BMO that they don't necessarily love the Copilot, that it basically feedback from Microsoft 365 Copilots remain muted. We think it limits revenue upside overall, and they took Microsoft off as a top pick. So it's not saying that they don't still love it as a buy, but that it's no longer a top pick. But definitely one to watch, and we have a bullish trade here, so some optimism there. Tom White, wonderful to see you. Thank you for all of those bullish trades today in Options Corner. Coming up next, we will take a look at global economy, including why our next guest believes China's stimulus is a make or break moment here for the Chinese economy. Stay with us.
Trading at Schwab is powered by Ameritrade, bringing you futures and forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades,
Hmm.
a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Tesla had a little bounce up there.
Welcome back to the watch list. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. The Dow is up 55 points right now after having been down throughout the morning. Here's a look at some market movers for you. We're watching First Solar closely, moving higher on the back of an upgrade over at Citigroup ahead of the third quarter earnings on October 29th and the U.S. election. The firm upgrading the shares to a buy from the neutral, raising the price target to 254 from 200. Citi adding Solar could benefit in almost any election outcome. Adding a Democratic win may drive sharpest recovery, and Republican win will likely drive higher tariffs, resulting in a long-term recovery. To the downside, there's Deckers Outdoors. Now, this is lower. We saw BTIG downgrading those shares, and they were downgraded to a neutral from a buy without a price target. Firm sees the stock's risk-reward is balanced after channel checks picked up a slower start for the holiday season for Uggs. The checks also showed signs of Hoka growth moderating as competitors are playing catch-up. All right, it's time to focus on the global markets. Of course, we're focusing on China and the stimulus. Of course, it gave a big boost to a lot of those Chinese stocks and even commodities and things that trickled out. But now, joining us right now, Ben Harbour, Portfolio Manager, Core Values Alpha, straight from Beijing. I think this is a special guest to have. Ben, thank you for being here. You know, we were just talking about the Chinese economy, and I know we just got a recent boost and tons of stimulus. But prior to that, okay, because I still think you're going to tell us about some worries, but it just has been slower, right? Slower growth, or what would you say?
It's to be expected. I mean, we're a maturing economy now in China. It doesn't have that same 10% annual growth rate that you would expect, or that people had come to expect. And so, with that slowing economy comes more of a 4 or 5% growth range, and stability. And China continues to grow in a lot of those kind of fifth industrial revolution verticals you mentioned: solar, batteries, EVs, anything kind of manufacturing, hardware. So 5G hardware, mobile handsets, but still obviously slower than expectations and slower than people had come to be accustomed to.
And do you think the stimulus is working?
We're starting to finally see it trickle through. So people had a bit of a spring in their step that week of Golden Week when they saw the stocks pumping upward. The objective here is really to kickstart the economy. It's not to solve all the ills of the Chinese growth model. So it's to get people to feel that their stock portfolio is going up, that their home equity value is stable and going up, and therefore they can spend a little bit more on the high street. And we saw relatively positive data come out of the Golden Week period where people were spending more, traveling more than before.
Right. There were a lot of folks. Last week was sort of choppy because there was a lot of folks who were expecting more, right? There were folks who were betting on some of the stocks in hopes that China would provide some stimulus, which they did over a couple of days. And then there was this pause. And then now people are worried that we're not going to get more stimulus that they had hoped. Would that be on point? What would you say?
So I think people's expectations were higher than at least the reality at the moment. People are throwing around numbers like a 10 trillion yuan stimulus, and instead they got 200 billion. And
right.
I think it was just inflated expectations that drove stock prices way beyond where they should have risen. The Chinese move obviously came unexpectedly off the back of the American interest rate drop, but our view is that these stimulus kind of drip feed will continue, and you're seeing day-by-day policy initiatives.
I mean, even here at home, Goldman Sachs is sort of being a little more tepid on its outlook overall. I mean, there are people who are worried about the U.S. stock market. Do those have a connection?
I think they've become decoupled over the last few years. And in many ways, the American market, I would say, is more primed for a drop than the Chinese. The Chinese has been trading really at rock bottom. There's a lot of levers the government can pull to stimulate.
Leverage.
Going through an election cycle. There's a lot of reasons to feel that there's a stable upward momentum now.
What do you say to folks who are nervous to be investors? People like to trade the Chinese stocks. They're nervous to be investors in the Chinese stocks. Does that have merit?
Yep.
It's certainly been a little bit more unpredictable than the U.S. market, and the Chinese government hasn't done a great job of foreshadowing and forecasting even like the stimulus to let people know that it's coming. But generally speaking, I think China today has the best potential of kind of 4 or 5x type returns because of where we're trading on the lows, because of where it is kind of within its cyclicality, because of the scale of the economy, and just how irrationally and unfundamentally depressed these stock prices are relative to their true valuations.
So how can they find value? I mean, if an investor is looking to find value, China has been a growing country, as you noted, maybe not 10% anymore, but still sees the growth. If investors are looking for opportunities to invest in China, how would they go about that?
So we like the public markets. We've obviously created our own ETF called CGROW, China Growth, which taps into what we believe are the key consumer trends within the Chinese market, some of the top enterprise companies, as well as the way consumer behavior is gravitating, so more towards domestic brands, domestic travel, and those are all net beneficiaries with this economic kickstart.
So we'll watch for CGROW. And what about the EV market? Obviously, they get subsidies to be able to manufacture there and get those out. What about some of those names that people love? And Warren Buffett loved BYD. And we've seen XPeng and NIO. What about some of those names? Do they have a good outlook?
I think so. We were early investors in NIO on our private funds, and we've continued to invest in the public side as well. These are businesses that have such
very good point
than their U.S. competitors. NIO just announced last week as well that it's going to start manufacturing in other markets like the Middle East. They're opening up showrooms in Western Europe. So these companies are going global. BYD is already global, and they have an integrated supply chain, and again, really superior technology at a low cost point.
I wanted to go back to CGROW. So it's CGROW, Greater China Growth ETF. So what kind of names are in that ETF? How often is it being rebalanced, etc.?
So an active ETF, our view is that China is too nuanced a market to simply put on autopilot and trade passively. And so we're moving in and out of names every 2 days or so, and moving in between the A shares, the H shares, and the ADRs. And we have focused particularly on a lot of those key consumer names that we thought would be attracting a lot of this capital flow as a result of stimulus. So some of our biggest positions are Pinduoduo, the maker of Temu, names like BYD, as well as, of course, Tencent, the gaming and consumer internet giant. So we think these are the types of people that will be the first wave of recipients of growth after the stimulus.
Real estate was a really tough part of the Chinese market. I feel like that was the first to start to blow up, right? At this point, are we seeing a little bit of a recovery on that? You said people are feeling like maybe their home is valued a little more.
Yeah, the numbers would say they are. If you follow the Hong Kong listed, the A-share listed property developers are doing better. And that's because the Chinese government is taking lots of these policy measures to lower interest rates, lower the costs associated with mortgages, ensure that people can buy where they were restricted previously from buying more than one home in certain geographies, so making it easier to buy.
So now, in the next 6 to 12 months, I mean, is this the make or break moment? What would you like to see as far as policy? You actually reside there or spend a lot of time in Asia, in China in particular, in Beijing. Give us a sort of your vision for 6 to 12 months out. What are some of the trends we may see?
I think this is make or break for the Chinese government. China could easily now settle into kind of a Japan-esque malaise if they're not able to very quickly restabilize global investor attitudes towards China, and of course have these stimuli impact consumer behavior in a positive way. And so our view is that they are very keyed into that. Maybe they were a little bit more, let's say, blissfully ignorant of it a year or so ago. But today, it is the key driver for all policy. Everything they do talks about stimulus. And their really stability as a government rests on improving the economic livelihoods of their citizens. And so I believe we'll continue to see a sustained stimulus, and hopefully that'll show in the consumer numbers and global investor appetite.
Yeah, I mean, obviously, and for the people too. I mean, they feel better when they have a better economy, right? I mean, that's so obvious. But thank you, Ben. It's great chatting with you and hearing your firsthand experience too. Ben Harburg, Portfolio Manager, Core Values Alpha. Thank you for being here. Still ahead, BlackRock has expanded investor access to technology and AI equities, launching 2 new ETFs. Jay Jacobs from BlackRock will join us and tell us all about them. We'll be right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical
Robust
studies.
charting and
Tailor
analysis.
platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights.
He's on to something.
Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalides. Today, BlackRock expanded investor access to technology and AI, launching 2 new ETFs. We want to hear all about this investing theme. BlackRock does see AI as a mega force with broad investing implications, both now and long term. So let's hear what the pros and cons may be. I'm sure there'll be more pros. Let's see what Jay Jacobs has to say about all of this. Head of thematic and active ETFs over at BlackRock. Good to see you. Thank you for being here today. The AI revolution, I keep hearing about this. Is that where you stand on this?
Exactly. I mean, we see AI as one of these really powerful mega forces that could create, up to $15 trillion worth of opportunity in the economy right now. And that means there's a lot of opportunity within investing, but there's also a lot of nuance to it. And so the reason we're bringing out BAI and Tech, 2 actively managed ETFs run by our portfolio manager, Tony Kim, is to really navigate some of these structural changes that are happening in the technology space today and for the foreseeable future.
So tell us about the ETFs that we're featuring here today. What are the ticker symbols? Why were they created the way they were created?
Sure. So the first is BAI, and this is a specific artificial intelligence strategy actively managed by Tony Kim. And the idea here is to really look across the AI tech stack to find opportunities to invest in this megaforce. This means looking at infrastructure companies that are playing into data centers, power infrastructure, and semiconductors. This means looking at large language model developers and proprietary data owners that are really building some of these really impressive AI models. And then also it's looking at the application layer of companies that are starting to integrate AI into their businesses. So Tony and the team have the ability to really look across the AI landscape and identify who the winners might be in the future across this AI tech stack. Now, the other product is TEK, and this is more of a tech sector replacement strategy. It's going to be a bit broader, but it's still looking at some of the highest convictions ideas in technology, both looking at some of those mega cap tech stocks as well as some emerging tech stocks that might be the future leaders, whether that's in artificial intelligence or whether that's in some other technologies that are emerging. But I think overall, what we're seeing is just so much opportunity and nuance in the technology space right now that we're really focused on bringing out active strategies that can help navigate the opportunities in tech.
Yeah. It's interesting because you talk about all the things that are happening, right? The data centers, the growth, the infrastructure needed, the power needed, the opportunities that lie ahead for tech going forward and the creating that is happening. You mentioned $15 trillion worth of opportunities, so you want folks to get in. Is now the time? Are people going to feel in 3 months or 6 months?
A little triple top on SMCI.
Wait.
We think it's still early, especially in artificial intelligence. I mean, this theme, really only hit this inflection point if you go back to November 2022 when ChatGPT came out and really kickstarted this generative AI revolution that we've been experiencing. But still, if you look further out, this is a multi-year, decades-long plus theme that is going to take time. I mean, just think about where we are today. A lot of what is happening right now is building out of that digital infrastructure. And this isn't a software game necessarily. This is shovels in the ground, building real estate, building power generation, manufacturing semiconductors. These are things that take time to produce so that we can build all that infrastructure to really set up for an economy that is going to increasingly integrate artificial intelligence. So we know this megaforce is going to take time, yet at the same time, investors are looking for solutions today for how to position their portfolios to anticipate these changes in the future. So we believe this is really the right time to bring out these products for investors.
What kind of risk is involved? If people ask you that, what do you tell them?
Yeah.
Well, I think where there's more uncertainty is in the timeline of artificial intelligence. We know that the technology has some really impressive characteristics to it. We see a lot of interest in adoption, particularly in the enterprise space and the consumer space. But it will take time to adopt artificial intelligence. It'll take time to build the infrastructure. It'll take time for people to get comfortable using this technology, to integrate it into existing processes. whether that's 2 years, 3 years, 5 years. I think there's some room there for debate. And so I think that the exact timing of when this theme is going to play out is where there might be some uncertainty. But we do feel a lot of conviction that over the long run, artificial intelligence has a tremendous opportunity to contribute to economic growth and generate outsized returns for investors.
How do you quantify? I mean, thematic investing is one way to talk about this, and ETFs in particular, and the fund flows that happen for that. Certainly, ETFs have grown in popularity over the last decade or so. Used to be only mutual funds that people talked about. Now it's ETFs. Do you expect that they will continue to grow, be more prevalent, and what do you think is the draw?
Yeah.
Well, we're seeing for a lot of investors, ETFs are the vehicle of choice. That if they are an advisor building a model for their clients, if they're end investors looking to make portfolios on their own, ETFs are increasingly that vehicle that people are using to express their views.
Be okay.
That can be using tickers like IBV, which is just getting really core U.S. large cap exposure, or getting really specific into themes like artificial intelligence with BAI, or even looking at income strategies like IBVW, where you could generate additional income using a buy right strategy. So in many ways, there's so many different flavors of ETFs, but increasingly investors are using that as the vehicle of choice. We continue to see this trend growing across basically all client channels as ETFs continue to grow in popularity. We see a lot of these tickers getting more and more liquidity and really being that vehicle of choice.
What's the overall on the market? You have a general market feeling at this point?
Well, I think there's a lot of reasons to still be excited about where we are in the markets. I know we're near all-time highs, but you still have over $6 trillion being held in cash on the sidelines. And as you see investors get more comfortable with rates potentially coming down, maybe some certainty after the election of kind of the direction over the next few years, you can see more people getting back into the markets and starting to deploy that cash. Some of that might find its way into fixed income ETFs. I think others will be looking more opportunistic at growth opportunities like artificial intelligence. But I think there's going to be really kind of a wave of confidence towards the end of the year as we've really seen kind of a really kind of a soft situation in the economy in terms of there's no real major risk of recession at this point that we see, and it's giving people confidence to invest.
Great to see you. Jay Jacobs, thank you, of BlackRock.
Jacob.
And TEK and BAI. Appreciate it. Thank you.
You're fired.
Still ahead, we will speak with our panel.
See you later.
The banks, the regional banks in particular, after the earnings have propelled those stocks forward. What's ahead for the group? Let's have a discussion. We'll be right back.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly. Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free.
Yep. That's what's going down.
Schwab Network. Welcome back to the watch list. Time to focus on the regional banks. We've seen some recent earnings, and overall financials have done very well in earnings season, the regional banks as well. Let's bring in our panel to see what they like, maybe don't like. Alexander Yoakum, equity analyst at CFRA Research, and David Cheverini is with us, Managing Director, Equity Research at Wedbush. Thank you both for being here. Alexander, why would you surmise that this group is doing well in the first place? We all remember last March, way back when, and the scrutiny that was put on this group. So different now, right?
Yes, absolutely. I would say the biggest difference is today, investors are really looking about what could go right, whereas last year it was all about what could go wrong. If we think about the environment, from a deposit perspective, it's much more favorable. Uninsured deposits definitely aren't an issue anymore. That's sort of, gone to the back burner. In terms of areas like commercial real estate exposure, most regional banks have cut their exposure, so that's less of an issue. Also, with rates likely coming down, we would expect, less strain there from a credit quality perspective. And then also, just in terms of capital levels, banks are much more capitalized now than they were last year, so there's less concern there. There's also been some positive regulatory developments, so there's a good chance that regional banks will have a less need for capital than previously expected. So there's, I think, some optimism around share buybacks as well.
Very good.
Yeah, and look, the lower rate environment, theoretically, granted, we're lower than we were, but that lower rate is coming down slowly. Folks are anticipating more of a lower rate, that's for sure. David, what are some of your thoughts? How do these regional banks benefit from the lower rates, which we're expecting more and more of, and the other points that you would say makes this group a good group?
Yeah, so lower rates, what could be really beneficial is a steepening yield curve. We're finally getting a little bit of shape to the curve, and hopefully that continues. At least the forward curve is kind of implying that, and especially seeing the 10-year Treasury yield now up at 4.2%. So if we get that upward sloping yield curve, that'll be nice for net interest margins. The other is lower rates can stimulate loan demand. Loan demand has been anemic and weak over the past few quarters, particularly here in the third quarter. Lower rates could be a really nice catalyst to really get loan growth going and generate some earnings growth.
I always think when something's going to happen, sometimes it's slow to happen, David. Lower rate environment could stimulate more demand for loans. How quickly does that happen?
Yeah, it's going to take a few quarters. In talking to bank management teams, it seems that the hurdle rate is about 100 basis points to really see that growth demand really kick in. And based on the forward curve, we may not get to 100 basis points until the end of the year, right, or early 2025. And then the first quarter of each year tends to be seasonally weak for loan demand to begin with. So we're probably looking at spring of 2025 where we see an upward swing in loan growth.
So we do have, you mentioned this earlier, Alexander, you did talk about the capitalization of some of these banks, that they're more well capitalized. Those deposits are less of a worry. In fact, Janet Yellen, our Treasury Secretary, actually confirmed that, saying that banks are in fact well capitalized. So at this point now, do you have certain picks in the group? There's so many regional banks that you think could be the leaders or the winners for investors going forward?
Yeah, absolutely. I would say probably our top pick right now, regionals, is M&T Bank. This is a bank that was sort of dragged down over the last few years by elevated commercial real estate exposure. But like we mentioned, we do expect that to be less of a drag. As rates come down, it will be easier for refinancing, and we do expect credit issues to be less. Also, M&T is actively cutting the commercial real estate exposure that they do have. So with less exposure, we think the Fed actually might lower their capital requirements. So that could happen potentially next year, which would leave them to have more capital for loans and buybacks. So we think they will cut their shares because they're well capitalized, shares outstanding that is. And then we do think they'll lean into loan growth once that comes. I do agree that we likely won't see much demand, this fourth quarter, maybe even the first quarter. But after that, we would expect, with election certainty and lower rates, that demand to come back. And for a bank like M&T, we would expect a solid growth there because they've actually had strong loan growth. It just hasn't been in commercial real estate. So they've seen growth in other areas, but commercial real estate, kind of like they've been letting that run off. That sort of masked actually strong growth. And once the commercial real estate is less of a drag, we think results will get better.
Not that one.
Yeah, and you also have Fifth Third on there, right? Alexander, another name that you like, is that correct?
That's correct.
Yes, we definitely like Fifth Third. So Fifth Third, they sort of got dragged down in 2023 with the other regional banks, but they really weren't the same. Their deposit balances actually barely fell. Currently, their deposit balances are near all-time highs. So we think that will be a beneficial. Again, when loan demand returns, they'll have the deposits. They'll have the capital ready to deal with those loans. And then I would also say they were dragged down by long-dated securities. So they have a large securities portfolio, which unfortunately they did invest in long durations. So that was a drag on them when interest rates rose. I know long-term rates are up a bit now, but generally speaking, long-term rates are much lower today than they were last year. Right. So that strain has come down.
Exactly. David, what names do you like most in the group?
Yeah,
and actually, I like both of the names that Alexander mentioned. Another couple that I like, Comerica, CMA. This one is one of the more liability-sensitive banks on a relative basis to the other regional banks. And what that basically means is a lower rate environment means that their net interest margin should perform better than other regional banks. And since net interest income makes up the lion's share of revenue for the regional banks, this is an important metric. So we like America. Because of the liability sensitivity, they're also seeing a nice remix on the deposit side of the balance sheet. They've been allowing broker deposits to roll off as they bring in core customer deposits that are lower cost. So we think that Comerica is in a pretty good position here relative to other banks.
Yeah, I would love to hear a little more, Alexander, about the Fed could lower the capital requirements. Of course, a lot of those requirements were put in place during the Great Recession.
Exactly.
Right? When you think about 2007, 8, 9, and what occurred during that time, and so on and so forth. Then we had the COVID and everything that's been on. When they start to lower the requirements, the capital requirements, will that be a good thing?
On everything today.
Yeah, so I was more referring to actually Basel III Endgame. So after the collapse of Silicon Valley Bank, there were some expectations that the entire industry would really see a big uptick in capital requirements. So it's not that capital requirements will fall from where they are right now, but it's that they will fall from the increased level that was expected. So over the last year, we have seen a little bit of an inclination that the capital requirements won't be as high, especially for more of the regional banks. If you look at the banks in the $100 billion asset to $250 billion asset range, the expectation is that basically Basel III Endgame will not apply to them outside of these kind of unrealized losses in securities portfolios. So just generally speaking, banks have really increased their capital. If you look at almost every bank, they do have more capital than historically. So that's why I'm saying I think they're well positioned for loans and buybacks just because they have extra capital. I mean, of course, generally speaking, lowering capital requirements does increase the risk for the banking system as a whole, but it also, can increase profitability. So it's sort of a mixed bag. You have to be careful, with capital for sure. You don't want to, just lower the capital requirements just for the sake of it.
Alexander Yoakum, CFRA, David Cheverini of Wedbush, thank you both for being with us. Appreciate it. I'm Nicole Petalides. Thanks for being with me here on the watch list. Glad you were able to join us. And keep it right here. Market on Close with Oliver Rennick is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography
You make too much money.
How did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Yeah, tell us.
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
No, I have not.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Oh, we got a knife here. Looks like it. Oh, looky.
Good afternoon and welcome to
One of them pits are now. I'm no longer in, but.
Left in session here, stocks basically.
Oh gosh.
Looking for some direction, better than this
450
morning.
now.
Got two indexes in the green. Had been a little bit of a sluggish start.
Yeah, good.
But really not seeing a lot of big movement here. Just kind of came back to the baseline.
Okay, Jimmy.
There's some movement in
Randy.
crude oil up a decent amount. You got still a little bit of sluggishness in some of the cryptos. Ethereum's down a bit. Bitcoin's not
SPX moving back to the calls. Prepare ye in the name of the Lord.
Reliable winners in some places, like big tech. But again, that too is a bit of a mixed cohort today with NVIDIA slightly lower. But Microsoft up a
58.50s.
It's a little bit of a sleepy session in terms of big themes. We did give you a little heads up this morning, though, that it could be a themeless day. And it kind of is so far. I think that was somewhat prescient. Good thing we've got good guests and smart people joining us to keep the conversation interesting and thinking about the rest of this week ahead does leave some room for some potential volatility. We've got some Fed speakers. We've got bonds wanting to sell off, it seems. Treasuries continuing to find sellers, and that is building a story for us, perhaps on the macro side. Earnings will be fun this afternoon. We've got Seagate and Texas Instruments to give us a look at some of the less glamorous semiconductors, but ones that are still relevant generally to the conversation. I think the most important thing is that yields are generally higher on the day. The 10 years at 4.2 now, so that steady creep has picked up the pace a tad. And it is a pretty big deal when you've got long-term downtrend lines that are breaking. I've been kind of pounding the table and beating the dead horse on the long-term chart of the 10-year that's breaking out a bit, and it does look like that's happening with some conviction here because there really wasn't anything this morning that would make bonds sell off. Richmond Fed was better than expected, but does the Richmond Fed really cross your list of important data points? Not usually. So the point is that the default state seems like for treasuries to slip right now. And without any news flow the last 48 hours, other than perhaps some Fed speak, the bond selling remains the most interesting thing to me. Now, equities, in theory, could be just fine with this, but it does suggest some trend shift, and maybe
we're at the 200 EMA.
Adjust somewhat. I think because of that, there are a few areas that are still a little soft on the day that are worth thinking about. But there's also just a quiet session compared to yesterday. A lot of the stuff that was much more actionable yesterday has calmed down a little bit. You got the dollar still holding pretty firm. You got regional banks down a little bit yesterday, but now firm today. So there's not a lot of obvious ramifications of the yield moving higher. The dollar obviously will be one of them, though, if we assume that yields in the dollar are going to stay intertwined, which they should. That's telling us the Fed's not going to be able to cut as much as folks thought. But the move is pretty intense. Like, that dollar really is ramped up. Is that going to make waves and make problems? Again, this is something that is up for debate. At this point, we had 1 day of selling yesterday, basically, and the stuff that was concentrated in selling, like the regionals, have bounced back today. Some of the value trades that got hit yesterday are firm today. So we're kind of in a bit of a hover mode right now, just sort of treading water. Not obvious what's going to move the market this week in any big way. If there's going to be something, perhaps a few economic print sentiment on Friday in durable goods, maybe. But at this point, that's why I'm watching the dollar and bonds as my main input. Some of the earnings tonight could be interesting for Texas Instruments and Seagate. The Mag 7 trade is solid today. It's green, but it's a little bit divided. If you look at the semiconductors on the year, you're going to see that today we're generally dealing with underperformers, which is not quite as exciting as NVIDIA, but Seagate and Texas Instruments, still relevant. Seagate is up 35% on the year, so it might be underperforming the basket, but it still is better than the stock market. So that seems like something worth talking about. Notice also the disconnect between Texas Instruments and the whole group is that's your very traditional legacy analog player, but if there's a surprise there, then it'll be worth talking about. If it's an upside surprise in particular, that would suggest that some of the more cyclical components of the semiconductor camp are actually firming up, and that might be a more reflection of a sort of global recovery, whereas if Texas Instruments disappoints and sells off, then that's just kind of more underperformance. So that's what we'll be looking for this afternoon. If there's a surprising beat from Texas, if Seagate can hold their own, and of course with NVIDIA breaking out to fresh all-time highs yesterday, we're generally assuming that chip makers are expected to report good things as opposed to bad things, but there's been a big gap that's emerged. So the numbers that we're going to be looking at are a little bit secondary still to the main conversation around artificial intelligence and NVIDIA. Kevin Hanks is joining me alongside Jenny Horn, host of Fast Market and Next Gen Investing, respectively. Themeless day We kind of called it this morning.
We sure did. I wish we were wrong about that, actually. We started to see some firming up of the NASDAQ, S&Ps throughout my show, and then what the heck happened? Now you went on air and you're lower. No, I mean, we actually are modestly higher than now the Dow and NASDAQ, but it's like you're clinging right now to a story. I'm actually, it's like, I feel like in this market, we can see like a non-catalyst event become quite interesting, like a smaller earnings names, for example, like Seagate, Texas Instruments, I think actually could be quite compelling because I feel like we've heard so many commentaries from all these CEOs of like the major AI names, like NVIDIA, for example, that's able to then move the overall semiconductor trade. But without that, without earnings, it's just like this stable, quiet sort of drift to the downside.
Yeah, really the only kind of notable move is the fade in bonds again, Kev, which seems to sort of be our default state for treasuries is selling again.
And some weakness. Yeah, you know, I look at the chart, I look at the 20-day chart of the 10-year yield, and it was October 1st, 3.7%. And then straight up from there over the last 3 weeks. And what's that doing to stocks? It doesn't seem to be doing much after a couple days. So I'm looking at the overall sectors of the S&P 500. It's 6 down, 5 up. The only big one is industrials, and that's GE and Lockheed Martin that are dominating that sector. Besides that, there's not a lot of big movers here. So it's almost like dry powder. You almost want to go to that camp because, Oliver, dollar higher, yields higher, crude higher, VIX higher, gold higher. Market doesn't care. Right. They bought the dip and they've taken it all the way back to unchanged.
Agreed. I think that's where we are still sussing out what that relationship is going to be like between stocks and bonds at this point. That could turn into something more dramatic, but we just don't know if it's that way right now. The Fed speak this week also, I think, is might get less interesting, unfortunately, because Kashkari kind of was the one who made waves yesterday. When I look at the general calendar, he was kind of the highlight, the one that has the potential to move markets.
And he usually is the one that'll make a little bit of headlines. He has a tendency to make them more than others.
Exactly.
Mary Daly, I think, made some comments today. Who was I looking up? Someone.
We had Harker speak.
Yeah, but I thought Nick Timmeros reported that Mary Daly thought interest rates could still go lower, and she made some comments today. So I think this is a dry powder day, all things considered. I think they're waiting for some bigger, high-profile names to start coming out. You know, the high bar, low bar is starting to form kind of a little more clear right now. If you have a high bar going in earnings, it's going to be hard for your stock to rally after that earnings announcement. And a low bar, well, we got some low bars coming up here. We'll see what happens with them tomorrow morning with Boeing.
Yeah, all right. I think some of the earnings-related moves that were fairly violent, with GE down pretty big, Genuine Parts down, so an auto-connected trade down about 20%. I mean, some of these are, you know, notable, but they're not going to move markets. GPC, though, maybe? What do you think about that, Jenny?
Okay, so pretty mixed picture from their third quarter. A grim outlook, I think, is what a lot of the pressure today is attributed to. I mean, we saw overall some segments, profit margin contraction. Their automotive parts actually contracted. Their industrial parts group also declined. And that profit margin also contracted. So anytime you have profit margins contracting, I mean, that's not good, obviously. But they did say that the results were below their own expectations, driven by continued weakness in market conditions in Europe and their industrial business. The good news for this is, I feel like for the rest of the market, is actually, in contrast, you have GM, which reported strength in their trucks and U.S. business. So, I mean, I think, U.S. business continues to be strong. I think this is all good news for a name like Ford, frankly. And also, I know we have Tesla earnings tomorrow. So even though Tesla is its own beast, I do think as far as like the North American business is concerned, which is still the bulk of its business, things apparently seem to be shaping up. And so many of these automotive stocks we talk about in regards to like the various semiconductor trade. I mean, there's aspects of this business that then have a direct impact on like a Seagate, for example. And so I think that at least hearing that the U.S. business is strong is a vote of confidence here. But I'm really reaching. I'm trying to find a theme here in this themeless day.
No, I like that point too. That kind of confirms what we're seeing to some degree in the dollar, which is that European economies just are a lot softer than we are generally right now. So you take one auto parts supplier versus an actual automaker. The fact that GM is doing as well as it is, I think also to some degree is a welcome surprise, Kevin, because if we think about 8 months ago when all these autos were having to cut prices and kind of go to war a little bit with each other. And there was also the notion that consumers were just going to stop buying high-ticket items. Clearly, those concerns have been misplaced.
And the initial rush to EVs, though still going, it's just not going at the pace that original people would have liked them to. And where are they falling? Internal combustion and hybrid. And GE may have accidentally set them up perfectly, set themselves up perfectly for what's happening here. So it's an interesting turn of events. I mean, for GM to get through 50, that was a big hurdle. It broke through pre-open and then fell back down. So them to get through there, that's some serious institutional buying going on in GM.
That was after multiple attempts to try and get through $50 and failing. So the fact that that happened, I think, is pretty notable. This afternoon, Seagate and Texas. I mean, I know you guys have been talking about the chip stuff on Next Gen, but those aren't the Next Gen names.
No, they are. I mean, the Enphase Energy reports.
Next Gen.
What about Enphase? Maybe, I guess.
Enphase is also a good read on like the lack of European growth right now. I mean, that's a huge name, and Germany is like one of the biggest solar countries out there. So,
okay, yeah, good point.
So I'm back to my European theme today, but
don't expect much, basically.
Don't expect much. Texas Instruments at least has been. I mean, I think that name's a little bit more compelling as we go into earnings because it has a good read on like various segments that aren't just AI. And I like the story.
That's why it's kind of stunk.
Exactly. So I think that's going to be an interesting one. Again, I'm trying to make a compelling case, but anytime you can tell me about like your businesses outside like the traditional growth engines, like I actually liked that GM said their traditional business, they're focused on their profits again. I mean, like talk to me about the way most of your company is making its money still. I appreciate that.
Yeah.
I think Texas Instruments has got big inventories, big expansion plans, and a big valuation.
Okay.
And so they have to show some promise going they're already kind of guided for a weak Q3. It's going to be an interesting one today.
All right. Thanks, guys. There we go. Found some good stuff to talk about. An otherwise sort of forgettable session. Forgettable sessions don't necessarily make forgettable shows. Thanks for the help. Jenny Horn, Kevin Hanks joining us. Ali Hushban is Managing Director and Portfolio Manager of EQT Exeter Real Estate Income Trust, a publicly traded REIT. Ali, thanks for being here on the Schwab Network.
Thank you for having me.
And good timing because it seems the last couple of days we've been talking about some of the themes that the market had been gaining confidence on. Yield curves, impact on regional banks, commercial real estate, and then we get the pretty big move in the last 48 hours in rates, and we get a little weakness in some of these themes. Kind of take me from the top line of what matters most to your business. Is it interest rates? How much does that factor into what you do?
Yeah, thank you. So EQT Exeter, is a very much of a bottoms-up organization.
Okay.
We've got about 50 offices globally, 30 in the U.S. 24 plus in the U.S. to execute our business. And the reason we do that is because we literally do everything in-house: leasing, property management, et cetera, et cetera. And there's just a way to tell you that, yes, we absolutely monitor interest rates, inflation, macros, et cetera, but at the end of the day, we're literally analyzing street corner by street corner with respect to what our tenants want and sort of what the market needs. But to answer your question directly with respect to interest rates, yeah, it's certainly created a dislocation. There's a capital markets dislocation. I would say of the many food groups in real estate, industrial is still relatively healthy from a long-term fundamentals perspective, but even it is not immune to a 400 or 500 basis points move over the last couple of years in the benchmark rate. And so we are certainly seeing opportunities there, and we are seeing values reset actively in the U.S. for sure.
Where are those values resetting the most, and in which direction?
Right, so they're basically getting cheaper. I don't know how well your audience knows about cap rates, but if you think about the typical core industrial transaction in 2021, sort of peak 2022, we're sub 4. Those have probably expanded by anywhere from 100, 150, in some cases 200 basis points. In other words, multiple dilution. So buyers are getting better deals in this market. In terms of where specifically
ETF up next.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Back to Market on Close. Let's talk some investing themes as we've seen high quality stocks dominate performance in the market the first half of the year. Things have shifted a little bit in the last 3 months. The market's broadened out. Now the question is what's going to take us higher. Kevin Kelly joins founder and CEO at Kelly Intelligence, home of the Efficient Growth Fund, RUNN, which about a year ago launched and is getting close to 250 million AUM. Kevin, good to see you again.
Great to be on. Thanks for having me.
So let's kind of frame this conversation about the sort of factors that are this year have kind of been skewed one way. The first half of the year was like super high quality, highly concentrated tech stuff. Now it seems like the market wants to dabble in some of the value trades. So how do you kind of navigate that, and what's the approach to sort of thread that needle?
Yeah, it's certainly broadening out when you look at the performance as of late. I mean, obviously, value and quality certainly it hasn't had the run up because it hasn't had the concentration like the other indices where NVIDIA is the top player and it just is off to the races.
That's
so
right.
We're starting to see that broadening out. So if you think about the market today, it's anticipated that we're going to see earnings growth around 14%, but that's across all industries.
That was my go-to trade for a while.
Which haven't been so magnificent. So when you're thinking about portfolio construction, one thing you want to think about is diversification, right? And where is your risk? You want to get on the so-called efficient frontier. And one way to do that is really diversify your portfolio into names that still have growth qualities, but you're not subjected to that concentration risk. And so Running Oak, the efficient growth strategy, really focuses on where you're getting into high growth names, but you're not overpaying for them. And then one of the ways it actually protects itself in all market cycles is that it, one, doesn't get over levered companies, right? So a lot of times when you see growth, sometimes those companies are over levered and can really catch you on the downside. You know, it's one of those things that, you know, when you want to get out, it's really tough and you're subject to the downside. Another way to do it is to think about diversifying out of your current exposure. And so when you think about portfolio construction, you don't want to overlap. So an active share, which the efficient growth strategy has around 97, helps you diversify your portfolio because you're not already owning those names like in the S&P 500.
It's pretty interesting, the list of companies that end up falling under the umbrella And also, the fund has basically kept pace almost to the T with the S&P 500 since its launch, without having any of like the mega caps. Basically, I mean, Eaton, Curtiss-Wright, Air Products, MCOR. I mean, W.W. Granger. There's a lot of like sort of cyclical kind of overlooked themes here that I guess together all work well. But that's quite a feat to have that kind of value tilt in a way, or rather, just not have the super heavy tech stuff in there to compete. Do you think that's something that's sustainable?
Yeah, and here's the reason why. Because if you think about the mega caps, their valuations are high. And so if you go down towards more of a mid cap space, you can get the same type of growth, but for a lesser valuation. So that's why you're seeing the names in the portfolio are more mid-cap focused-esque. You know, they're in the large cap, mid-cap, they're not mega cap names. And so that's one of the reasons why you're seeing the performance, and especially with the broadening out in earnings. So that's the nice aspect of this. And that goes back
33
to that
minutes
share where all the names you mentioned, talk to 10 out of 10 advisors, I'm sure they don't own every single one of those names, right? They don't own all of those names, so you can get it in one efficient growth strategy.
The other thing too is, I guess, if it hasn't underperformed when the expensive companies were leading, then any rotation in the market should favor this strategy and potentially then outperform. So if it's been able to do a keep up when the broad market S&P has been driven by expensive tech, if that changes at all, then that would be in favor of the strategy.
Yeah, it would be in favor of this strategy, and one of the key tenets of the strategy is long-term hold, right? So it's equally weighted, so you're not having concentration risk. We've seen that happen before in go-go days, where you can have like famed female tech investors, you know, have a genomic fund and they would Teladoc over-concentrate and then blows up, right? So the nice aspect here is that you're really focused on diversification with equal weighting. You're not over-concentrated, long-term hold, so you let it play out over the entire market cycle, right? So you're not constantly rebalancing in and out of names every single quarter, semi-annually, annually. So it's a long-term hold, lets the thesis play out, and so it's names that people don't even own. But it's important to note that the strategy has been around since 1989, and it's had half the drawdowns that the S&P 500 has. So we're trying to participate with the upside, but limit as much downside as humanly possible.
Got it. And that's kind of where I guess the value proposition is very important. The limited downside. Do you have a strong macro view, Kevin, on what happens maybe from here to the end of the year and what the risks would be? Like, I guess if the economy hits a wall or the Fed's forced to hike, will some of the cyclical names then underperform, or is there any macro risk you see?
Yeah, that's the biggest problem when you're investing in the market, right? Is your systematic risk. And so, that's why you need to focus on getting in names that have idiosyncratic risk that can perform over the various market cycles. So yes, there's a lot of concern out there. There's a lot of greed. Valuations are high. If we look at how we're trading over the moving averages, it's just showing you put call ratios. Everything you can see out there is just saying we're in a go greedy phase where you may want to look at, okay, how do I protect myself to the downside? Because there is so much uncertainty out there, especially when it comes to economic policy, when it comes to, I know you wrote a note recently on the political economy. But those are of concerns because we've seen that as different administrations come into office, we could see new wars that impact the price of oil or gold or other things where people then have flight to safety. So there's a lot of uncertainty out there between now and the end of the year, and so it's hard to digest that even going into a good earnings season.
All right, good stuff. We'll talk some more macro when we catch up next time. Kevin, thanks for the explanation. Appreciate it. RUNN is the fund. Kevin Kelly, founder, CEO at Kelly Intelligence. Let's take a look at the S&P options flow coming up. Some of the positioning also into Tesla ahead of tomorrow's report. We'll check out some of the gamma levels on the index and in the highlight of the week for earnings, which of course is Elon Musk's giant tomorrow.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome back to Market on Close. Let's look at some options flows. Mr. Shane Skinner rejoins us, manager of trader services at Charles Schwab. And we're going to talk some S&Ps, and you got a little treat for us with some Tesla analysis as well, Shane. Now, let's start with stocks. I mean, what is there to say? We're doing nothing.
Same thing as yesterday, like we said. VIX expiration Wednesday seems pretty tight. They're going to keep that thing likely between 15 to 20-ish. And so, you know, when we're right in the middle of that, don't expect vol to do much. Don't expect the market to do much. And, you know, again, like we said, 58.50 yesterday is just, it's sticky.
Okay, so right now it's pretty much where we're at, 58.55. Let's pull up the chart. Let's look at where the potential ranges are. If that's the median, where are the guardrails on the road?
Yeah, so in terms of today, you're green right up above at about 58, 60, 65 seems to be sort of max upside on the day. Your white area is where the most gamma has been for the last probably hour in terms of balance on both sides, calls and puts. You've seen the most right there. Blue has been the point of control, also known as the max pain level, sort of where majority of long option holders essentially experience the most pain, and the most options expire worthless on both sides there at that blue level. So not a surprise to see that hold throughout the day for a while before we were finally able to break out to the upside. And then, you know, red down below, that 58.25 level when we woke up and started the market there this morning. You know, it wasn't a surprise. That was a level we were watching yesterday. It touched in the morning, caught instant support, took us back up to the point of control in blue, and then from there they took it another 20 points higher.
Okay, so we found support. How important was that this morning to kind of explore the lower end and then bounce back to hold after yesterday, a little bit of slippage? Also, we kind of did firm into the close thanks to tech, thanks to NVIDIA.
Yeah, if you're bullish right now, this is what you want to see. You're not upset at the idea of a slight pullback, a quarter to even maybe 0.5% down, you know, in the index, and catching a bid, pulling back up, looking towards Friday's expiration. You know, 58.50 has a ton of action going on at it as well. This is today's, but 58.50 on the week as a whole. Just a ton of action. So we expect that level to be a magnet. So if you're bullish and you're going to stray from that level, you just want to snap back up to it. And as the week progresses, we essentially, over time, break from that 58.50 level, start exploring higher, and hopefully by Friday, you're sitting in that 5,900 area.
Okay. So at this point, Dan, it seems like the still trend generally in bulls' favor, but it's slowed a tad. Last week I described it as a slog. We ultimately got a percent gain, but it did kind of have to add up. Seems like that's an okay thing, but if vol starts to creep, then maybe there's something underlying. And it does seem like the vol situation refuses to budge. Does it add up, the positioning in S&Ps versus the positioning in vol, or does it look like vol traders are still kind of bracing for something a little bit more choppy?
At this time, I think we're seeing prices and puts and just vol in general is a little elevated more than we've seen, recently throughout the summer, barring the, dip in July and August there. At this time, though, I think the market and vol are sort of behaving pretty evenly in terms of, the positioning in VIX. Like we said, 20 is a big wall to the upside. I don't think that'll give. And then all that positioning down at 15 below in the puts, I wouldn't be surprised if this gets crushed, going into tomorrow and then the rest of the week. You just, like you said, price up, vol down, and you're going to stay in this sort of tight range. The S&P on average each month has been going up about 3 to 3.5% roughly. And so in the past month of trading, we're up about 3 to 3.5% right now. So, not out of the norm to see us up that much on the month, and here we are sort of just running sideways.
Okay, so the heavy positioning at VIX 20 suggests it's going to take something real dramatic to pop us through that. It does seem like with the election kink in the vol curve still, talked about that with Henry Schwartz from SIBO this morning, that more likely than not, hopefully, if things go all smooth, then that vol will start to dissipate. But it also seems like, it might be tough to get it back down super low beyond 15 to the downside. Let's talk some Tesla. What are the levels? What are you looking at? Is there a bunch of options in there? Is there a bunch of big positioning? Institutional traders giving us some insight on what numbers maybe to expect?
Yeah. So there's 3 key levels I've got my eyes on. 220 seems to be the max pain level, and again, that's sort of a point of control where the majority of long, call, and put holders, those options are going to expire worthless and or at a low value. So that 220 might act as a magnet and hold. To the downside, 200 is where you've got the max amount of put open interest to the upside, 232.5. So expect that to act as your sort of range initially with earnings, and then if you're able to break below 200 or break above 232.5, you might see some another 5 to 10 points. What's interesting to me more than anything right now in this expiration of Tesla options, volume today versus total volume for all Tesla options, 55.31% of volume today in Tesla options has taken place in this Friday's expiration. So a lot of money on the line there. And then another thing is the put call ratio, both relative to open interest and volume, is less than 0.75, 3/4. So you have what appears to be bullish sentiment in the options market right now on Tesla. Now, whether that holds or not, I'm sure it's going to come down to 4 main factors within their earnings, right? Are profit margins shrinking based on price cutting? What's revenue looking like? Is it growing? Is it sustainable? I'm sure we want to know more about autonomous driving and the robo-taxi situation. And then, on top of that, they've got leadership changes and the ever eccentric Mr. Elon Musk, who no one can seem to peg. So it's going to be a really interesting one, but I wouldn't be surprised for a break to the upside of Tesla.
It seems like for the stock's habit of being a higher beta style trade, these complete sideways activity for almost 2 weeks is somewhat abnormal. And so even though
absolutely
there's a lot of options like, pull magnetism right at that 217.5, it seems like there's also some pretty welcome speculation happening that that's going to break out.
Absolutely. And, again, we've heard the phrase time and time again, never short a dull market. The last thing you want to do is be getting short here as this thing's ran sideways for 2 weeks. And then once a move's made, if that thing breaks out to the upside, I mean, we're probably going to see some big short covering going on. So this is a situation where, it's sort of a coin flip, but based on positioning in the options market, it seems like there's bullish sentiment.
Yeah, it seems like it does skew a little bit more bullish just looking at where the trades are taking place right now. So they'll skew favoring the upside potential. Thanks, Shane. All right, helpful, good stuff. Nice look at the S&Ps, and love the Tesla details too, getting us ready for tomorrow. Appreciate that. Staying cognizant of earnings coming back. We'll go to the NASDAQ, talk about that IPO pipeline, and give you a developing story for the smokers. PM is a rally to an all-time high, the return of the classic, but also the embrace of the new, of course, from Philip Morris.
Ethan, how's my favorite client?
Great! I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome back to Market on Close. Stocks hovering, of course, near all-time highs, and the IPO pipeline is a busy one. Let's go to the NASDAQ for the latest with Madeline Radner, Director of the Market Intelligence Desk. She's got some good macro thoughts for us as well this afternoon. Madeline, good to see you again. Let's talk some IPOs firstly. Give me the latest here. Who's coming through the pipe?
Yeah, so NASDAQ actually just released the latest version of the NASDAQ IPO Pulse Index, which actually sees IPOs really holding up into next year. I know we've spoken about the IPO Pulse in the past, which is a data-driven approach to an IPO forecast. The data looks at various factors that really would take into account for a company to determine if they're ready to go public, such as market volatility, interest rates, earnings, valuations, and investor sentiment. So the Pulse actually remains right around 3-year highs. So we're seeing that IPO numbers as of late have been consistent with what the Pulse has shown us in the past. So IPO activity was actually little changed in the third quarter from the second quarter, where we saw 2.5-year highs. So year to date, we have now seen 183 total IPOs, that is including SPACs, that have raised just under $34 billion in proceeds.
Pretty good stuff. Seems like the index too, the Pulse, has done a pretty good job of signaling kind of the overall swings. I'm not sure if I'd be trying to trade it as a correlation, but it seems to give a really good general assessment of the environment. Recent headwinds, I don't know, compared to kind of 2022, it seems like still a more favorable environment today, but we haven't kind of seen rates pick up again. Is there any chatter about that at all in your world?
Yeah, I think some of the major headwinds will definitely turn into tailwinds. It just might take a little bit more time as we see rate cuts really play out here. I think there's really been two main challenges to the IPO market that we could see improve again as we see more rate cuts come into the picture. And those challenges are around valuations and margin. So higher cost to borrow has really impacted company valuations, which then in turn discounts future earnings. So that might have been making companies a little bit more hesitant to move forward with IPO plans until valuations improved. And then when we look at margins, those have been hit pretty hard, specifically across some of our small cap companies who really have about 50% of their debt in floating rate. So actually some data compiled by NASDAQ's economic research team showed that rate hikes doubled the ratio of interest to earnings for small cap companies when we look at the S&P 600 specifically, from about 20% to 45%. So the rate hike process really hit those companies hard. So as soon as we see rates continue to decline, it should be easier for companies to grow valuations, especially across those small and micro cap companies, biotechs, community banks, who typically choose NASDAQ as a listing venue of choice.
Love that connection to some of the stuff that we talk about on a trading perspective, which is sensitivity by small caps to rates, and it shows pretty clearly in the chart how kind of linear that relationship is, where smaller down you go, the higher interest expense to earnings ratio that you get. So pretty clear kind of sensitivity that that does make sense. The good thing it seems like is the earnings potential for some of those small to mid cap companies also should be firming as the economy holds in. That should at least on its own, all else held the same, help alleviate some of those interest to expense ratios.
Yeah, definitely. I do think maybe one rate cut is not going to solve the refinancing risk that a lot of these small and micro cap stocks have been seeing. It might take a little bit longer, and as you know, there's been a lot of conversations in recent days over how many and what's the trajectory of the rate cuts going to look like. So I think the small caps are hesitating a little bit, especially coming off of last week's rally. So I think the bottom line, the focus and the appetite is still really on mid and large cap companies, especially as we're looking at earnings season. I mean, 22% of the S&P 500 is reporting earnings this week, and all eyes are still on those large cap companies just because of the sensitivity that we're seeing in the small cap space. That said, when we look at earnings year over year, we're still seeing a little bit of a recession in the small cap space, but it looks like next quarter we'll start to see year-over-year earnings growth potential for some of those small cap companies if we're looking at that chart.
Seems like we're right on the fulcrum, right? That's current. The orange bar there with, I mean, that's the turning point. We're at the pivot.
Yes, we're at the turning point, yes. So again, as the economic outlook improves, earnings remain strong, we could really see the small cap space take off. Again, it might take a little bit more time, but that could also provide a runway for some of these smaller companies looking to tap into the public markets, grow their company as a public market on a U.S. exchange.
Yeah, love that. Good potential outlook there, and good connection into the things we're talking about on the macro side with the rates. Love it. Thank you very much, Madeline.
Thanks, Oliver.
Yeah, good look at the charts. Madeline Rauner, Director at the Market Intelligence Desk, where the IPO Pulse suggests more on the way. Just need some earnings to kick in and hopefully rates to stay cool. Let's go to Jenny Horn in the newsroom for our developing story. Before we get into the macro discussion with our big picture panel, let's have a smoke break. Philip Morris rallying. Is this because of the old stuff, Jenny? Or is this because of the new stuff, like the vapes and all the other biz?
So the irony of what you just said is it's because of the new stuff. It's actually because of the smoke-free, a lot of this like tobacco-free, the oral stuff that people can consume, like Zyn, for example, is crushing it. And I think there's no secret there. I mean, you go to most gas stations, it's like flying off the shelves, but they did mention that quarterly shipments of smoke-free products reached close to 40 billion units. The smoke-free business now accounts for about 38% of their total net revenues and 40% of their gross profits, with those revenues increasing by 14% or around 17% organically, and gross profit rising by 16% or over 20% organically. So their total cigarette and heated tobacco unit shipment volume actually did still increase by about 2.6% to around 198 billion roughly, and cigarette shipments actually increased by 1.3%. With increases in all regions except for
9 more
America.
minutes.
Good to know that Americans are for once maybe doing something a bit healthier. But total oral product shipment volume in cans increased by 25%, predominantly reflecting that growth in nicotine pouches specifically. I think this is a really interesting story and a read on like the tobacco market, because I know there was a time where there was a thinking this was left for dead. That's obviously not the case. And then you look at it compared to one of its closest competitions like Altria. It's about 88% still exposed to the traditional cigarette market, and this name's outperformed on the year. So I think there's no secret why. They're definitely finding that niche and continuing to capitalize on that fact that consumers, regrettably, do still need their tobacco. They're just choosing different forms.
Okay. Zen is monstrous. I mean, it just seems like this is like totally taking the world by storm, basically. So huge growth there. I'm not surprised when you've got essentially the hottest, the hottest thing. It's like a meme, Also, some of the government interference on like the Juul and other vape stuff too. I feel like has positioned the pouches even stronger.
Totally, and also I totally agree. It's become like almost a cultural phenomenon where I feel like now it's almost like a part of like being your image. If you post about like, I've seen these people that make like structures out of their Zyn cans. I don't know why that's coming up on my feed, but it exists. I see it over and over again.
Okay, well you might have to do some soul searching there if you're getting targeted with Zyn products, Jenny. But no comment further. 41% rise in Zyn sales. Okay, intense stuff. Too intense for me. Tried one of the golf sims somebody had one day. No, it didn't work.
Hey, we all gotta find our vices, all right?
Yeah, all right. Appreciate it. Thanks, Jenny. Big picture with the Schwab team coming up next. Into the bell. We might get all 4 indexes higher. Russell just needs to add another about 1/3%.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Stocks might just go all green here in the next 6 minutes. Joe Mazzola joins us alongside Kevin Gordon, which means we're talking some stocks today. Good afternoon, guys. Kevin, get us started here. Market's kind of a little bit slow, but seems we've still got pretty good momentum behind us. What's your read?
Yeah, there's pretty strong momentum. I think if you were to take it year to date, the momentum factor, at least for the S&P, is having its best year since 1999. So it's a pretty strong year so far for momentum. Took a little bit of a breather yesterday and today. Although even with yesterday, it was interesting that kind of breadth weakness that you had for an index like the S&P, with more than 80% of members declining, but really with just a slight loss for the overall index. It really puts it in a different historical category in terms of it being an outlier, but also speaks to at times the strength of a sector like tech. I think the one interesting caveat with that, though, and what's probably worth being mindful of moving forward, is that even for supposed strength and a supposed strong rebound for a sector like tech, it's pretty thin in terms of its strength up the cap spectrum, being led by only a couple of names, which are mega cap in nature. For the industry that is sort of always in focus, being semiconductors, breadth has looked pretty weak there, even though the industry's been doing pretty well because of names like NVIDIA. So I think it's a thing worth mentioning or worth keeping an eye on, because you do have a sector like tech that's been exhibiting some strength since the Fed cut rates, but it hasn't necessarily translated to the entire sector.
I like that point. It also brings me to kind of the valuation subject for the broad market, which started out in tech, but now has got some more going forward. So we keep getting more expensive. Basically, in the S&P forward PE like 24.6 right now. That's juicy, Joe. That's basically outside of COVID mania and .com. You don't really see that. So how is our potential to grow into that this earnings season, Joe? You think we could just work that off, kind of the old-fashioned fundamental way, but pumping out some earnings?
I think you're probably going to have to see a higher earnings than what are expected, and kind of what we've seen so far. Expectations were about a 4.2% year-over-year growth, and we're trending around 5.5% to 6% right now. So that's good earnings growth, but it's not the double digit that you probably need to see to kind of work off some of those multiples. I think what I think is important is kind of the takeaways from this quarter as we head into Q4 and then 2025. Do you start to see some of those earnings estimates revised downwards? Because we haven't seen that yet. They've kind of held firm, and they waited to the analysts waited to relatively the kind of the end of the road before kind of cutting Q3s. So they lowered the bar enough to where you're getting a beat rate around 80%, which looks good. And at the same time, out of the 11 sectors, eight are forecasting or have already beat, and 3 are coming in a little bit light. And those 3 are energy, materials, and industrials. And I think given energy is expected to come down about 25% year over year, kind of given what we saw with the crude oil prices, that one's understandable. Materials and industrials we want to keep an eye on going forward. But at this clip right now, the way we're going right now, I'm not sure you're going to grow into that 24 PE.
Yeah, it's a lot to grow into. What kind of surprise rate would we have to hit, Kevin, to live up to those expectations? Is this an unachievable bar, or can time work in our favor as long as we don't get any adverse events to kind of create that slippery slope of selling?
Well, the key point is the end of what you just mentioned. Stretch valuations are really, I think, just emblematic of and symbolic of a relatively stretched investor sentiment environment. We tend to use them as a sentiment indicator or an indicator of sentiment, and really what they tell you is that investors feel pretty great about the market. If you're sort of paying relatively nosebleed valuations for the broader S&P 500, then you probably feel pretty optimistic about the market, and you're sort of caught up in the momentum trade itself. But anytime you get to an environment where investor sentiment gets frothy, not just in an attitudinal sense, but in a behavioral sense as well, which is sort of where we are. I mean, you mentioned the point about being the most stretched since the COVID craze period, but also the late 1990s. And that is true across several valuation metrics.
There's the crash at the end of the day.
It doesn't necessarily mean you're at an imminent end for the bull market. So it does take something to tip you, in the other direction. What that is, nobody.
Market's trying to tell me something. Be careful. That's for sure. So, from here on out, Jimmy B's careful until the election. That's 2 weeks. Then we have those big days where I can get $1,000 contract on SPX. So, catch y'all later. Thanks, everybody.